not the opportunity because of the cooler job market. And so if people feel stuck, that resentment is going to build up. And once the job market does heat back up, I think a lot of employers are going to get caught flat-footed, not expecting a wave of turnover, a wave of revenge quitting, if you will, to start to take hold.
What are some of the top reasons for the buildup of that resentment that you were mentioning among employees?
I think it's really about career growth and career opportunities. Consistently, when we look at the Glassdoor data, that is one of the most important factors behind employee satisfaction. It helps attract people to companies and also keeps them there in the long run. Right now, there are a lot of employers who are cutting back on their budgets for raises, for promotions, and that sort of thing. And of course, if you need to do that to stay in business, to keep the financials healthy, that's a choice you have to make. But for employees, they're not going to sit there and get passed over for promotion year after year after year and not want to look for something new once the job market opens back up again.
It's remarkable within this data as well. You pointed out the side hustle culture, and it's fueling new paths to career growth. And, I've often heard about this, especially on the show, and the side hustles, and especially now in the creator economy. My goodness, we had the CEO of Cameo on yesterday talking about how many people are joining the platform, earning on the side as well. And we learned about an inanimate object in a puppet that's earning $600,000 in 2024. We'll put that conversation to a different thing. But how many people and what portion of the population do you think is really coming around to having
this ability to earn within the margins of their time and using that as a potential pivot one day?
Mm-hmm. In this Glassdoor poll we looked at, about 40% of workers are actually pursuing a side hustle, and I think that goes to show you that a lot of people are pursuing these non-traditional paths to success in a time when maybe the traditional career path or the traditional career ladder isn't really working for a lot of people. And I think that it's actually very encouraging, because not only does it allow people to experiment in maybe a lower stress way than just fully quitting your job and starting something new, but it also opens up those pathways down the road if maybe you want to start a business and really go all into self-employment and entrepreneurship.
Yeah, I'll send you my LinkedIn post about the puppet making $600,000. Daniel, great to see you.
Thanks.
Absolutely. Well, inflation overall is moderating, but one sticky item has been the price of eggs. Cue up the egg VO. 1 dozen grade A eggs currently cost around $3.37 in October. That's up over 60% from a year ago, according to the Bureau of Labor Statistics. Here with more on egg price concerns, we've got Tom Flacco, who is the CEO of Pete & Jerry's Eggs, here in studio with us this time. Great to have you.
Good morning. Great to be here.
Absolutely. Let's dive into this. What's really driving the cost year over year and the increases that we've seen in the price of eggs?
Yeah, I think the first thing you have to look at, Brad, is just to remember that the egg business is really two different businesses. There's what we call conventional, which is in the well, and then there are specialty eggs, which is what Pete & Jerry's and Nellie's are. The conventional eggs are a supply and demand driven business. So the number of hens out there are going to produce a certain number of eggs, and that's going to drive supply, which is going to end up driving the price or affecting the price on the shelf. That's set by an independent group. That has been affected by avian influenza, which has started in 2022, and we're still dealing with it. So we talked about this a little bit before. Since then, another 20 million birds have died from avian influenza, which takes, if the total layer population is around 325 million birds, 70 million in total have come out on this cycle. So when you take that much of a reduction, almost a 20% reduction in the supply of birds laying eggs, that's going to drive up price. Now, that's not the case for specialty eggs. For our eggs are actually about the same price now as they were a year ago for both Pete & Jerry's and Nellie's. Our eggs, we have a much different model. We have a fragmented model. We're in close to 300 farms and barns across the country. And so our eggs are not beholden to any one flight path of migratory birds. Avian influenza is spread by migratory birds. So that distributed model protects us. We also have, our farms are run by families, and there's 1 or 2 people on that farm doing all the work. So you're not bringing new people on and off the farm, which again is how that disease can spread. So touch wood, we haven't had the impact that those big conventional players have had.
So I guess from the broader industry, how far away are we from normalization of egg prices post avian flu, if that is in sight here?
So the thing about avian influenza is like any other virus. It mutates, it has become a little stickier. It's not going away as quickly. The last big bout lasted maybe about a year. This one is close to 2 years. 2015-16 was the last big bout. It went away for quite a while, and now it's come back. We're seeing it start to abate, but then every once in a while, then another farm is hit and another million or so birds are affected. So we're not seeing it go away anytime soon, although this is the time that it ought to quiet down.
Sure.
So now birds have finished migrating, either now they've gone south, and we should start to see it quiet down, and then we'll see what happens in the spring if that comes back.
You've got an incoming administration that has been campaigning on a myriad of different talking points and rhetoric, but one of them that has emerged, at least on the food side, has been Make America Healthy Again. And I wonder, from your seat and position as an executive within this industry, what type of changes you're even anticipating needing to come down the pike as you're having discussions and representing a portion of the food pyramid.
Yeah, I mean, the good news is inside we refer to eggs as nature's perfect protein. It is the perfect little protein bomb that has a very small carbon footprint. It has a much better health impact than, say, beef or some other alternatives, and is certainly on a cost per gram of protein basis much easier on the wallet than, say, steak. I mean, I was doing a store check this morning on the way over here, saw a piece of steak for $22 that wouldn't, I don't think, feed 2 people. For $6 or $7, you buy a dozen of Pete and Jerry's or Nellie's, you feed your family and probably have some leftovers. So for us, it's around breakfast for dinner, and we think eggs have already been deemed a healthy food by the FDA. The cholesterol myth is debunked. Cholesterol has a lot of very important, very healthy proteins in it, and vitamins, and so eating a whole egg is not going to raise. Matter of fact, there's somebody who I think he ate nothing but 4 eggs a day for a month, and I think his cholesterol went down.
Wow. Okay.
So when you think about eating healthier, it is about something it's healthy eggs, it's healthy hens, healthy eggs. We think a healthy planet. We think all those things are related. Our birds, by the way, because we're free range and pasture raised, that outdoor access is a really important piece to creating the healthiest egg possible. Birds that don't get outside, they're not going to have the access to vitamin D from the sun, grubs, bugs, things that chickens like to do.
Yeah.
They're just not as happy. We don't think as happy or as healthy, so caged and cage-free. So we think if you really want to lean into this, right now the cost difference is less than $1 between cage-free and free range. But cage-free is not, the birds are not getting outside.
Yeah.
Free range they are. Right, so you're getting better animal welfare, more humane treatment of the bird.
Yeah.
And we think a better product on the backside.
Just lastly, while we have you, Tom, it's so interesting, the many industries that AI is going to have some type of role within. Could we really see that within food distribution, within egg production even?
Yeah. Talking about the other AI now.
Yes.
Yeah. The AI everybody else talks about. Yeah, so for us, we look at artificial intelligence as helping us really in two important areas. One is forecasting demand so that we can make sure we have the right supply online, and then the timing of that supply and as it comes on to be able to meet that demand. So AI can help us in both those areas.
Excellent. Tom, great to have you here in studio with us. Great to catch back up. Appreciate it.
Great to see you. Thank you.
Coming up, everyone, your Yahoo Finance Market Update. We'll check out how stocks are moving and run through 3 stories you don't want to miss. Stay tuned.
are 2 hours into the trading day. It is time for Yahoo Finance's Market Minute. A flat day on Wall Street so far, with the S&P 500 and NASDAQ teetering near the flat line. Taking a look at the Dow, down right now about 0.2%. 3 trending headlines we are watching today. A choppy day for crypto miners as stocks initially got a lift with Bitcoin rallying past the $100,000 threshold on news of Donald Trump's pick to lead the SEC. Some of those gains now being reversed. Investors cheering the latest results from ChargePoint Holdings. That stock is popping after the company reported better than expected sales in its most recent quarter. And shares of Salesforce reversing some of those gains after getting a big boost on positive earnings results. The company raised its revenue guidance for fiscal 2025, citing strong demand for its AI offerings. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
Welcome back. Let's send it down to the New York Stock Exchange, where Yahoo Finance senior reporter Brooke DePalma is standing by. Hey, Brooke.
Good morning, Brad. Bath & Body Works just had a strong Q3 report, and now they're gearing up for their annual Candle Day. And I'm joined by Gina Broswell. She's Bath & Body Works CEO. Gina, good morning.
Good morning. Thank you for having me.
Of course, I want to start with something that's on top of retailers' minds at large, and that is tariffs. You say you have a big advantage here. Why do you say that?
Yeah, for years now, we have been doing a lot of nearshoring and onshoring, and really pleased to say that today, 85% of our production manufacturing is in North America, the majority of which is really right outside our headquarters in Columbus, Ohio.
Would you say that tariffs then are a benefit against your competition?
Well, I wouldn't say that so much. We do it for two reasons, really. One is minimal exposure, but the other reason for having onshoring is just flexibility with speed and agility. And for us, that's part of our differentiated model, is to be able to get our products in the stores in weeks rather than months. So it's sort of a double benefit.
Roughly 10% of your products or sourcing does come from China, Canada, as well as Mexico. So when you think about that, how much of an impact will this have? Will you have to then raise prices?
Well, we do a lot with our supplier partners, very collaborative. It's a group of suppliers called Beauty Park, and we work together to, mitigate any sort of additional costs, as we have been doing for years and years with them. So we would seek to mitigate that, and if there were anything, of course, we would, pass on a modest amount. But honestly, I'm very comfortable with the value engineering that our team does to be able to mitigate that.
So Best Buy CEO does say that consumers will brunt the cost of it. You're saying not so much in your case.
Well, we offer a compelling value proposition. So for us, it's all around the absolute highest quality, the most value, which includes convenience and experience, but at an affordable price. And so that's very important to us, to make sure that we're meeting the customer mindset where they are.
Yeah, perfect segue to your big annual event, biggest promotion perhaps of the year. It's your annual Candle Day. How are customers thinking about promotions and overall this holiday season?
Well, we are on the eve of Candle Day. It is our biggest day of the year. And, I'm so excited to see how the stores are going to light up with all of that. We usually have customers lining up at 6 a.m. Literally lining up with matching outfits. We have a fandom that is like no other brand I know. And so to see that sort of excitement, and we're also celebrating a 25th anniversary for Winter Candy Apple. So we have fragrances that people love for years and years and years. And so when it comes to just the shopping spirit, the 30,000 seasonal associates that we hire to be able to keep up with the shopping demand, bring all of that to life with our customers. So,
are customers really focusing in on these promotions days? Are they holding to buy out until then, or are they mixing their basket with full price items as well?
So we have been seeing a value-seeking customer for several quarters now. And as I said, value isn't just about the lowest price, and we were very excited. We're America's most loved candle, and what that really means is the leadership credentials that we have. It's the best fragrance throw, it's the 25 to 40 hours burn time, it's a clean burn, and so forth. So we find that when customers seek value, they're not necessarily seeking the promotions per se or the discounts, but rather the full quality. And so that's what we bring to bear. But yes, they are choiceful, they are discernible in terms of what they put in their basket, but we've been navigating successfully this macro environment for some time now.
Yeah, I do quickly want to hit on the share price. Year to date, shares are down roughly 14%. What's your message to investors here?
So we are heads down executing against a long-term strategy, and it has been working from the standpoint of, I think, this third quarter. If you adjust for the calendar shifts, which is, of course, you have to remove the 53rd week and the shorter shopping season, we have sequentially improved our top-line sales throughout 2024.
Very quickly, top challenges against your consumer right now, and where is your consumer when it comes to the income cohorts?
So one of the things that we have a huge loyalty program with 38 million active loyal users, and that allows us to sort of look at demographics of all kinds, socioeconomic. We've actually not seen any discernible difference on socioeconomic in terms of their behavior and their ability to shop with us. And I think that speaks to the fact that we have a wide range of price points. You could literally go right now and pick up a beautiful gift set already wrapped from $10 to $50. And so really it's more around meeting the customer where they're at and less about sort of the socioeconomic segments. And we certainly don't see it in our data, so we're excited about that.
Gina Broswell, Bath & Body Works CEO, thank you so much for joining us.
Thank you for having me.
Happy holidays. Happy holidays.
Thanks, Brooke, for that interview. Really appreciate it. All right, everyone, let's take a look at the major story that we're tracking here today within the crypto markets. Bitcoin holding above 100,000 right now, and it's really the move over the past 24 hours here. How about I circle it over here? That 6% move that you've seen equates to about $5,600 and has pushed us above that $100,000 marker. And as we're taking a look over this past year-to-date move that we've tracked, of course, much of that rise higher has really been sparked post-election, now we're getting even more news and inclination about how crypto thinkers and traders and holders out there are anticipating the entire environment to potentially shift next year with a more crypto-friendly SEC, more of those picks being made known, and now you're seeing us cross above that. But there's still a lot that has yet to be delivered. We'll see exactly what that looks like over the course of next year. But as we're thinking about some of the other elements of the crypto landscape, let's take a look at other cryptocurrencies as well. This is a past 1 month view here, and you can see Ethereum has risen by about 60% over that period. Bitcoin is not the biggest outperformer. Hey, take a look at XRP. That's been up over the course of the last month by 360%. Here on the day, seeing a little bit of a give back. Of course, this is a 24-hour look at Ripple, but all these things considered, a ton of green here as the broader Bitcoin ship has been perhaps rather a tide that's lifted the rest of the boats here that we've been tracking within the crypto landscape. And then just lastly, here's a look at the crypto stocks. Let's take a look at those intraday on this new record day for Bitcoin at 100,000 and above 100,000. And as of right now, you're taking a look at more green on the screen than red. However, pulling up a little bit of the caboose here, you've got Argo blockchain, but leading the pack here up across the board. You've got an 8% move higher into 9 and some of the other crypto-related stocks as well. Coinbase, for all those that are keeping score at home, as of right now, it's up on the day by about 0.3%, giving up a little bit of the ground that we had seen earlier in trade. A lot of young people aren't very confident in their money knowledge and avoid risk, according to a Wallet Hub survey. 57% of Gen Z think savings accounts are the best way to invest their money. Here with some tips to get Gen Z interested in investing. We've got Ashley Fox. She is the CEO of Amplify. Great to have you back in studio with us. And so, how can we make sure that the future generations are confident about their investing strategy, and where can they potentially start to put toe in the water or put some skin in the game?
So when I think about investing and building wealth, you cannot save or work your way to wealth. So we have to start investing. When we think about our buying power and spending our money, these companies are getting bigger and bigger and bigger. What if we start to own a piece of these companies? And as the Gen Z population continues to go into the workforce, spending their money is only going to make the economy grow, but how can we build our wealth with it? So opening brokerage accounts. Yes, saving is great, but what about when they get older? What about when they're thinking about retirement? What if we start retiring early and we have our money working for us? So it is extremely important that we are not just relying on savings accounts, we are also investing in the stock market.
And so what are you seeing in terms of Gen Z and how they're doing their own investment strategy planning? Where are they performing well, and where are some of the pitfalls that you're noticing as well?
I'm noticing a lot of Gen Zers are really good at attempting to make money. Okay. Right? They're finding different ways to make money, whether it's online in different ways.
That's not a bad thing.
No, I love it. I love it. But what else?
Yes.
Right? We're putting in the effort, we're putting in the time, we're putting in the energy. How are we putting our money to work? And if we think about the school system, we're not taught how to invest. We're not taught how to manage our money. We're not taught how to understand credit cards. So we're good at taking out debt. We're good at shopping. We're good at creating content. But what about investing and building that wealth so that we can create passive income? What about dividend investing, right? What about growth stock investing so that that money, while we're working for it, it can also work for us while we are sleeping?
What are the top strategies that anyone can be putting into effect with the last few weeks of the year to set themselves up even before that New Year's resolution when it comes to their investing and saving strategies?
The first thing I would say, you have to get a brokerage account.
Okay.
Because having a savings account, having a checking account, we're good at that. We have to start setting money aside automatically. So the first thing I would say, open the brokerage account and pick a small amount of money every 2 weeks that you can set aside. Nothing too big that forces you to feel like you're about to overdraw your account, but something that can be set aside consistently and automatically so that you're comfortable and confident. I always tell people at Amplify, the people that we're working with, you can start with $20, right? There are brokerage accounts now that allow you to buy fractional shares. What if we $20 our way to $1 million? What if we don't have to work until we're 50, 60, 70 years old, but we're building now while we're young, we're starting small, and it's compounding over time. So I would say get the brokerage account open, set small amounts aside automatically so it happens without you even thinking about it, but also build a strategy. Think about at the end of 2025, what do you want life to look like? What kind of money do you want to have coming in? How big do you want your portfolio? How much passive income do you want to have coming in? And start moving with intention. And every single quarter in 2025, increase that automatic deposit just a little bit so that you can train your mind to grow as you grow as a person.
I want to marry two different segments together here. And we were talking earlier with Glassdoor senior economists just about what they're noticing within the mindset of the workforce and where there could be a trend that takes place in 2025 of revenge quitting because there isn't the upward career trajectory. But I'm going to take the other side of that. Say you finally come into that promotion. Say you finally are able to say, all right, I'm getting a new raise. What is your mindset that you need to take on the second some of those things start to fall in line?
So if I'm being honest, I know just whether you are a Gen Z or baby boomer, anyone, when you make more money, you create a way to spend it, which is fine. Acknowledge the fact that you want to spend money on other
like
things.
A book, yeah.
So acknowledge that.
Yeah.
But also understand to sustain that lifestyle, to always be able to put yourself in a position to get the things that you want, you also have to set money aside. So that at some point, when you don't have that promotion, at some point where you choose to leave that job, you have accumulated wealth that has been set aside, that has been grown, because it's great to work. It's great to build a business, right? But what about when you don't want to anymore? What about when you want to travel, when you want to do things? What if you don't have to utilize your physical energy to be able to do the things you want to financially? So as you make more, you invest more and pay yourself first, because even though we like to spend, we're giving that money to some other company, to some other individual that is making their money, fine, but what about you?
Yeah.
Because you're going to decrease your net worth every time you spend. So what if we spend and invest? I always say it's not this or that, it's this and that.
We got a little bit of time left here. I'm going to throw you one more, and we didn't talk about this in advance at all, so I trust that you've got so many strategies here. We're in peak spending season, basically.
Yes, we are.
How can people make sure that they're spending smart, even as they are going out, balling on a budget perhaps, and making sure that they check off everyone on the list?
So I always say, start considering to own stock and who you give your money to. So inside of our Wealth Builders Community app, our membership-based platform at Amplify, we have a I Own It challenge, where we are investing in the companies that we're spending our money with. So start thinking about parents, where your children, what they want for Christmas, what do they want for the holidays. So I have like a 7-year-old niece. She loves Roblox. She loves YouTube. She loves Target. What if we take a second and find out, well, how much does it cost to own stock in Target, to receive a dividend from Target, to invest in Google? So take into consideration that, yes, we're going to spend money for our children and for our families, but what if we give the gift of wealth? What if we buy them the gift, but also buy them a share at the same time? And really challenge yourself during a time where the entire world is spending money. Let's look at earnings at the top of Q1 2025. Think about all the money these companies are going to make. And what if they grow because you spent money, but you grow with them because you spent money, but because you also invest? So it's, again, doing both. Just, you have to train your mind to become a wealth builder, to operate in that capacity. And yes, we're going to spend. But we are not going to make these billion-dollar businesses even richer and not get a piece of the pie.
Ashley, thanks so much for joining us in
Thank you.
studio. Excellent
Thank you.
advice as always. From album sales to book sales, Taylor Swift is the ultimate chart topper. The music superstar self-published the Eras Tour book, sold over 800,000 copies in its first week, according to Circana BookScan, making it one of the best-selling nonfiction book debuts ever. Target is expected to get a boost from the book's success as the exclusive seller, and they've set their hopes high, producing 2 million copies for the first print run. That's according to the Wall Street Journal. So, if you're looking for a gift for the Swifties in your life for just $39.99, you could get them this 256-page work, which includes more than 500 images of their favorite pop star. programming note in this week's episode of The Money Glow Up. Host Tiffany Alshay speaks to Michael Learsh, who's the head of advice and planning for wealth and investment management at Wells Fargo. Learsh offers insight for managing financial stress, budgeting, and why people so often find themselves financially strapped during the holidays.
So when you think about holiday and stress, I do want to normalize it again, Tiffany. So it is normal. The easiest way, though, to tackle it is to talk to other people.
Okay.
And talk to other people you trust and come up with ideas together.
Okay.
So I just want to highlight that accountability partner, that conversation, being open and honest. In the United States, we have done so many studies. It's just so hard for people to talk about money and finances and financial stress. It's really not great for anyone in the U.S. So let's open the conversation like you're doing, and that's why I admire you so much,
Thank
Tiffany.
you.
And you can catch Money Glow Up every Thursday, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. A new survey from CNET shows 66% of U.S. adults are concerned about falling victim to scams this holiday season. And more than 7 in 10 respondents have already taken actions in the past year that security experts deem dangerous. You've probably seen headlines about data breaches over the years, either via online or little notice in the mail saying your personal information may have been compromised. And one of the best things that you can do in that case is freeze your credit, which restricts access to your credit report and can prevent bad actors from spending money on your dime, opening a new credit card in your name, or applying for a loan, et cetera, et cetera. This CNET survey reveals only 27% of U.S. adults said they froze their credit following a breach. To freeze your credit, you can contact each of the 3 major credit reporting agencies, Equifax, Experian, and TransUnion, or do it online through their sites or apps. CNET also found 41% of adults are using the same password across multiple accounts within the past year. We're still doing that? That can be a big no-no. But as people shop this holiday season, they are taking action to protect themselves. 84% are taking some sort of action, with 48% buying products only from reputable sites. 37% strengthening their password hygiene. Side note, that's your cue to get rid of your mom's 0000 passcode. And 31% are checking the website's security before making a purchase. So, save this video to keep safe from scams this holiday season. Let's do a final check of the markets as we are just about a few minutes away from noon Eastern Time. We're mixed as of right now. The Dow and the S&P 500 in negative territory. The NASDAQ flat, just barely to the upside. And that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.
Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lifton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There's a number of different valuation models that have the price of Bitcoin at between 111 and 150 this year, so within the next couple of weeks. And then the stock to flow model has Bitcoin at over 800K by the end of next year, at the end of 2025. But we are just starting to see just the implications of having a pro-crypto administration, Congress, SEC, regulatory heads, and getting all that cleared up is having a huge impact on bringing these markets back.
Something like the Department of Government Efficiency, a sort of massive government reform effort, is desperately needed, right? It is something that is long overdue. There's an endless number of lists of things where government performance is just not where it should be. But the approach that they're talking about taking is sort of so profoundly mismatched to the needs of what the government actually has that it's hard to see how this effort is going to be helpful.
Well, the inflation numbers definitely are something that if they're really out of whack, I think that's going to be something that people are going to look at, right? And then the Fed's going to decide, what to do, if they're going to do another 25 or not. Either way, it's not going to move the needle. The markets are trading up. The Trump trade is on.
We got 1 hour to go until the market closes. We're taking a look at the major averages. It feels like we're playing a little bit of a waiting game. We've had a bunch of jobs data this week, but obviously the biggie is going to be tomorrow morning with the non-farm payrolls report. And so we've got stocks kind of fading into that here. The Dow off by 185 points right now, 0.4%. The S&P 500 down about 0.1%, but you can see a lot of fluctuations throughout the day. And the NASDAQ, little change as well. But again, a lot of volatility in kind of a narrow range today.
Yeah, listen, not a ton of fireworks. You are, of course, hanging out right on near all-time highs,
Yes.
given the relentless move higher we have seen. I think, Julie, you're right. I think some of this wait and see. You do have key jobs data coming tomorrow. The narrative has been, from any number of economists we've spoken to and strategists, that the labor market, you get that kind of cooling, not crashing theme we've been hearing about. So you're waiting to see whether tomorrow reaffirms that theme, and of course, what our Fed officials make of what they see tomorrow morning as well.
Yeah, and just taking a look at the bond market as well, not really any change that we've seen there today. If you look at the 5-day move, it's also very little changed here as people try to figure out what the Fed is going to do. Within the stock market today, some big moves on the sector level, both up and down. Materials down a lot, healthcare down, industrials down, but consumer discretionary higher. So that's kind of the split that's leading us. Also sparking our interest, some of the meme stocks, and that's because our old friend, Roaring Kitty, tweeted something today.
Yeah, back in the news.
And so, cryptic as usual, but you saw the move in GameStop after that tweet.
But really all the discussion. We've got to talk let's talk Bitcoin.
All right,
let's talk crypto.
Where's my crypto here? Here it is. Here are the cryptos today with Bitcoin moving up 1.8%. Pairing some of the advance here, it looks like we're actually down below 100,000 again, but still got up as high as 103,000 late last night, early into this morning.
I feel like we might have the perfect guest to elaborate on this very topic.
Yes, indeed. Bitcoin indeed topped 100,000 for the first time ever. The cryptocurrency on that record-breaking run since President-elect Donald Trump's victory. Joining us now, Michael Saylor, Executive Chairman of MicroStrategy. Of course, MicroStrategy now one of the largest Bitcoin holders with just over 402,000 of the coins. I don't know if you want to do a little dance, Michael, if you've got some champagne behind you, but obviously we've been talking to you for a while now, and you have been a staunch bull on Bitcoin. You put your money where your mouth is in terms of adding it to the balance sheet over there at MicroStrategy. I guess, now that we've gotten there, now what? What's next?
Every day for the past 4 years, I've said, buy Bitcoin, don't sell the Bitcoin. I'm going to be buying more Bitcoin. I'm going to be buying Bitcoin at the top forever. I joked with Dave Portnoy today. He said, I missed it at 10,000, I missed it at 20,000, I missed it at 100,000. I said, Dave, it's still less than $1 million a coin. You're getting a 90% discount from $1 million a coin. I'm sure that I will be buying Bitcoin at $1 million a coin, probably $1 billion a day of Bitcoin at $1 million a coin. And so I think it's a very simple idea. Just keep buying Bitcoin with your spare capital. It's going to appreciate against the dollar forever.
So, Michael, so if I don't own Bitcoin, though, and I'm listening to this, your advice is buy here or no, wait for a pullback? And then when I do buy, Michael, your advice to folks who are listening about how to do that, what do they buy? You know, do they dollar cost average into Bitcoin? What's your advice?
I think you should think of Bitcoin as a long-term capital asset. So if you have money you don't need for 4 years, or even better yet, for 10 years, you put it into a portfolio. You might hold scarce desirable real estate. You might hold your favorite artwork. You might hold some portfolio of companies you're going to hold forever. I think a part of that is Bitcoin. So I say dollar cost average into Bitcoin every quarter, sweep some long-term savings into Bitcoin, expect to keep it there for a decade or longer, and don't get too worked up over the volatility in the near term.
Well, and Michael, you know, you kind of alluded to this, that you don't try and time the market here. You're just going to, the strategy through MicroStrategy is to just keep buying consistently, regularly, no matter what the price is.
Yeah, I mean, I look at it like Manhattan real estate. The year is 1650, and if you had a chance to buy it in every decade from 1650 to today, wouldn't you just keep buying it? If you didn't have to pay property tax and you could hold it, you would just keep accumulating it forever. There's never a bad time to buy it. There's a Sailor tracker. You can look at it. It just shows we bought at every price point every quarter, at the highs, at the lows, at the mids. I bought it every week for the past 4 weeks in a size billion or more. I'm going to just keep buying it. And it's not that complicated. I expect that it'll be the most valuable thing in the world 100 years from now, so why wouldn't you just keep accumulating it?
Michael, we've talked a little bit about this before, so I want to just re-up the question before we move on. When you've likened it to Manhattan real estate. Manhattan real estate, you collect rent on it, right? So at some point, do you somehow, you know, monetize the Bitcoin that you hold in some way?
Yeah, well, imagine I gave you the chance to buy 40 city blocks of Manhattan real estate 100 years ago, but there were no buildings on it and there was no rent associated with it. But you knew it was going to be the greatest city in North America, and you could buy it and hold it. It's, you know, you would still do it, just like you might buy Alaska in 1867, even though there's no rent on it, because you think that over the next 100 years, someone else will find a way to take advantage of it. With Bitcoin, it's cyber Manhattan. There's 8 billion people that have money. They're not going to live there, but they're going to put their money there because everybody has to park their money somewhere. And so you're just buying one block out of 21 million of all the capital in the world. It'll be the center of the digital economy. You may not know the applications, but there are applications. MicroStrategy makes a lot of money by holding that digital property. We're generating massive amounts of shareholder value from that. So you don't have to understand how we do it. You just need to hold your Bitcoin and let us drive the price up.
And Michael, obviously the move since the election has been powerful. Trump is moving back into the White House. He clearly positioned himself, you know, as an ally of Bitcoin, an ally of crypto. What would you like to see, Michael, his priorities be now, his policy priorities?
Well, I mean, I think low regulation, low tax, pro-innovation policies give people, specifically with regard to digital assets, if we have a digital assets framework that supports digital commodities, digital securities, digital tokens, digital ABTs, digital currencies, digital NFTs, so that people can innovate in the United States of America and spread those assets everywhere in the world, I think that'll be good for the world and good for the United States.
Michael, I'm curious because we've talked to some of your peers in the crypto industry who have talked about maybe some of the friction at times that they have felt when they've been trying to buy crypto assets under the existing regime, under Gary Gensler at the SEC, for example.
You guys have obviously accumulated an awful lot of Bitcoin at MicroStrategy. Has there ever been that kind of friction? Have you seen those regulatory obstacles to what you've been doing?
Well, I think Bitcoin is the one digital asset that has the most regulatory clarity in the world because there's general universal consensus that it's a digital commodity. The friction on Bitcoin has been slow approval of the ETFs, the inability to do cash create and redemption, the slow approval of the options market on the ETFs, and resistance to banks custodying and handling Bitcoin. So that's held back the asset class. I think that a favorable crypto regime will accelerate the development of Bitcoin. And I think on the digital asset side, right, just the lack of a digital assets framework for digital currencies and digital exchanges and digital tokens has put that industry in limbo. And I think we're looking for those things to be resolved with the incoming administration, and that should accelerate growth for everybody.
And Michael, this week on the show, we did speak to Senator Kirsten Gillibrand. And I asked her, Michael, specifically about this idea of a Bitcoin strategic reserve. Listen to her response here.
I don't know what the purpose of a Bitcoin central reserve is, and I haven't really seen the details of any idea about why you would do that and why that's important. I think it would have an obvious impact of supporting the Bitcoin industry, which in and of itself isn't good or bad. I just would want to know what the reason is.
All right, Michael, so the senator not sure about the reason for it. What do you say to that? What's your response?
Bitcoin is emerging as the world's reserve capital network. If you want to store your capital for the long term and you live in Africa or Russia or China or South America or even the US, your choice is local real estate or local stocks or Bitcoin. Well, people are realizing that Bitcoin is better than real estate. It's better than stocks. There's not a single company or real estate property in Africa that you would rather own for the long term than Bitcoin. So the very simple idea is buy 20 or 25% of the Bitcoin network on behalf of the U.S. government, catalyze the development of that world reserve capital network, and then let all the Chinese and the Russians and the foreigners sell all their other assets and buy Bitcoin, and then the money flows into the United States. If you want to put a great twist on it, dump your gold, sell all the U.S. gold, buy Bitcoin, then the trade is free because you could buy 5 million Bitcoin for the cost of the gold. You will demonetize the entire gold asset class, and our enemies hold gold in their banks, so their assets would go to zero. Our assets would go to $100 trillion, and we would control the world's reserve capital network as well as the world's reserve currency network.
As usual, you're painting a grand and vivid picture, Michael, with this kind of stuff. I know your long-term price targets are sort of almost infinite. Let's talk shorter term, and let's assume that the Bitcoin reserve doesn't happen, right? Let's assume that conditions continue as they are. Where do you see Bitcoin at the end of 2025?
You know, I don't chart it month by month, but I noticed that it's been a 60% ARR for the past 4 years and even before that point. And my model is generally that it will grow at 60% ARR, decelerating to 20% ARR over 21 years. So if you start to crank in 60%, then 58, then 56, then 54, you know, and you put that on a scale, absent the cyclical volatility, you get to a forecast which makes sense.
Michael, quick question on that cyclical volatility, right? Because typically Bitcoin does move in these 4-year cycles, and there is a sharp pullback typically. Is that anywhere in sight, and what would be a potential catalyst for that?
I think as the asset grows and matures, the volatility decreases, and those the extremes of the drawdown decrease. The structure of the market determines the volatility, and so if you're going to forecast the structure of the market, you can't look backwards. It's like if you looked at a bicycle 4 years ago, and I show up with a motorcycle right now, it's a different set of physics. The market right now is driven by the ETFs, driven by the options market, driven by companies like MicroStrategy, driven by the global adoption. So I think what you'll see is you will still see volatility, but you won't see the extreme drawdowns of the last cycle. You'll see a more gentle volatility. It'll surge up, it'll come back, but I don't expect like we saw an 80% drawdown in the depth of the crypto winter from 66,000 to 16,000. In order for that to happen, you had to have a bunch of very poorly capitalized companies like FTX and Genesis and Celsius and BlockFi force liquidate. We don't have those kind of companies in the system now. The capital structures of the companies participating in the market today are much deeper, much more robust, and there's a lot more equity capital today. So you'll see a different dynamic. I think it'll be muted to the upside and the downside because of the options traders that are moderating the market.
Michael, great to see you. Thank you so much for joining us, especially today on seeing this milestone in Bitcoin. Appreciate it.
Yeah, thanks for having me.
We're just getting started here on Market Domination. Coming up, Doge is taking over Capitol Hill, not the cryptocurrency. We're talking about the Department of Governmental Efficiency. It's trying to take over Capitol Hill, at least. We're going to get an update from D.C. later in the hour. Elon Musk and Vivek Ramaswamy are meeting with lawmakers today in an effort to gain support for their cost-cutting initiative. Stick around, much more Market Domination still to come.
Stocks hitting a pause on the rally today as the November jobs report now looms. For more on the latest moves, let's welcome in Eric Friedman, U.S. Bank Asset Management Group Chief Investment Officer. Eric, it is good to see you. So your bottom line here, Eric, is you say, glass half full, right? Favor equities. You know, it's interesting, Aaron. At this point, I don't remember the last time I spoke to a strategist who wasn't glass half full and favored equities. I mean, it is just bulled up across the board. I wonder whether, you know, that's a source of concern at all for viewers who are listening right now.
Yeah, Josh, it's a great point. I mean, we certainly don't want to be on the same side of the boat as everybody else, but the setup, if you will, from both monetary policy as well as the earnings cycle, we think are positives. Clearly, fiscal is an open question, but this is still an environment where this is a market that has to be proven wrong, if you will. And if you look at what we've just come out of in terms of earnings, it's been both top line and bottom line. Last thing I'll say is this. The swing factor we think it's really out there is what happens with the consumer. There's going to be obviously a lot of activity and chatter heading into the retail sales prints of the holiday season. What's going to be very important is what do consumers feel like in the first quarter of next year. So we're still glass half full, not just in stocks. We also think that there's an opportunity in credit, not corporate credit, but really more structured credit, which is, again, a mouthful. But we still think this is a time to add income and add risk to portfolios until proven otherwise.
Eric, on the consumer, what kind of tea leaves are you looking at that's helping you, kind of feel that glass half full feeling about the consumer going into early 2025?
And Julie, I think the biggest thing is the marriage of top down and bottom up. What I mean by top down is not just survey data, like we got to get great information tomorrow with the non-farm payroll data, which of course has a huge standard error, so we can't be too focused on it. But the top-down macro data is always helpful to see just what are consumers thinking from a survey basis or just from jobless claims or the employment picture. But probably the most important variable we're paying attention to is bottoms-up corporate earnings. And so hearing from a wide swath of retailers as well as both, big box as well as e-commerce entities to understand where is that marginal dollar going. And what we're starting to see is that continued bifurcation between lower income and higher income consumers. That's been well documented. It's not new news. But what's most important is understanding through corporate outlooks, what is that middle income consumer doing post the holiday season? Lots of noise through the holiday season, but we think it's really more important to pay attention to corporate outlooks and going to investor days and listening to outlook calls. That to us is probably the most important variable, which is tough to do. Unfortunately, we have a big team to do it.
Eric, on the equity market, even bulls come on the show, and if you ask them what concerns them, they'll, some of them at least will say they don't really love what they see when it comes to valuations here. I know it's a bad timing tool, but I'm curious how you're thinking about it.
Yeah, I think it is, Josh, important to look at valuation, and the way we look at it is through a couple different lenses, but I do think that in this backdrop of falling front end of the curve activity, which we again still think will be the case, we do think that Chair Powell's comments yesterday in New York were certainly well measured. Some may say a touch hawkish, but we still think the bias is for the Fed and also other central banks beyond the Fed to keep lowering interest rates. That's obviously something that makes earnings more valuable. So that's kind of the first point that we'd make is that yes, we're seeing on sort of traditional PE basis or price to sales or the Shiller PE, yes, there are certainly metrics that look a little bit elevated. However, interest rates are coming down at the front of the curve, which makes earnings more valuable. I think the other thing to pay attention to is that dispersion across sectors, which has been more constructive. Last year, if you didn't own domestic tech, you didn't do very well in your portfolio. This year, there's been a lot of broad participation, which is a good thing. So in a way, having that backdrop of still improving earnings trends, really the growth rate expected for next year is too aspirational. In the context of lower interest rates, we think that's a good setup for risk assets, particularly domestic equity still.
What about the DC setup, the policy setup going into next year? Obviously, there has been a lot of attention on what can happen with taxes, what can happen with tariffs. How are you factoring all of that in?
Yeah, I think it's an important list to go through. We kind of center on three areas. One is deregulation. The second would be taxes, and the third would be tariffs and trade policy. So we think deregulation, as a general statement, that's bullish for risk assets. We again understand that with, and I think it's a great segment you'll have on later about what the Department of Government Efficiency can actually do. There's a lot of things that have to still go through Congress. And again, our Washington team is really focused on the actual output that can be gained. But net, we think this is still an overall positive backdrop with deregulation and those deregulatory policies coming through. The second is on taxes. Again, I think there's a lot of expectation from the market, at least, and the immediacy of the Republican sweep, that there would be a quick resolution to the TGCA. We think that's probably going to be a little bit, distant in sometime later next year as opposed to the front end. So tax policy, investors should probably be a little more patient on than expecting that'll be an early congressional agenda item. I think the last piece is on trade and tariffs. And again, we think about this in terms of what's going to happen with China will be very different from what happens with the rest of the world. Also, to really point out that while everybody is very focused about how the U.S. acts, there's two parties in a negotiation. Of course, there's a reaction function from those other countries as well. So we do think that on balance, if you put all those things on the scale, that the policy set will be more earnings and equity friendly, but we have to, again, be somewhat reactive to what the news flow looks like. And again, most of that news flow will happen more in January and early Feb as opposed to right now. So again, we're still glass half full, still of the mindset that most policies will be pro-growth, but again, we'll certainly have some more details as we get deeper into the administration's inauguration in January.
Eric, always great to see you and have you on the show. Thanks for joining us.
Thanks for having me. Take care.
Coming up, shares of Synopsys lower today on the back of their latest earnings report. We're going to be joined by the company's CEO on the other side to break down the quarter. Stick around. Much more market domination still to come.
Now, time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most viewed stocks of the session on Yahoo Finance's trending tickers page. First up, a look at shares of Uber and Lyft as Alphabet-owned Waymo says it's expanding to a new city, Miami. The company aims to have the robotaxi service available to riders in 2026. We know now it is in places like Los Angeles. Now, you can't trade Waymo directly, of course. It's owned by Alphabet, but you know, you can see the effect in its potential competitors that aren't even actual competitors right now.
Yeah, it's interesting because I know some analysts argue that, at least with Uber, you know, and these are folks who have buys on that name, they actually consider Uber to be a winner long-term in the AV arms race because they think AV companies long-term are going to want to partner with Dara Khosrowshahi's company.
Right.
They're going to like the scale, they're going to like the brand. We'll see.
So we'll see, but investors right now are selling.
All right, turning to shares of another name here, Brown-Forman, the Jack Daniels maker, of course, topping second quarter estimates, reaffirming its full-year growth outlook. Biggest intraday jump I was reading here in 4 years. Among other brands, Jack Daniels forecasts a return to growth this fiscal year. CEO saying we continue to expect a performance to accelerate through the second half of the year, and investors like the sound of that.
Yeah, big reassuring report here. The shares are down about 20% year to date, even including today's gains. And people have not been drinking as much whiskey. Brown liquor's been, I know you're doing your part, Josh, but
sure am. But that was part of the
decline, right?
Part of the. I know there's some on the street who cover them were saying part of what you saw here was maybe kind of a sigh of relief that okay, American whiskey isn't in total free fall.
Right, exactly. Bill Chappell over at Truist making some comments like that. So that seems to be what's going on here.
Good news for the brown liquor.
Yes, indeed. All right. On Wednesday, chip design software firm Synopsys reported its fourth quarter earnings. And while the company did beat on earnings and revenue, shares are sliding after the forecast for fiscal 2025 revenue came in below Wall Street expectations. There was a slump in China sales as the U.S. tightens controls on what chip technology can be sold to that country. Joining us more to drill down more into this and talk more about the outlook is Sassine Ghazi, Synopsys CEO, who is back with us. Sassine, it's good to see you here. Obviously, there is a lot going on in your world in terms of the expansion of the demand for AI, your role in that. But, you know, it doesn't sound like it's going to be up and to the right in a smooth and straight line for almost anyone. So talk us through what you are seeing currently and what you expect in 2025.
Hey, Julie, good to be here. Yeah, if you look at Synopsys' performance over the last 5 years, it has definitely been up to the right with a 15% CAGR growth during that period. We doubled the size of the company during that period due to an AI inflection point and significant investments by our customers to build silicon for the data center to satisfy that opportunity.
So, seeing some analysts who cover the company, and I want to get your thoughts on that. They looked over your the report in the end markets, and they said, you know, Sassine's company there, AI data center seems strong, but they said, you know, slowing PC, smartphone, auto demand. Walk us through what you're seeing.
So I like to describe it as we sell and operate in a tale of two markets. There is the AI infrastructure, and every company that is building semiconductor or any solutions for the AI infrastructure is booming, and we're doing fantastic with that boom. Then there is the other cohort, which is the rest of the semiconductor industry that's selling to mobile, to PC, industrial, automotive, that they're at a different point in time when it comes to their recovery. Some of them, they're still at the bottom. They have not turned. And other, they're trying to bring in an AI refresh cycle into their product, like AI on PC or AI on mobile, which is, again, a good opportunity, but it's behind, definitely behind the AI infrastructure investment and build-out.
Sassine, let's talk about China a little bit, because there are two tracks of what's going on there as well, right? First of all, you have the macroeconomic backdrop there, which has not been improving as quickly as many investors wanted it to. And then, of course, there's the political backdrop and the export controls that already exist and the threat that there may potentially be more. So how are you managing around that, and what do you expect for China?
So China is absolutely, from a growth point of view, has been decelerating. If I look at our business 3+ years ago, the number of startups, the money that was being injected in the market was significant. That has changed over the last couple of years. Our growth in China used to be in the mid-20s. Over the last couple of years, it's been at around the corporate average, and we anticipate that to continue right around at or slightly below or slightly above. Now, so that's the one factor in terms of the China economy. The other factor is the trade and restrictions between the US and China, which absolutely have an impact. Pretty much every quarter, we get new customers added to the entity list. That's revenue that disappears off our backlog, as well as technology restrictions. Even customers that they're not on the entity list, however, they cannot design competitive chip due to restrictions. And these factors do have an impact on our business in China.
So, Sassine, I saw some analysts commenting that Intel, a meaningful customer of yours, they pointed out, obviously it's a company in transition, parting ways with its CEO. How are you navigating that dynamic, Sassine?
So we have a fairly resilient business model. Our agreements are multi-year committed agreements, and that's the beauty of our business. We have about 70% of our business is ratable, and about 30% of it what we call upfront. Now, the upfront portion in general is lumpy, and the reason it's lumpy is based on our customer need on when to use that technology, in particular IP and hardware, based on their roadmap. With Intel is no different. We anticipate with Intel in the short to midterm there will be no impact. However, that lumpiness, the same as we see with the rest of the portfolio, will apply to Intel.
Sassine, great to see you. Thank you so much for joining us.
Thank you, Julie. Take care.
Coming up, Doge is taking over Capitol Hill. We'll get an update from D.C. on the other side as Elon Musk and Vivek Ramaswamy are meeting with lawmakers today. Plus, we'll be joined by Skybridge founder Anthony Scaramucci to talk about what potential risks could lie ahead for Bitcoin after surpassing the $100,000 mark. Stick around, we've got more market domination still to come. Tesla moving higher today on the back of bullish comments from Bank of America Securities. That's after a visit by the analyst to the Austin Gigafactory. And lead analyst John Murphy writing in a note, the trip gave us increased confidence that Tesla is well positioned to grow in 2025 and beyond with its core EV business and launch of its robotaxi offering and longer-term profits from its investment in Optimus. Murphy reiterated his buy rating for Tesla, upped his price target to $400 from $350. You know, I was saying earlier, Josh, it's kind of interesting that Tesla's moving higher today, but Uber and Lyft are moving lower on that Waymo news because Tesla, of course, is developing autonomous vehicles.
And of course, remember, I mean, it seems like forever ago, but early October when Tesla had its big robo-taxi launch, some investors on the street clearly saw that as underwhelming, and Uber and Lyft actually popped on that. Remember, we talked about it.
There are Waymos on the road already.
This call is interesting. Basically, the analyst goes down to Texas and gets the full tour, meets with IR, gets the tour, has a drive session, and leaves the analyst saying, I mean, obviously they liked what they saw and heard because they talk about increased confidence in Tesla's growth, positioned to grow that core EV business, launch that robo-taxi service. So they reiterate the buy and do take their target up to 400.
Yeah, I also saw Optimus, I guess.
Yes, robots.
The Tesla robot learning how to catch a tennis ball. I don't know then what the next use case is
Evolving.
for. If you want to play catch, if you're alone and you have no one to play catch with.
Soon it'll do this job.
Get yourself a robot.
Robots.
All right, speaking of Elon Musk, he and Vivek Ramaswamy bringing the vision for President-elect Trump's Department of Government Efficiency to Capitol Hill. The Doge co-leaders discussing with lawmakers about the cost-cutting initiative. Here with more, Yahoo Finance's Ben Worschel, who is on the Hill. So what are you seeing? What are you hearing about what these guys are talking about?
It's the real circuits here, Julie. It's so it's the long-awaited Doge Day. The long-awaited Doge Day here on Capitol Hill. Elon Musk and Vivek Ramaswamy are meeting right now with senators and House members on the Republican side, and this is kind of a cap of a whole series of meetings they've had today, all across Capitol Hill. One I would take note of is appropriators, who are actually the ones in charge of government spending, and so they kind of have to figure out exactly what Doge is, how it fits in here in Washington. So it's the start of what's going to be a long process. A couple little anecdotes for you. Musk was kind of going between meetings today, and it comes as he's sort of still been coy about exactly what Doge aims to do. What is the kind of overall goals? Is it about cost cutting? Is it about regulations cutting? All these things. At one point, a reporter yelled out, "What is Doge?" to him. All he did was smile and keep walking. At another point, they asked, "Do you want Democrats involved?" And he said yes. So we have a little bit of that to go on, and there is some Democratic interest here. But this is the kind of first step of what's going to be a long process up to and through President Trump's inauguration, where what Doge, this idea of Doge from the campaign and from kind of Twitter or from X, kind of goes to a reality of here in Washington of what it could actually be.
All right, as you said, Ben, first step of a long process. We'll stick with it. Thank you.
Yeah. Thanks much.
Well, Bitcoin hitting a milestone, surpassing 100,000 for the first time. For more on what is next for the cryptocurrency, we're now bringing in Anthony Scaramucci, founder of Skybridge. Anthony, always great to see you and have you on the show. So Bitcoin does enjoy this big moment, 100,000. As a believer, Anthony, walk us through just this milestone, what you make of it, why is it important? And maybe also, Anthony, it feels like a good time to take a breath and tell viewers how you think about possible risks for Bitcoin ahead as well.
Well, listen, Bitcoin is a volatile asset, so it peaked at about 103,700. It's already backed off 5%. So Bitcoin is the type of asset I always tell people, if you're going to buy Bitcoin, you got to hold it for a 4-year period of time. Any rolling 4-year period, you do well, but at any given moment, you've had big drawdowns. And Bitcoin has drawn down. I think its most recent and most terrible drawdown was 82%. And so if you were interviewing me, Josh, in December of 2022, I was having a very rough time. I think Bitcoin was 16 or 17,000. And a lot of people thought that we had made a bad investment in Bitcoin. And so we were dunces 2 years ago, we're geniuses today. So I would just caution people not to put too much money into Bitcoin in the sense that they've got to be careful about its volatility. Now, if you're somebody like me, I have a lot of my personal net worth in Bitcoin because I'm not looking at it and not tracking it day to day. But this milestone is important because I think it tells people that Bitcoin's probably ready now for prime time institutional investing. And frankly, this milestone should have happened 2+ years ago when the futures ETF was approved in November of 21. It would have been appropriate to have approved the cash or spot Bitcoin ETF right after that. But Gary Gensler decided not to do that. He went on to lose a lawsuit resulting in the success of the January BlackRock, Fidelity, and others Bitcoin ETF. But this should have happened a couple of years ago, frankly, but for the regulation.
Hey, Anthony, it's Julie here. We just talked earlier in the hour to Michael Saylor, who, as you know, is sitting pretty on top of a pretty substantial mountain of Bitcoin at this point. And we talked to him about those 4-year cycles as well. Another guy who watches crypto closely, Gautam Chugani over at Bernstein, is looking at potential 250,000 by the end of next year and looking at those 4-year cycles. But do you think that the cycles will be more muted? In other words, do you think we could see another 80% drawdown, or do you think those kinds of declines are in the past?
Well, first of all, Julie, it's good to see you. I've been humbled by life in markets, so I will tell you that anything is possible. I do think, however, that there's a floor of support for Bitcoin now. With the approval of these cash ETFs and with legions of Wall Street people out there selling the idea of having Bitcoin in your portfolio, I do think that there is a floor of support. That's not to say that there won't be aggressive corrections in Bitcoin. But if you believe, like I do, and Michael Saylor believes, that this is an asset class, it just isn't another investment story like a stock, but it's actually an asset class, then Bitcoin should trade to the market capitalization of gold, which is roughly 10x where Bitcoin is today. And so if you don't mind, I'll just quickly, I wrote a book with Michael called The Little Book of Bitcoin. It's out today.
That's what we call a shameless plug, Anthony.
A shameless plug.
We'll allow it.
All right, but Michael said something to me, that I think you'll enjoy. He said, you wrote a great book, and I'm willing to endorse it, but you are too small in your asset allocation recommendation. What do you mean, Michael? I said, I'm telling people to own 2%. And of course, Michael has 100+% of his net worth in Bitcoin. And the point being is that if this is your best idea, and it clearly is my best idea, I probably don't have 50 other ideas like this. And so I do think people should own Bitcoin and have it in their portfolios.
Anthony, I also want to get your take. Trump's pick to lead the SEC, Paul Atkins, as a crypto investor, what do you think of that pick? Do you like it, Anthony?
Yeah, I do like it. I know Paul a long time. He's a libertarian by nature. There's a picture of him actually in 2016. He was up for the SEC commissionership back then. Just to remind people, I was on President Trump's presidential transition team 8 years ago, and we interviewed Paul and Jay Clayton and many others. He's a terrific person. Believe it or not, he's liked on the left and the right. So, of course, there are Gensler enthusiasts that hate Bitcoin. My former high school friend John Stark is one of those. He likes Paul Atkins. And so you've got pro-Bitcoiners and anti-Bitcoiners that like him. I think he's a very fair guy, and I think he'll do an amazing job for the president and for the country.
Yeah, indeed. We talked to Sheila Berry yesterday. We talked to Kirsten Gillibrand, both of them saying they like that Atkins pick, which was interesting. Do you think that once Donald Trump takes office again, things sort of immediately get better on a regulatory basis for the crypto industry? I mean, there's been all this complaining about so-called debanking or at least friction within the system by people who are in the business.
So that's a great question. Unfortunately, I have some education in Washington, and of course, I learned the hard way. I got myself fired after 11 days in the first Trump administration. Things happen way more slowly, and they happen in a way more complicated way. And so I would just caution people, if you think on January 20th, a switch is going to flip and everything's going to be better and roses for Bitcoin and the digital asset community, it's just not how Washington works. It will get better. They certainly, I think, will deal with what you're talking about, which is this choke point 2.0, where people have been unbanked. I think there's been some unfairness to that. I think that will get repaired. There'll be more positive clarity on legislation. You mentioned Senator Gillibrand. I'm one of her supporters. I'm also close to Senator Schumer. I think these guys want a bipartisan stablecoin bill and more clarity on how Bitcoin and other cryptocurrencies are regulated. And so I think that stuff will happen in this Congress, okay, over the next 2 years. So for me, I'm positive, but I don't think these things happen immediately, Julie, and I want to caution people about that.
And do you think that there's any risk that the pendulum goes too far in the pro-crypto direction, and that, you know, there's any risk of retail investors getting hurt by if there are too few, you know, curbs put on the industry?
Well, I think it's an important point. I think the smart, common sense people want propitious and appropriate regulation. They don't want to be overregulated, and they certainly don't want to be underregulated. I think the real serious players in the industry that want to conform to the best practices want rules in place to screen out the bad actors. So I don't see the risk of that. You know, you just mentioned Commissioner soon-to-be Atkins as an example. I think he's somebody that's very, very focused on that. So I don't think it will swing too far into the under-regulation. And again, if you bring CEOs on from the various crypto exchanges, the best actors are looking for best practices, some help in the regulation, meaning willing to offer some self-regulation, but they really just want clarity on the rules. And I think we'll get that without over-tipping.
Anthony, switching gears a bit here, Elon Musk, Vivek Ramaswamy on Capitol Hill today. The new Department of Government Efficiency, Anthony. I'm just curious to get your take on that, what you make of it. Do you think it's a worthwhile effort?
Listen, I've been around too long. I hate to be this cynical, but these things have never worked. I'm old enough to remember the Grace Commission under Ronald Reagan. They presented all these cost-cutting measures to the government. None of them went into place. I'm old enough to remember Simpson Bowles. That happened during the Obama administration. Those guys put together a very comprehensive bipartisan plan. They submitted it to Paul Ryan and President Obama. It ended up in a paper shredder. The Musk-Ramaswamy situation, these are very smart, capable entrepreneurs. Elon Musk is arguably one of the most successful people in human history. And so I don't want to bet against these guys, but I know how Washington works. I know how slow it is in the process of cutting things. And I know how many legal protections are in place for things like entitlements. You know, somebody suggested, I think this morning, that they were going to cut $119 billion of veterans' medical benefits. I think there would be a huge political uproar on that. I don't even know if it's necessarily legal. So could they get some things done on the margin? I'm hoping that they can do that. Can they cut $2 trillion from the federal budget? I don't think that they can do that, and I think we have to be realistic about it.
Anthony, we know that you campaigned against now President-elect Trump, right? What do you think is the biggest potential upside, particularly for investors, from his presidency, and what are you most worried about at this point?
Well, I did campaign against him. You know, I worked for him. I have an understanding of how he thinks, and I'm worried about the lack of predictability, and I'm worried about the process. As an example, he has not signed the ethics agreement yet for the transition. He hasn't received the federal money for the transition, and there's things like that that go on. You know, the fact that he's meeting with all these foreign leaders right now, I find astonishing, because way back in 2016, I was present when President-elect Trump met Shinzo Abe, then the Prime Minister of Japan, and President Obama called him and said, you know, this is sort of a Hatch Act violation. Could you not do this? And President Trump was compliant with that. But now I think he's met with at least 3 or 4 different leaders. And I think this sort of stress on the system and the stress on the traditions have me worried. He's got a guy named Kash Patel that's up for FBI director. He said he's going to come after people in the media. He just filed a lawsuit, a personal lawsuit against Olivia Troy for, I guess, her First Amendment right to criticize him. And I think there's a danger in that. And I think if Kash Patel ends up as the FBI director and he actually goes out and starts prosecuting journalists for their free right to speak and their freedom of expression, I think it's a very dangerous time, and I think it puts a lot of stress on the economy and a lot of stress on the system. So there are things that they're willing to do that I think don't work in the United States, which is why, yes, I did campaign against.
Anthony, when you worked in the White House, were there certain things that you had to divest when you took that position? And do you think that that's going to happen with this incoming White House? Are they, are there going to be conflicts of interest in terms of the assets that are held?
Well, I was in the process of following those rules and divesting, but of course I got fired, so it became moot. I didn't have to divest, but I was actively in the process of going over what the ethics rules were with my attorneys and making sure that I was legally and ethically compliant. There were other people in the cabinet, other people in the White House that just ignored those rules. I don't even think they were punished for that, and I don't think there was a lot of retribution towards them for doing that. And again, we got to be very, very careful about this stuff. You don't want to overly mix the government with business. You don't want to turn the United States into the American oligarchy. And so, again, we have to be careful with these things. And if you're telling me people are going to enter the government and not follow the ethics rules or what the potential conflicts of interest are, I'm going to tell you there's going to be decisions made that are not dispassionate decisions. They're going to be linked to people's business interests. And that's not really fair to the American people. That's not what I think the American people would like to see in their public servants.
Anthony, always great to see you and have you on the show. Thank you so much for joining us.
Good to be here.
Appreciate it.
You have to teach me how to grow a beard, Josh. I got to learn.
Next time.
I got to learn.
Time.
Okay?
It's easy, Anthony.
Yeah. I need tips. I need tips.
Thank you, sir. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime. We're joined by Jared Blickery to get you up to speed on the action
from today's session. So let's start with the major averages here. We saw the Dow closing pretty much at the lows of the session, drifting lower throughout the day by a little more than 0.5%, about 248 points here. The S&P 500 off by about 0.2% after gyrating considerably throughout the day, as did the NASDAQ, which also finished it down about 0.2%. Small caps doing worse today. We've been watching that group closely. It's down 1%, and so just sort of a mess sort of day in the markets here. We've been getting a lot of economic data throughout the week, but tomorrow with non-farm payrolls, that's going to be the big one of the day, which maybe will give us some direction when it comes to people extrapolating what the Fed is going to do at its December meeting, whether or not it's going to cut, because when we heard Jay Powell speak this week at a conference, well, we didn't get necessarily much direction one way or the other definitively from him. Jared's got a closer look at the action from this session. Hey, Jared.
Hey, Julie, that's right. We got quite a few catalysts this month, not just tomorrow. We got CPI next week, the Fed meeting, so the list goes on. But today, we did see some underperformance from the Russell 2000 at the small caps, which you were just looking at. I want to show the VIX real quick, and I'll just throw a 3-month candlestick chart up here, and we were just coming off the lowest levels. Hard to see that little candle down there, but it's kind of a bottoming formation. Does the VIX rise from here? That could portend a little bit of weakness in equities, but I wouldn't expect anything great in the month of December. This is the time of year when we tend to see volatility contract, and notwithstanding what we're seeing, excuse me, with a slightly higher VIX today, we're really not seeing that in the realized volatility, which is not implied volatility like the VIX. So aside from the volatility lessons here, consumer discretionary was the best performing sector today. It's been one of the best since the election, and you can see materials, that was leading the downside. That was down 1.37%. Industrials down over 1%. So is healthcare. Some more losers than winners. And if we take a look at the NASDAQ 100, where we had a spectacular day for the mega caps yesterday, kind of a split day today. Tesla up 3%, while we're seeing Alphabet down 1%, and then Amazon and Microsoft, they are each up 1%. Josh.
Thank you, Jared. Markets closing lower to end the trading day. Joining us now is Jay Bowen, CEO, President, and CIO at Bowen, Haynes & Company. Jay, good to see you on set.
Good to be here.
We've had some strategists on, Jay, and sometimes it sounds like try as hard as they might, they can't find a reason not to like the stock market right now. Earnings are growing, the economy's growing. Jay Powell said just this week, right at a media conference, no reason he doesn't think the economy can't keep growing. Fed seems biased towards easing. Is it that simple, you think?
Well, to some degree, I think it is. I mean, the Fed is easing into a rising earnings environment, and I think you've had two pivots over the last few months. Number one, they've decided to prioritize preserving the business cycle versus the inflation fight. And then the second pivot in terms of the financial markets is more of a focus on valuations and multiples as opposed to momentum. I think that's starting to change too. And you've seen that in the last month with the broadening out, where the equal weight, that's the best proxy, looking at the equal weight versus the traditional index. Equal weight did better, for instance, the last month. And I think that could continue into 2025 as it broadens out. To me, it's got a very much of a second half of the 90s feel in terms of, that was the last authentic soft landing. 95, 96 with Greenspan. And I think that's kind of where we are. A lot of innovation, high-tech innovation. Also very important, that burst of productivity growth we had back then, that was major, and that is an authentic silver bullet when you have productivity growth. If you look at the last few quarters, we're ticking up into that 2.5% to 3% range, which after a 10-year period of very lackluster productivity growth, that can make a big difference in terms of profits and profit margins. I do think we're going to be more volatile in this new environment, more 5 to 10% pullbacks, as opposed to, where you have these extended periods where it's kind of quiet. I think we're normalizing. We're normalizing from a nominal GDP standpoint. We're normalizing from a real GDP standpoint. And from an interest rate standpoint, in the late 90s, the 10-year traded above nominal growth. I mean, that used to be a pretty good proxy, nominal GDP in the 10-year. That was a rough estimate, pretty good. The great financial crisis and the aftermath totally shredded that with the zero bound and that hyper-activism from the Fed. I mean, I think we're normalizing. We're moving away from that, which is a good thing. We're normalizing. So these higher rates, I think, are going to be here for a while, and they're moving. The good news is they're moving up for the right growth-oriented reasons. When you look at the real rate, it's a growth proxy as opposed to more inflation expected.
Jay, you're known for managing the Tampa Firefighters and Police Officers Pension Fund, which has had remarkably consistent performance. But you guys just came off the best year for that fund, right? The fiscal year ended at the end of September. Did you change anything, or was it just a function of what we have seen in this market environment and the opportunities you're seeing? And do you still see those kinds of opportunities?
I think the financial guide said, well, it's your 50th year, so we're going to make it your best. That's actually what happened. That was our 50th year. And it ended up being, as a sole manager, it ended up being our best. And it just, the stars were aligned. And it's a September 30 fiscal, which also make it in terms of, as opposed to the calendar. It just, the momentum was there. And we're heavily oriented towards equities.
Right.
And our top holdings really did well.
NVIDIA is your top holding?
Yes, it's our top holding, and we started on building that position back in 2019, and we have taken more profits than the market value now of the stock, and it's still, so that gives you a flavor of some of the momentum that we've had with some of these holdings. That would be a good example. Right.
And Jay, you talk about how you like one theme you like, technology companies disguised as industrials.
Right.
What do you mean by that, and what are some examples?
Yeah, you've got these companies that some people might say, wow, that sounds like a stodgy industrial company, like an Eaton, for instance, or a Honeywell.
Or Corning, I heard was on that list, right?
And Corning, which was the backbone of the internet revolution back in the 90s, now seems to be becoming one of the backbones of the AI revolution in terms of the high demand, particularly these data centers for fiber. And the fiber build-out continues in a big way. Their springboard plan that was released a couple of months ago is very aggressive in terms of that optical division, fiber division, strong double-digit growth prospects looking out. So I think that's one from a valuation standpoint that also looks very intriguing, not only from a forward multiple standpoint, but very strong free cash flow, strong balance sheet, really good management team with an extremely unique product in that optical segment.
In addition to that, a lot of people like financials right now, and you have a financial among your top holdings, but it's not one of the big banks, it's American Express. Why do you think that they're well poised right now?
Again, a very financially strong company with good momentum. And it's very intriguing to me, this company. The growth prospects are still looking out. They're growing globally and they're growing demographically. They're making really good progress in Japan, which I think is interesting. And another very interesting statistic to me is that new card members over the last year, 60% were millennial and Gen Z. It's got kind of a mystique, the card, for these younger generations, and also globally. So I think it's a very well-managed company with strong momentum and good growth prospects looking out.
Yeah, Jay, it's good to see you. Thanks for coming in.
Thank you.
It's been a while.
Great to be here. Yep.
All right, thanks. Appreciate your time. Coming up, we've got some earnings to get to as shares of Lululemon and Hewlett-Packard Enterprise are in focus following their latest reports. Stick around, we've got more market domination overtime coming up.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capsule Gains. We're up for a few days and everything has changed.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Fourth quarter results of Hewlett-Packard Enterprise hitting the wire just now. Let's take a look at those numbers here. Q4 adjusted EPS 58 cents versus 56 cents. That's a beat. Revenue $8.46 billion versus estimates of $8.26 billion. So beats there on the bottom and top. Looking ahead, it looks like they are calling for Q1 adjusted EPS between 47 and 52 cents. Street was at 48 cents. And it looks like they're looking for Q1 revenue growth. They're calling for up mid-teens %. They also do on that Juniper acquisition, they say they expect that transaction will close in the early part of 2025. So that is within the previously stated time frame. We do have some comments here from CEO Antonio Neri as well. He talks about how HPE delivered an exceptional fourth quarter, record quarterly revenue, talks about capping off a strong 2024. He says we exceeded our full year commitments for revenue, EPS, and free cash flow. He talks about what he calls a differentiated portfolio across hybrid cloud, AI, and networking. And you can see that stock popping about 3%, nearly 4% now. And of course, tomorrow on Yahoo Finance, Julie, we'll be speaking with CEO Antonio Neri. So more insight to come.
Those shares up about 27% this year. So building on those gains. We also just got numbers from Lululemon. So we're looking at those Lululemon numbers as the company's third quarter results hit the wire. Those shares up a quick 7% here. Third quarter earnings per share at $2.87 versus the $2.75 that analysts had been anticipating. Revenue also coming in ahead of estimates. And third quarter total comparable sales, excluding currency effects, on constant currency, up 3%. That's a little better than estimated. All of that growth, by the way, coming from outside of the U.S. Constant currency international comparable sales up 22%, but in the Americas falling by 2%. And then finally, the company forecasting full year net revenue of $10.45 to $10.49 billion. Analysts looking for $10.42 billion, so ahead of estimates. And the company also authorizing a further $1 billion stock buyback program.
The stock action in this one had been really interesting too, Julie, because heading into this print, it was down about 30% year to date, but it had rebounded strongly. It was up around 30% in just the past 3 months or so. You know, we had spoken on the show about different challenges to the company. There was, over the summer, remember there were the product issues we had discussed, of course, competition as well, but at least initially here, investors like what they see.
Yeah, and I think really interesting in particular what we saw from those China sales specifically. I mentioned international was up 22% in constant currency. China mainland sales up 24% in constant currency. So amidst an environment where we're talking about a lot of weakness in China or deceleration at the very least, this is a company that is still winning in China.
Yeah, investors responding.
Yeah. Well, as those Lululemon shares jump on earnings, let's get some more perspective. Morningstar senior equity analyst David Swartz is joining us now. David, interesting to see these numbers here. What stands out to you?
As you mentioned, the international sales growth was quite strong. Lululemon sales in the U.S. and North America have slowed down, that's clear. But the company still has a lot of potential for growth, both in China and Europe and possibly other parts of Asia too. And right now, Lululemon is opening most of its stores in China, and that investment really seems to be paying off.
You know, David, over the summer, we had talked about some challenges for the company, including challenges relating to product. Are those challenges, are those just all rear view mirror at this point?
Well, we'll see what we hear on the conference call, which is coming up later. These results suggest that Lululemon has overcome some of those problems. I think some of the merchandising issues, though, still remain. The company has done some reorganization of its product development team, and it's going to be some time before some of these new designs and new products get into the stores, probably not potentially until late 2025. So, I think that we have a lot more to see. But Lululemon still remains a very popular brand. The products are very popular. The market itself of athleisure, I think, is still getting bigger. So there's still a lot of reasons to like Lululemon, and a lot of reasons why I think consumers still have a lot of respect for the brand, despite the fact this year the company has had some difficult periods.
And the Americas sales did fall by 2%. In the quarter. Revenue for the United States specifically was unchanged. Even if they're growing internationally at the clip that they are, which is pretty impressive, How much of it, this is their home market, it's their biggest market. Is that a problem?
It definitely is a problem because obviously the U.S. and Canada are its biggest markets. But, there have been some tough comparisons this year. Last year, Lululemon had really strong sales of its handbags, which, I think was kind of underappreciated at the time. The Lululemon accessory last year really exploded, and they've slowed down this year. And so that's one of the reasons why the comparisons are difficult. But it is clear that there is competition in the U.S. and Canada, too, that is affecting Lululemon. We've seen some strong competition from brands like Vuori and Alo Yoga. And, of course, there's many others like Nike, too, that compete with Lululemon. And so the competition is there. But I do think that Lululemon is doing a good job of expanding its addressable market. By expanding into footwear, for example. It's still a very small percentage of Lululemon sales, but potentially, it's a very large market because that's a market that really, continues to be dynamic and grow, and Lululemon just has a very small part of it right now. Also, if you look at men's is still only about a quarter of Lululemon sales, but men spend more money on sportswear overall than women do. So, someday I think that percentage could get close to 50-50. Right now, men's is still a minority of their sales, though.
David, I mentioned to Julie how the stock action, this one was interesting. Heading into the print, it was down about 30% this year, but it had really rebounded. It was up about 30% over the last few months. I'm just curious, as a financial analyst, what does valuation look like on this one at this point versus peers?
Well, right now, I think it's overvalued again. My fair value estimate's a little under $300. So there was a time when it was in the low 200s when I thought it was undervalued. This stock tends to be volatile. It clearly kind of went down too far, and now maybe it's going up too far too. But that's not unusual for Lululemon. Typically, for years, I've had this stock as overvalued. To be honest, really earlier this year was one of the few times ever when I had it as undervalued. So this is a stock that people tend to give very high multiples to. And there's a reason for that, of course, because Lululemon has consistently beaten estimates just as it did today. And so people appreciate that, and they see it as a strong momentum stock. But I would be a little bit worried about the valuation right now because, as you mentioned, there is a legitimately strong slowdown in its sales in North America that's been happening this year.
What do you think the company needs to do to try to juice that to some extent?
I think that Lululemon's main problem has been that its products have been kind of the same the last couple of years. I still think that people really like the brand and they go to the stores, but when they've gone to the stores this year, they've kind of seen the same stuff that Lululemon's been selling for the last couple of years. As I mentioned, they did have a big hit last year with crossbody bags, and they haven't really come up with anything that big this year to make up for that. And, a lot of the core products like leggings, I think maybe getting a little bit stale. The company tried a new fabric that didn't quite work. People didn't like the designs, and they had to pull that out of the stores. And so, some of the products this year, I don't think have been the big hits that Lululemon needs. But I still think that when Lululemon does come out with those products, that the shoppers will be there. I still think the market is there for Lululemon right now.
David, always great to see you and have that instant reaction. We appreciate it.
Thanks.
Time now for To Watch Friday, December 6th. We're going to start off on the jobs front. The monthly jobs report for November is coming out in the morning. Economists forecasting non-farm payrolls to come in at 218,000. It's coming after October only added 12,000 jobs impacted by hurricanes and the Boeing strike. Economists also expecting the unemployment rate to hold steady at 4.1%, while hourly wage growth slows to 0.3%.
Moving over to the Federal Reserve, we'll get a big batch of Fed commentary throughout the day tomorrow, and this will come after comments yesterday from Federal Reserve Chair Jay Powell. He said the strength of the economy gives the Fed the ability to take time on future interest rate cuts.
And we're also going to get a look at the consumer with consumer sentiment data for December coming out in the morning. Economists forecasting that number to tick up to 73.3. The preliminary print giving us more insight into the consumer as the holiday shopping season rolls on.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Markets pulling back from record highs, and even Bitcoin coming off that $100,000 level, despite optimism over the incoming administration's pick for SEC chair. And a key catalyst for investors is, of course, that jobs report. We're going to be looking at the top takeaways from the trading day coming right up. Plus, what will drive the tech trade in 2025? We've got expert predictions and what you need to watch for when it comes to AI and NVIDIA. And the booming business of sports betting. Even Robinhood suggests it might consider joining that field. The CEO of SimpleBet joins me straight ahead. Well, the tech sector enjoying gains of nearly 25% so far this year, while the tech-heavy NASDAQ notches a new record close this week as AI continues to be the life of the party for tech performance. We're looking at what may lie ahead with Technalysis Research President and Chief Analyst Bob O'Donnell. Bob, great to see you in studio.
Yeah, it's great to be here. It's always fun to come to New York and come on into the studio here.
So let me ask you, Bob, so let's look ahead. Yeah. Going into 2025, and I'm hard-pressed to think of a theme investors were more excited about than AI. I'm curious how you think, as we head into this new year, how do you see that technology developing from here?
Yeah, you know, Josh, I mean, what we've seen in the past 12 months has been this incredibly rapid transition, and I think that's going to continue and, in fact, accelerate in 2025. And that's actually going to lead to, I think, a lot of different changes. We're going to see things that we think are really big or were really big this past year, maybe not be so big next year, and yet other new things become really big and important. So fundamentally, I think we're going to see, for example, this notion of what I call hybrid AI. The idea that I'm going to do some of my computing, some of my Gen AI stuff in the cloud, but I'm going to do some of it inside a corporate data center, and I'm going to do some of it on a PC or smartphone device. And just the way we saw hybrid cloud computing, hybrid AI, I think, starts to change the story when we think about who are going to be the important players? Where does some of this computing work get done? Who are the software providers? How do they make companies better able to build applications that they in turn can use to change their whole foundation of how they work? Because that's where we are right now. We're just starting to see these big companies start to deploy Gen AI applications. I just finished a survey of about 1,000 U.S. companies, and on average, they're using 6 different Gen AI applications. Now, some of them are POC, but 90% of these companies that I surveyed were already using one Gen AI app in production already. Next year, we're just going to see that grow. And alongside that, we're going to see the big cloud guys. I just came from AWS reInvent in Vegas. They made a whole bunch of announcements. I was just at Microsoft Ignite 2 weeks before that. They, of course, had a whole bunch of stuff around Azure and Gen AI. Google's got things going on as well. So we've got a lot of big players, a lot of big parts moving. Obviously, OpenAI continues to be a lead on the foundation model side, but where that Gen AI work is happening, again, I think is going to evolve, and there are some important implications there. Other thing is silicon. We're going to see more and more custom silicon. Of course, NVIDIA is going to continue, I think, to dominate, to be clear, and we'll get to more of that later. But, you know, we just saw Amazon introduced a new chip called Trainium 2 that they believe could be a competitor, a lower cost competitor to NVIDIA. Doesn't mean they're not going to continue to use NVIDIA. Of course they are, but it's an option. Microsoft has been doing the same thing, same with Google. So we're seeing a lot more diversity in terms of the silicon that's being used to power this stuff. We're seeing a lot more software. And back to NVIDIA, just to follow up on that point,
because a name that clearly investors decide, listen, that is the face of this AI revolution, right? It's Jensen Huang and his team had an incredible year. What do you see? How does NVIDIA's business, I guess, evolve from here next year?
So, you know, first of all, they're going to continue to crank out GPUs in as fast as they possibly can, and the orders are going to be as big as they can possibly be, because we're still building up the capacity that people need. Now, there will come a point, it's not going to be in 2025, maybe it's 26, 27, when as the way some of the stuff gets calculated and performed, maybe we shift to see where some of these things are done, and some of that starts to moderate. But we're still a little bit of ways away from there. But I think the important thing to think about with NVIDIA is the software story. So what they have been doing, they have these NIMs and other software tools that they've been developing and making available. So for a number of the companies like your HPEs, your Dells, your Lenovos, your Ciscos, the companies that sell servers to enterprises and businesses, they're saying, yeah, you can have our GPUs, and oh, by the way, just make sure you bundle our software with it, from which they can start making licensing money. And so I think you're going to start to see a software licensing business start to come into NVIDIA as well. And initially it's going to be small, but still that gives them a nice growth opportunity. And also, if we would ever see a slowdown, again, a couple years out, it shields them a little bit from that because all of a sudden they'll have software revenues as well. So I think, you know, Jensen's a very smart guy. He's going to be playing a lot of different cards in that regard. And of course, related to that, another trend next year is AI PCs and
AI-enabled PCs.
Yeah.
Do you think AI-enabled PCs sort of jumpstarts a meaningful refresh cycle? Is that a 25 event, 26 event?
It's a 25 and into 26 event. And just to finish the NVIDIA story, rumors and rumblings are they may be jumping into this space as well sometime next year. So that's yet another angle on NVIDIA. But yes, I do think we're going to see, because you've got several things. When I talked with you last time about happening in the PC market, you've got the Windows 11 refresh, you've got the Windows 10 end of support, you've got all these AI PCs coming out there. You've got silicon from all the major players. And a lot of companies are sitting on 4-plus-year-old PCs that they updated at the beginning of the pandemic. It's time for a refresh anyway. So I think that's another story to watch in 2025.
It's a lot of tailwinds. Bob, we'll have you back next year, talk about 26 as well.
Sounds good.
Thank you, sir. Great to see you.
Yeah, you too. Thanks.
Meanwhile, the Dow leads losses as the stock rally hits pause. Bitcoin pulls back from 100,000 here with the trading day takeaways as Yahoo Finance's Josh Schaefer. Josh.
Hey, Josh. Yeah, so the three major indexes closing a little bit lower today, but coming off record highs. Not necessarily a ton of interesting action we were watching from that perspective. What stuck out to me today, of course, Bitcoin. Bitcoin crossing 100,000 for the first time Wednesday night, actually inching up to hit 103,000 during the trading session today, Josh. One thing that's been interesting with Bitcoin, too, when we just take a look, I'll go 1 month. A lot of the big moves have actually happened overnight. So when you go even shorter here, you can see the large move really coming in those overseas sessions, which has been an interesting thing to watch. A lot of times people are just waking up and your crypto has moved a lot when it's a 24-hour session. But what I was taking a look at today, Josh, was the moves in other cryptocurrencies. So I'll show you on the board here over the last month. So the election was a month ago today, right? We're going to equal weight this out. Let's find Bitcoin. 43,000 here. Look at the amount of altcoins that have outperformed Bitcoin. So I asked our guest Andy Baer from CoinDesk earlier today about this, and he explained basically Bitcoin already has ETFs, right? A lot of these other coins would benefit from a more pro-crypto regulatory framework. Maybe they could get an ETF attached to their coin. They need Web3 platforms that are going to be able to be legalized, things like that. And when you take a look, Josh, I made this into a chart for us, too, so you can really see it. Bitcoin is down here over the last month. Look at how small those gains look. Bitcoin's up 50%. But when you look at these other three coins, we're looking at Cardano. I put in Dogecoin here to show that it's just kind of risk on. But you've seen these massive, massive rallies. The other thing Bear said, though, if you just want a little bit of crypto exposure, Bitcoin's probably your place to be. This is volatile, and it's a little bit too hard to track on a day-to-day basis.
We spoke to Michael Saylor today, so we heard from the mountaintop. He was on the show. He told us he expects Bitcoin will be the most valuable thing in the world 100 years from now, Josh. So buy it for the grandkids.
Hey,
that's what he's saying.
Bitcoin market cap over $2 trillion, Josh. There aren't many U.S. equities that have a larger market cap than Bitcoin, and it is quickly chasing some of those big names, right? So that's going to be an interesting thing to watch.
All right, Schaefer, point number 2.
All eyes are on the labor market, right? So we kind of had a quiet day in stocks today, and I think part of that is because we have that big jobs report tomorrow. When you consider sort of key catalysts here in December, you really have this jobs report, you have an inflation print next week, and then you have the Fed meeting the week after. Other than that, it feels like stocks are a little bit just kind of drifting higher here, headed into December, or the end of December. So here's what we're looking at for this November jobs report. About 220,000 payrolls expected to be added. That number's been shifting throughout the day, been at 215, 220. Unemployment rate expected to be flat at 4.1. The major narrative here, Josh, being we had that weak October print because of the hurricanes, because of the worker strikes. Remember, that number was 12,000 last month. So you're supposed to see a big uptick, unemployment flat. The economics team over at Bank of America says we get this. Probably doesn't mean much for the Fed in December. It's probably going to be a little bit of a snoozer of a report. A lot more concern about that inflation print, though, next week.
Yeah, the narrative certainly has been labor market cooling, not crashing.
Cooling, not crashing, and this is more cooling, not crashing. So as long as there's not a big surprise,
we shall see, Joshua.
We will.
All right, thank you, sir. Stick around. More Ask You for a Trend right on the other side. Social media platform Blue Sky has surged since Donald Trump's election victory. The company offers a decentralized platform, which means it's not bound by a single authority. But can Blue Sky succeed where others have not? Akiko Fujita joins us now. So, Akiko, can it?
Well, that's a big question, right? The idea of decentralization in many ways rooted in the early days of the internet, where you had a network of machines connected organically. Flash forward to today, and you've got companies like Meta and TikTok and X dictating their algorithms and your feeds. Blue Sky's trying to disrupt that by giving users direct control over what they see. A key factor here, Blue Sky is an open platform, which means the data that drives the feeds is available to the public. There's another critical difference here. Blue Sky is built on something called an @ protocol. CEO Rose Wong tells me that means users own their data and can take it with them.
The idea is you can put Reddit, Facebook, dating apps, Goodreads, anything on top of our protocol. Why do you want to do that? Because then your identity, your data can actually move from platform to platform, and you're not locked into these walled gardens, and you own your identity on Blue Sky versus having the platforms own your identity. And so the vision is actually much larger.
The catch is you need other tech firms to sign on to this to be able to move seamlessly from one platform to the other. That hasn't happened yet, but the hope is Blue Sky's success will spur them to at least consider shaking up the infrastructure, Josh.
And Akiko, what are the chances for that success? I mean, despite other social media platforms emerging, dominant players have remained the same for years, right?
Yeah, I mean, we have seen other platforms experience a spike in their user base off of big events. You had right-wing platforms like Parler and Gab emerge as an alternative to Twitter under Jack Dorsey. The migration to Mastodon happened after Elon Musk bought the platform. And then you had the president-elect himself, Donald Trump, establishing Truth Social after his 2020 loss. Now, while it did make some gains post-election, Truth Social's total number of users trails by 400 times that of X, as well as Meta's Threads, according to Bloomberg. Downloads for Blue Sky have also slowed down from the highs that we saw post-election. But Wong tells me she thinks Blue Sky can thrive precisely because the social media landscape is so fragmented now. It's no longer about the global town square.
I think that binary choices are often wrong. Like, is it communities or global square? And I think this is where we take a page out of the offline world, which is like, how do we interact as people and communities? And I think that we have many circles, or in some ways like concentric circles, in which we have, you know, a smaller group of people that we're close with, and then there are larger groups. And so I think that's should be mirrored online, where you should have small world, big world experiences.
Josh, regulation is also part of the conversation here on why these upstarts haven't been able to challenge the big social media companies. It's largely because they have such a hold on these platforms. But you heard Rose Wong there. It does feel like increasingly you've got users sort of going into their cozy corners, if you will, as opposed to sort of Twitter's heyday, maybe 2011 or so, when it was about one platform and the big conversation that happened there.
All right, Akiko, thank you. Appreciate it. On Wednesday, DraftKings is completing its acquisition of SimpleBet, a provider of automated in-game wager pricing. The deal will allow DraftKings to integrate SimpleBet's machine learning models and improve the quality and speed of data throughout the DraftKings platforms. And joining us now is Chris Bevilacqua, SimpleBet CEO. Chris, great to see you and have you here.
Yeah, great. Thanks for having me.
For the uninitiated, Chris, who are listening right now, explain SimpleBet. It's micro betting. What does that mean, and what are some examples?
So SimpleBet, we're an enterprise software data and technology company, right, that has built this enabling technology, this software technology that we license to third parties like DraftKings and other sportsbook operators. And really what micro betting means is, think of it as micro time frames. So we create opportunities to bet on every pitch and every at-bat in a baseball game in real time, or every play or every drive in a football game in real time. Or every
so I'm like watching baseball. I can bet on whether it's going to be a ball or a strike?
Ball or a strike, or is the pitch going to be over 95.5 miles an hour, yes or no? And so we basically take a 3-hour baseball game, we turn it into thousands of mini betting opportunities.
And Chris, you helped create this company. You worked at it for years. Why did you decide, listen, now's the time to sell to DraftKings?
You know, that's a great question because
I would imagine, Chris, the space you're in has got to be hot and growing fast.
Yeah, there's no question, and that's one of the benefits of now being with DraftKings, which is, you know, basically a part of a duopoly now between them and FanDuel that control over 80% of the online sports betting market. And the whole market now moving towards in-play betting, which is what happens, bets that happen while a game is going on. And that's really where the whole market is moving, and that's where micro time frame and micro betting is really at its finest. And our technology enables that. But the problem that we had two major headwinds, right? The first was getting access to high quality live data streams. So we had data companies like Radar and Genius that were in the way of us and the league IP. So there was always friction in getting the necessary data from the data companies. That's issue number one. The bigger issue was over time, and what certainly played out over the last number of months, and actually last year or two, is our customers were becoming our competitors because they wanted to in-house the technology that we have. In other words, they wanted to build it themselves. So those two factors, you know, really, I think, drove our decision if we're going to really unlock the value of our investment over the next couple of years, we have to do it inside of one of the big operators, in DraftKings, because they were one of our early clients, and we've had a great relationship with them. They were the right partner at the right time.
And how does DraftKings, now that they acquire SimpleBet, Chris, how does it fundamentally help grow their business, attract new users, new fans?
Yeah, so as I said a minute ago, like the market is moving towards more in-play offerings, right? So right now in the U.S., in-play makes up somewhere around 35 to 40% of all of online sports betting handle. Whereas over in more mature markets, like over in Europe and Asia, it's closer to 70%. So you have this movement occurring that clearly is moving towards in-play betting. And in order for DraftKings to continue to grow and grow in an outsized way versus their competitors, they want to win the in-play market. And our technology, we're years ahead of anybody else. And so by them having that as captive technology, in other words, taking basically moving out of the B2B business, right, because we have contracts that are going to expire, and then now they're going to have a product that is years ahead of anybody else and is now going to be captive to them, and you get more casual gamers, right? That's why, like right now they got about 3.5 million active users, and that is growing. And this type of betting is more attractive to casual users.
Are there certain sports, Chris, where micro betting is more popular or even just makes more sense than others?
Yeah, I think for us, we've certainly had the most success with baseball, right? Because baseball, you got 75, 80 at-bats in a game. You've got 300 pitches or so in a game. And we have dozens of markets around all. So you have thousands of opportunities, right? So the cadence of baseball is like perfect for micro betting.
Right.
But it's really good in NFL and college football and NBA and college basketball. That's where we're getting 95% of all the handle across sports betting is in those 5 sports.
I would also think, Chris, that listen, if I was a league, if I was the NFL, or if I was a team, I mean, I want viewers watching as much as possible. It feels like micro betting, because it's just so fast and so robust and so constant, would be one way to do that.
There's no question. There is no, and I come from the media business, right? I wasn't a sports betting guy when I started the company 6.5 years ago. So I always knew, right, and most people would intuitively understand that if you bet on a game, you're going to watch and engage with that game longer, right? So you watch what's happening in media, and you see ratings going down across the board, cutting the cord, and we have this whole movement of what used to be mass media and traditional media into personalization and personalized media, direct to consumer. And in the middle of all that is technology, and sports betting is right at that crossroads. And so what we're seeing now is all genres of programming are being less engaged and less watched inside of the traditional media. NFL and college football, as an example, are actually going up. It's in many ways defying gravity. But to me, there's no surprise that that's happening, because now betting, which was illegal 6.5 years ago, is now in 38 jurisdictions. It's in the majority of the United States. That level of engagement, people that have money and bet on games, is just driving live video consumption. And it's an amazing combination for the media business.
Keep those eyeballs hooked. Chris, great to see you. Appreciate your time.
Thanks for having me.
On the latest episode of the Yahoo Finance Sports Report, host Joe Pompliano breaks down the big ratings that the NFL produced on Thanksgiving Day. Be sure to scan the QR code below to stay up to date with all the Yahoo Finance podcasts, and check out the Sports Report every Thursday at 5 p.m. Here's a look at this week's episode.
This year's game was a little bit unique because it was 2 of the worst starting quarterbacks in the league today. Both backup quarterbacks for the Giants and Cowboys, with Drew Lock and Cooper Rush, played, and the game wasn't very exciting. Still, it averaged 38.5 million viewers, which will likely make it the most watched regular season game this NFL season, and the 4th most watched Thanksgiving Day game ever. And not to be outdone, even the Miami Dolphins and Green Bay Packers put up a huge number at 26.6 million in the late night game. Now, we don't have the final number from the Lions game earlier in the day, since CBS ended its contract with Nielsen this past October, but I'm sure that'll be just as big, given the Lions have become a mainstay on Thanksgiving Day for the NFL.
For a chart of the day, we're looking at the cycles of Bitcoin. And Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yes, and this chart coming to us courtesy of Gautam Chagani over at Bernstein, who has a price target of $200,000 on Bitcoin for the end of next year. Now, conventional wisdom goes that Bitcoin moves in 4-year cycles, and Chagani divides them into 4 periods within each of those 4-year time spans. He says there's a breakout period out of a period of sort of low volatility, a humdrum market, something that usually happens to cause it to break out into that period. A couple of examples, Tesla buying Bitcoin in the past, he says, the growth of grayscale assets in 2020, of course, the spot Bitcoin ETFs. Then he says there is a hype period where there's a lot of money pouring into the market and a lot of people start talking about it. I guess this is the period where taxi drivers are talking about it, etc. Then he says you see a drawdown phase, a correction phase where people are booking profits, and you see big drawdowns in the past on a percentage basis as much as 80%. And then finally, an accumulation phase. He calls this the year of healing. So you see the 4-year periods that we have seen in the past with each of those phases. Notice we're only a couple years into this phase right now, which is why he still thinks there is room to go. We've only seen the breakout, and we're currently in the hype period, according to him. Now, as to whether and what the correction period is going to look like this time around, we earlier, of course, talked to Michael Saylor, the executive chairman of MicroStrategy, and this is what he said about these cycles.
I think what you'll see is you will still see volatility, but you won't see the extreme drawdowns of the last cycle. You'll see a more gentle volatility. It'll surge up, it'll come back, but I don't expect like we saw an 80% drawdown in the depth of the crypto winter from 66,000 to 16,000.
And he doesn't think that's something that we will necessarily see again. Likewise, when we talked to Skybridge's Anthony Scaramucci in the last hour, he too said you're going to see the volatility, he said. But at the same time, he thinks there's more of a floor under Bitcoin than there has in the past. So again, that suggests that maybe those sort of big, sharp drawdowns we've seen in these correction phases, they're not going to be as sharp going forward. Of course, as Scaramucci also said, he has been humbled many times in life and in markets. So it's difficult to be sure of anything, but this is something they're looking for potentially, that the next correction will not be as severe. Josh?
All right, thank you, Julie. Let's take a look now at what's trending after hours, starting with Petco, and those shares are surging in extended trading. The pet wellness company reporting a beat on Q3 results, including a narrower loss per share than expected. Chain posting revenue of $1.51 billion in the quarter, sees revenue of $1.55 billion for Q4. Shares of DocuSign skyrocketing after hours. The company's third quarter results beating analyst expectations. Adjusted earnings per share coming in at 90 cents versus estimates of 87 cents. DocuSign's revenue forecast for Q4 also coming in higher than expected, and that's helping lift that stock. And Ulta Beauty shares surging after reporting a beat on earnings for the third quarter. And the big surprise, comparable sales unexpectedly edging higher in the period. Ulta Beauty also lifting the low end of its sales outlook for the full year. CEO Dave Kimball saying the company remains confident that its model and strategies will drive long-term profitable growth. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.
to navigate the best moves for your portfolio. Today, we're looking at the investment potential in Japan amid the country's improving corporate governance. I'm here with Hennessy Japan Fund Portfolio Manager, Masa Takeda. Thank you so much for being here. Appreciate it.
Thanks for having me.
So let's get straight to the stock that you like here. It's called Oryx. It is the largest diversified financier by market cap in Japan. We've seen the stock do pretty well this year. We've seen it rise about 26.5%. So let's talk about why you still like it here. And first of all, has to do with tourism to Japan. We actually have a chart of what we've been seeing here. We had a sort of peak in the late teens, and then it's coming back up towards that level right now. Why is that good news for them?
Right. So you might think because it's a financial services company, why is it a beneficiary? Well, so they have three segments that that have been benefiting in a big way. One, they are the owner of Kansai International Airport. So they're an investment company, so they own these crown jewel assets. That's a monopoly business. Number two, they're in aircraft leasing business. Avalon and Oryx Aviation combined, they are the third largest in the world. And it's a wonderful time to be aircraft leasing business. And then thirdly, they run hotels and they own hotel properties across Japan. Again, inbound tourism, the business is thriving. So, I call them hidden beneficiary of Japan's inbound tourism.
Right, because as you say, you wouldn't necessarily think a company in finance would be connected, but because of that assets, those assets. Also, of course, Japan, the Bank of Japan has been normalizing rates. Talk to me about what that does for Oryx's investments.
Sure. So this is a financial services company by origin. So they started as a leasing business, and then they branched into lending business, life insurance, private equity, private lending, and so on and so forth. And these are obviously beneficiary of rising interest rates. We talk about rate hikes in Japan, but that sounds a little bit too hawkish. In fact, it's all about normalization of interest rates in Japan. And this is a nice tailwind for these types of businesses that have suffered for so many years.
Interesting. And then finally, even though the stock has been up as we looked at, the valuation to you still looks attractive. What valuation metric are you using?
Well, so I think the easiest metric you can look at is the price to book. And even based on reported BPS, price to book is touched below 1 times book. Now, the company, being an investment company, they have a lot of unrealized gains on assets on the balance sheet. Some of them show up in the balance sheet, some of them don't. Some of them don't show up. So on the market value based book value per share, their price to book is far less than 1 times right now. P multiple also 10 times or less than 10 times. Dividend yield 4 times. I think it's a very, very attractive valuation.
Interesting. So we always like to point out what could potentially go wrong or what's a risk. And that would be if there's a global recession, because it would sort of pull down some of these investments along with it. What do you think the likelihood, though, of that is at this point?
Well, obviously, there's always unknowns, but, anything financial is always sensitive and vulnerable to exogenous events. And so, of course, Oryx is not going to escape that, although we would see it as a potential buying opportunity. The other thing is, if the rates will continue to remain high in the U.S., they have some U.S. operations, so one of which is mortgage origination. And so, housing demand could be dampened if the rates continue to creep up.
Gotcha. So we'll keep an eye on that. And then the stock that you're saying folks maybe should avoid here is Hitachi, a name that is a little more familiar to U.S. consumers. It's a conglomerate that owns electronics, makes electronics, for example. Now this stock has just about doubled over the past 12 months. And so one of the reasons that you don't like it as much is because all of that capital has flowed into it?
Correct. So we're shareholders. We invested back in 2021, saying that it was trading at 10 times PE with return on equity to 15%, and it was back then regarded as cheap manufacturing conglomerate. But our argument for this name was, this is a company that is starting to focus on transitioning from traditional hardware sales model to solution provider model. And this company has IT expertise, and they have operational technology. So they run mission-critical social infrastructure, and they also have manufacturing expertise. There are not a lot of companies out there with all these three types of expertise under the same roof. Now, 2 years, 3 years fast forward, now it's become everyone's favorite, so it's less attractive for sure.
Yeah, less of that sort of hidden jewel, I guess. They have a large backlog, as you pointed out to us. How does that then translate into revenue and profits?
So seeing a huge backlog, is encouraging. But then, of course, engineering, if you're an engineering company, EPC company, history is rife with cost overrun. So it'll be interesting to see whether they can successfully translate that backlog into solid revenue growth and profit growth.
And then finally, you talked about that transition that they've been trying to make. How has that been going, and how quickly has it been happening?
So again, our argument was initially it was going from manufacturing conglomerate to solution-based provider. And now the pace of that transition, of course, it remains to be seen. So far, so good. And I think if they continue to focus, if they continue to go in this direction, naturally the returns on capital should improve and cash flow generation should improve as well. And that should be good for valuation matrix. So, we expected multiple re-rating, which happened, and now it's got to a point where we think it's fully priced in.
Gotcha. So what could change if the stock does correct downward? Maybe that would be a reason to get in, or if you got a little more clarity on that transition, perhaps.
Absolutely. This is a name that we absolutely want to buy again if valuation becomes sensible.
Gotcha. Do you still hold any of the shares?
Yes, we do.
Okay, you just wouldn't be adding at these levels. Gotcha. Masa, thank you so much for coming in.
Thank you.
Interesting stuff here. Thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capsule Gains. We're up for a few days and everything is staged.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
to big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. And today we're looking at the semiconductor industry. We're all awaiting NVIDIA gearing up to report its third quarter results this week. I'm here with Sphere Invest founder and CIO Ivana Dalevska. And we're not talking about NVIDIA, we're talking about other chip stocks today. There is a universe beyond NVIDIA, of course. And your buy stock is Marvell Technology. Now, it actually was your buy stock back in March as well when we spoke to you. And at that point, the stock had sort of a nice little run. Then it came down. Now it's going up again. So the stock is up 47% year to date. It's up about 14%, I believe, since you came on with us. So let's go through why you still like this one. First of all, you say it's benefiting from the boom in custom designed GPUs. Is that related to AI, or is it just generally we're seeing that kind of a trend?
So thanks for having me, Julie. This is specifically related to AI, and basically as we get further into the cycle, all the hyperscalers are designing their own chips and competing with NVIDIA. So Microsoft will have their own chip, Amazon is really far along the line, and that's who is Marvell working with. Google has their own TPU, so we think that as we get further into the cycle, custom chips will gain a significant part of the pie here.
And you think Marvell will take a lot of that share in that particular market?
The two players are Marvell and Broadcom. I think they're both well positioned to benefit, but Marvell is just a smaller company, so it will be just a bigger piece of their revenue base.
Gotcha. And you say also that they're a leader in networking interconnects. Now, first of all, explain to people what networking interconnects are.
So networking, Julie, just to give people some background, is a pretty big and important market adjacent to the chips side. So basically, this is all kinds of like connections, switches, cabling that goes side by side with the GPUs. And this is actually where we're seeing a lot of the performance improvement coming from. So if you look at the new Blackwell chip, it is two Hopper chips connected together. So the way you're connecting these chips and optimizing the network is really going to be key in getting performance improvement. Marvell specifically is a leader in interconnects. This is a smaller part of the market, but they have a very high market share. And they're entering in some of the other parts of networking as well.
Gotcha. All right, and let's talk about another market that they're in, or other markets that they're entering into within networking here. You've got, again, you're going to have to explain this to us, active electrical cables. So what does that mean?
So active electrical cables are basically versus optical cables. They're able to work with higher speeds and work inside these chips. So they're really a new area that is kind of born as part of AI, that they're part of it as we look further.
So basically all part of the AI chip ecosystem, if you will.
That's right.
You see a big increase there. Okay, so we like to talk about what could potentially go wrong, so or risk here. In the case of Marvell, a digestion period maybe in AI investments, and we've seen sort of fits and starts of that from a market approach this year thus far, where we kind of see the AI stocks run up and then pull back a little bit.
That's right. So we're seeing the market react to it, but we haven't really seen it fundamentally. So people are still ordering chips at higher levels than they were last year. The Blackwell numbers are going to come in very strong, we believe, on Wednesday. So we haven't really seen a fundamental slowdown. The question becomes, after Blackwell, when the next generation of chips comes, is there going to be as strong demand, or are we going to go through a period where people kind of learn and tinker with Blackwell and see what they can build on top of it? And this would be a downside case, or would create a prolonged period of time where we are going to see some sort of a stagnation in we're not seeing it yet. We're not seeing any signs of it yet, but this is something that we're closely watching.
And then the stock that you do not like as much is ASML, which is a chip equipment maker. That stock is down about 7.5% year to date. So you would think if the chip industry is growing as it has been, then the chip equipment would be growing, but that hasn't really been the case. Why not? What's going on here?
So that's right, Julie. So we've seen a bifurcation here between the chip sector and the chip equipment sector. For chip equipment, we already went through a pretty massive CapEx cycle. So companies like Micron, TSMC already invested, and all of the new build as a result of the CHIPS Act, all of those have not been built yet, but are in the company's backlog already, right? So in order for us to see acceleration in the numbers for ASML, you would need to see new plant announcements rather than what's been announced to date.
Gotcha. And, China's a big market for this company. But of course, there are some political headwinds there.
That's right. So China represented as much as 49% of revenues at some point earlier this year. With the restrictions, that's now down to close to the 30s. So we believe that basically that's going to continue to decline as we face further restrictions.
Right, and there already are some restrictions that are in place. But what do you think are sort of the further risks that could happen as a result of the election and the policies that might get put in place?
Well, I think the environment is going to get a lot more restrictive. Right now, the company is still able to export to China. They just need to get export licenses, and they're restricted in the high end of the chip side. So if restrictions get even stricter, we're going to see a potential of local Chinese players entering the market, which would be a long-term concern for their dominant position. So this is not something, it's not a bad company, but it's something where you want to be watching it through the down cycle and finding a better entry point than where it is today.
Well, and we did see some people coming into the stock recently because they reaffirmed their sort of longer-term 2030 forecast. So I guess that brings me to what could go right for them as you look over the longer term.
So what we're looking in terms of what can go right is some of these markets that are oversupplied, like memory. We're trying to see when those come to balance. As these companies are converting a lot of their traditional memory supply to AI, at some point in the next 2 to 3 years, they're going to need more capacity. So we're looking for data points of when that actually happens. For now, we're not seeing it just yet. Same thing on the logic side. TSMC had invested quite a bit of money in adding capacity. Their capacity will grow next year, but the extent to how much it will grow, that's a big question mark. And Intel as well, we know that they're struggling, right? So when they turn around and they start investing, that would be another catalyst for them.
Ivana, let me ask you, because not just chip equipment, but chips generally tend to be very cyclical. How do you know when in the cycle to buy? In other words, if you're anticipating, for example, that the chip equipment market for ASML is going to turn up in 6 months, in 12 months, when do you want to be buying?
So you want to be buying basically when you start seeing book to bill start exceeding 1. So if the company is booking more business than they're actually billing, that's a pretty big positive sign. ASML specifically booked something like $2.6 billion in the quarter when the market was expecting $5 billion. So that's a pretty big red flag. So you're looking for those bookings numbers to accelerate and book to bill to start exceeding or approaching 1.
Gotcha. Really helpful stuff. Ivana, thank you so much. Good to see you. And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack. Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capsule Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your...
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we are looking at the semiconductor sector with leader NVIDIA reporting third quarter results after the bell tomorrow. Joining me now, Kevin Munn, Henny Walsh, Chief Investment Officer, doing a double dose for us today with now Goodbye or Goodbye. And your buy pick is?
Shocker.
NVIDIA. So we know what the stock has done over the past year, right? We have seen a near tripling in the shares after they already had climbed a lot last year. And we are now coming into an earnings report where 85% earnings per share growth is estimated and 83% revenue growth. So let's talk about why you still like it here. You say it's the hub of this AI ecosystem.
Yeah, I believe NVIDIA is trying to become the hub of the AI ecosystem, very similar to how Amazon became the hub of the e-commerce ecosystem. They're not slowing down, and they're looking to take over all aspects of that ecosystem, not just semiconductors and chips, not just data centers, but ultimately hardware and software as well.
Right, so it's that whole system that they talk about. So let's talk about the market share for NVIDIA in this area right now, because most of the people we talk to say it's kind of NVIDIA and everybody else.
Yes, and they dominate in the chips aspect, and they're not slowing down there. And I'll touch upon this in a minute with respect to Blackwell and Rubin. But how about their data center business? I bet we see more explosive growth in their data center business going forward as well. And data centers are so critical to AI because they're the nervous system. They power all these intensive AI calculations. But they're getting stretched now because they have to look for alternative sources of energy, which is now delving into natural gas and nuclear energy, not just electricity.
Which I know is something else you like, but that's the subject of another Goodbye or Goodbye. And then finally, what's next, right? Because the market is always asking that question.
And so is NVIDIA. So we know next year they're going to come out with the Ultra version of their Blackwell chip that they just debuted this year. 2026, they're coming out with the new generational chip called Rubin. 2027, the Ultra version of the Rubin chip. So they're not being complacent. They're not resting on their laurels. They're continuing to power ahead, and I think they're going to continue to gain market share as a result. Whatever market share they don't have already.
Right. I mean, all of that said, they're not without risk, of course.
Certainly.
So let's run through some of the potential pitfalls here. First of all, there's the overheating issues, and we heard once again some reports of that yesterday, that they were kind of struggling, especially with the largest arrays of chips. When they put, I think it was 72 of them together at once, they do struggle with this issue.
And it's not just an NVIDIA issue. Remember, these chips run hot. The data centers run hot, so they need cooling solutions as well. That's why you see companies like Vertiv Solutions, Armodian Manufacturing, actually rising in terms of their stock performance because they provide the cooling solution to the data centers that employ these chips. So I think that problem will be resolved, but continue to look for other chip makers having similar overheating issues.
Gotcha. And then the valuation, which you can't ignore after the run that they have seen.
Yeah, I mean, they're currently trading at 64 times current earnings, 36 times forward earnings. I kind of like that forward earnings number, much better. 36 seems more reasonable, but it's hard to bet against NVIDIA right now. I think you could find an attractive entry point that's a little better than where we are today, but you might not get that after tomorrow, at least over the short term.
Yeah, we'll see. Although, you know, it is hard for it to surpass expectations, right? Even though you say, you know, you think they're going to beat, they haven't always risen even when they beat.
And will they meet the market's expectations for how much they're going to beat this time around? How much longer can they surpass these very lofty expectations? And if just one of those earnings report they provide weaker guidance than the street is expecting, you could see a pullback, but that could also bring more investors in who are looking for that.
Like you, maybe. And you guys hold the shares, I
We
see.
do.
Okay.
We do.
Let's talk about the stock that you would be avoiding here. This is Wolfspeed, another chip company. These shares are down 85% or so over the past year here, and the earnings have been falling.
Yes, unfortunately, Wolfspeed is moving at snail's pace with respect to profitability, pun intended, of course. Earnings declining quarter over quarter and year over year, and you'll see in the next point, revenues declining quarter over quarter and year over year, struggling with profitability, and you talk about that stock performance. This isn't a good trend. This company needs to turn itself around, else they risk no additional funds coming in.
What is going on here? Why is this such a different story than some of the others that we were watching in this industry?
I think it's just poor balance sheet management. They continue to take on more debt. They're in the right space, semiconductors and chips, right? And you'll see as a positive potential upside, they're in the right area of the market that could benefit from the next 4 years.
Let's go there.
Talk about it. EVs. There are certain EV mandates coming down the road, and perhaps now with Musk as part of the Trump team, there'll be even more money directed towards EVs, renewable energy, fast charging stations. So if they can hang on, they may benefit over the next 2 to 4 years, but they got to shore up their balance sheet. They have to start growing their earnings. They have to start growing their sales and become profitable first.
Gotcha. So this is not one that you're in at the moment.
Now, we are not.
We'll be
Doesn't meet our
watching.
selection criteria.
Yeah, we'll see if things turn around there. Well, Kevin, thank you so much for
My
being
pleasure.
here. Really appreciate it.
Thank you, Jules.
As we ramp up for those NVIDIA earnings tomorrow. And thank you for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
'24 has proven to be a huge year for the crypto market. The market's crown jewel, Bitcoin, soared to a new all-time high in Q1, and we now anticipate it's halving. Meanwhile, Ethereum, Solana, and others jockey for position. Join us on crypto's wild ride for the most up-to-date news on the coin market's fluctuations.
As Bitcoin resumes its climb towards $100,000, it's been really interesting to see the moves in Bitcoin this week, kind of mirroring a little bit of what I talked about earlier in your 9 a.m. hour, just in terms of the volatility of the Trump trade. We saw Bitcoin coming off its highs earlier this week. Now it's moving to the upside and bringing these crypto stocks right along with it. I just want to see if I can pull up Bitcoin for today. The latest numbers that I've got on my end is a little bit delayed for me here, but it's up about 3% on the day, just above 94,000. So getting further and further from that $100,000 mark, but we certainly are still seeing a lift to the upside when it comes to Bitcoin over the past week here. Having said that, that volatility that I mentioned is going to be really important to watch for a company like MicroStrategy. They lost about $30 billion amid that drop in Bitcoin over the past couple of days here, just because they are so leveraged to that asset.
Yeah, and I think the big question is whether or not we need a specific catalyst to get above that $100,000 hump, and then exactly what the activity is going to look like. And Maddie, you're so right when it comes to volatility. Obviously, it's hard to talk about Bitcoin without mentioning the volatility largely associated with it. And there's been a number of our guests that have come on over the last several weeks just talking about and really warning that we could see a sell the news type of event if we were to cross 100,000. We've already seen a bit of a sell the news event as we get closer to that level. So again, that is a key thing to watch here. And Riot's CEO was very much talking about the fact that there's a lot to be optimistic about, especially when you take into account some of the initiatives or early talks that we are getting from the incoming Trump administration, the potential appointment here of a crypto czar, and what exactly how that would play out here over the next 4 years. And that, of course, has been the driving factor of this recent euphoria and optimism surrounding Bitcoin, talking about a more friendly, or what is viewed as likely to be a more friendly administration towards the industry. Bitcoin right now is further retreating from that $100,000 level. The cryptocurrency's 4-day slide is the longest losing streak that we've seen since Trump's election win. Joining us now, we want to bring in Jason Les. He's the CEO of Riot Platforms, one of the largest publicly traded Bitcoin mining companies here in North America. Jason, it's great to have you. We just had the price of Bitcoin up on the screen. We've seen a bit of a slide here, a 4-day slide, but still pretty impressive, the climb that we've seen. It's still above 92,000. We know President-elect Trump has made a number of comments just about the fact that he is very bullish on Bitcoin mining, specifically here in the U.S. under Trump 2.0 administration. I'm curious how you're thinking about it, maybe the strategy, how that shifted following Trump's election win.
Sure, and thank you for having me. It's been quite a momentous movement in the Bitcoin and broader cryptocurrency market since the presidential election. You really have to look backwards to understand why. There was a whole of government attack on this industry for the past 4 years, and that suppressed a lot of investment and took a lot of capital out of the space, sidelined a lot of capital while the rest of us have been trying to build this industry. And by simply being friendly and not adversarial, the new Trump administration has lifted a massive regulatory burden that was carried over this whole space. So I think that's why you're seeing a lot of excitement and movement in the price immediately following that election. I know there's been a number of engagements and projects that President-elect Trump have talked about relative to Bitcoin and cryptocurrency. And as industry leaders, we are very excited to engage with the new administration on these projects. But I would say by simply not being adversarial, even being just neutral, it is a 180-degree environment from what we have dealt with for the past 4 years.
How do you anticipate it impacting your business specifically? Because I know over the past year to date, for example, if I look at your stock, it's down a little over 24%. Do you expect to see a read-through?
Yeah, I think that with the new administration in the White House, with the changes that we've seen in Congress, we have opened the way for new regulatory clarity to come through. There's been a number of bills that have not been able to be passed because opponents to the space, both in Congress and in the White House, did not allow them to move forward. A lot of investors are sidelined because of regulatory clarity. I also think the new administration's view on energy and energy policy is very bullish for not only Bitcoin miners, but HPC AI data center developers as well, and all sorts of technology that needs more power. So I'm very excited about the new era that we're going into this industry. While a lot of the Bitcoin mining stocks, Bitcoin stocks have suffered year to date, I think you've seen tremendous rise, Riot specifically, up about 40% over the past 3 months. A lot of that kicked in following the election.
We also have heard talk about the fact that President-elect Trump could appoint a crypto czar. Is that just another catalyst you're seeing for the industry?
I think having expertise inside the White House advising the president and the rest of the administration on crypto Bitcoin policy, I think that's very important. Industry perspective, industry insights always helps lawmakers make good decisions. And what I'm very grateful for is the lawmakers that we have built relationships with and educated and worked with over the past few years. And bringing all these parties together with a role like that, I think can be very beneficial for making the United States a leader in Bitcoin.
We've also seen a slew of companies benefiting from the broader Bitcoin rally. One of them, of course, being MicroStrategy, continuing to buy Bitcoin at its highs, even issuing debt to be able to purchase more Bitcoin, which then pushes the stock higher. Would you consider a similar process over at Riot?
We're following these developments really closely. You know, we're open to all options to create shareholder value. I think what MicroStrategy is identified and taking advantage of right now is the fact that there is a lot of fixed income capital that is looking for exposure to Bitcoin, and in many of their cases, convertible bonds are the only way to get exposure to that. So that's why you're seeing companies like MicroStrategy get very attractive terms, zero coupon debt, long dated debt, and with the use of proceeds simply to buy Bitcoin. So there's certainly interest in this. It's certainly something that we're following closely.
Does it? That sounds a little bubbly to me, Jason.
Well, you have to remember, a lot of these fixed income investors, they do not have any other way to get exposure to Bitcoin. They cannot buy Bitcoin. They cannot invest in Bitcoin equities. But what they can invest in is fixed income instruments, securities like convertible notes. And you know, there's still a conversion premium, so those investors are getting a return. And while it's unsecured debt, it is effectively, you know, built on top of the foundation of Bitcoin that MicroStrategy has built. So I don't know if I would use the word bubbly, but I would.
Now to crypto. Bitcoin, of course, has more than doubled in value this year, with no other major asset class coming close to matching that performance. Despite the pullback in recent days, Bitcoin is still near a record high, and President-elect Donald Trump has vowed to make it a central focus of his incoming administration. So should investors continue to chase it? The big question. Joining us now, Fred Thiel, Mara Holdings Chairman and CEO. Fred, thank you so much for being here. I want to talk about your business, but let's start with that price action, right? Of course, we're approaching very rapidly. It felt like 100,000. We've pulled back a little bit from these levels. I'm guessing, I'm going to go out on a limb and say you're a long-term Bitcoin bull, Fred.
Yes, I am, obviously. You know, the purpose of our business is to create value and accumulate Bitcoin. So being the second largest publicly traded company and holder of Bitcoin, and the largest Bitcoin miner in the world, we're obviously very focused on this industry. Needless to say, the industry got a huge bump with the Trump election win. If you think about where things were in August, we bought about $300+ million of Bitcoin in August at a price of about $60,000. And lo and behold, you know, last week we were buying Bitcoin in the mid 90s, together with Michael Saylor. A lot of us are long Bitcoin because if you look at what the Trump administration has promised along the campaign trail, Bitcoin strategic reserve, essentially providing the ability for banks to custody and collateralize Bitcoin. You're now starting to see institutions layering in Bitcoin in commercial real estate lending packages. You're beginning to see insurance companies essentially investing in Bitcoin-related equities. I believe in Michael Saylor's $3 billion bond offering, an international insurance company bought about 25% of that offering. So you're seeing more and more institutional investors really seeing value in Bitcoin and Bitcoin-related investments. And so this floating tide just keeps sucking up demand. If you think back just the other day, we were 99,000, just getting ready to kiss 100,000. Every single Bitcoin that was held in a wallet at one point was in profit. And so think about this. If in August we were at 60K, people who bought in August had essentially a 50% profit already in just a few months. People who bought Bitcoin 4, 5, 6 years ago, and you could arguably say about 40% of Bitcoin hadn't moved in 2 or 3 years. These were people who started having to take chips off the table, which they've done. We've seen a lot of selling, but there's been a lot of buying, and I think we're going to continue to see post-inauguration day as the Trump administration puts in place some of these programs that Bitcoin will continue to move up.
And Fred, I mean, you're right to say with this Trump administration, I mean, there's crypto allies there, there's crypto friends, not just Trump, but you think about Howard Lutnick and RFK Jr. In terms of policies, there's a lot they could do, Fred, as you mentioned, but what would you have them prioritize? Would it be more regulatory clarity, Fred? Would it be this idea of a strategic reserve and maybe even adding to that reserve? What would you want them to emphasize?
So, I think what we would love to see is an executive order from President Trump essentially directing the U.S. Marshal Service and agencies that have confiscated Bitcoin or taken possession of Bitcoin in the form of fines or criminal property, and allocating that as the seed for a strategic reserve. Senator Lummis has put forth a bill that would essentially provide for appropriations for funding to continue to fund and acquire Bitcoin. We believe that there are opportunities to look at things like Social Security and other areas where the U.S. is holding funds where they could allocate a portion to Bitcoin. The other thing is in the banking sector, freeing money center banks and federally chartered banks from the shackles of Operation Choke Point 2.0 and essentially saying, you know what, you can custody Bitcoin. You can lend against the Bitcoin on your balance sheet. You don't have to reserve 120% of its value to be able to do that. That would then free up corporations like us and others to feel very comfortable about holding Bitcoin on their balance sheet because now they could custody it with their primary commercial banking partners and they could borrow against it just like any other asset. What's unique about Bitcoin is if you have an operating company, you can typically only hold cash or treasuries. Any equities or other investments that you hold above a certain level, you start running the risk of being deemed an investment company or a financial services company. And so it's really important when you look at Bitcoin, it is something that you can hold a lot of without running that risk. And if you look over the past 11 years, the rate of return on holding Bitcoin over a longer period, as you guys showed in the chart earlier, this year it's been a great asset. Well, over the past 11 years, nothing has beaten it. So I think that Bitcoin is definitely something every company should have on its balance sheet. And when you look at IRAs, you start looking at pension funds, et cetera, that adds up to a lot of Bitcoin. And there only ever will be 21 million Bitcoin. You can't make more of them. We already have 20 million more or less in circulation,
right,
a portion of which have been lost. And so I think, it's a finite supply and it's only got upward trend to follow. It'll be up and down along the way, but I think the trend will be upwards.
Fred, you guys have about 27,000 Bitcoin on your balance sheet, but your business is not holding Bitcoin, or at least that's not your main business. Your main business is mining Bitcoin, and that is a tougher business right now than just holding Bitcoin. With the halving this year, your profitability has been sort of uneven amidst that. What is the outlook for that business?
Well, you can think of it this way. Mining Bitcoin, my cost to mine a Bitcoin from a marginal perspective is somewhere between $45,000 and $55,000 a Bitcoin. Well, Bitcoin at 91,000 right now, I'm buying Bitcoin in the open market for more than it costs me to mine it. And so it's all a question of accumulating Bitcoin. And we have the advantage over MicroStrategy that because we're a miner, I added last month 700 Bitcoin to my balance sheet at an average cost way below what the market was charging for Bitcoin in the spot market. So we have a very hybrid approach that we think is unique. Most of our mining peers do not buy Bitcoin in the open market. This is why we have the largest HODL, as it's called, of our peers in the industry. And we believe that we'll continue to do a hybrid of buying Bitcoin in the open market and mining Bitcoin. And as pricing and the competition dynamics change in the marketplace, we'll lever one more than the other. But we believe that that's the best approach long term.
Well, Bitcoin's blistering post-election rally is stalling the cryptocurrency backing away from that milestone of 100,000, at least for now. Explosive Options technical analyst Bob Lang joining us with more on what could get Bitcoin to that record level. Or maybe it won't be there in the short term. I don't know, Bob, but, we kept talking about it. Maybe we talked it out of it or something. What's going on here? Was it just sort of over-anticipated that it was imminent?
Well, it's interesting, Julie, about the hype from the talk of Bitcoin over the past couple of months. I remember when we were on last time in October, I think Bitcoin is up about 50% since that beginning of October, which is quite a substantial move here. It's pulled back a little bit here, about 4 or 5% from that $100,000 mark, roughly 100,000. That's a huge wall up there. That's increasingly going to push sellers to hit the sell button as we push through that number. But I do think that people like Michael Saylor, who runs MicroStrategy, I think they're onto something here. I think that certainly the investing public is looking for something to grab onto, and the momentum from this Bitcoin is just incredible. And if we could make a run much further than most people expect. I wanted to say that just a couple of days ago that Michael Saylor said that he thought that Bitcoin over the next 10 years, compounded 29% a year, is going to get up to about 13 million per Bitcoin. That's maybe a bit of a stretch, but that's far off. But maybe he's onto something.
So it sounds like, Bob, just to put a fine point on it, because you've been trading and studying these markets for a long time. Are you saying, Bob, in the short term, you do think maybe we take a breather here before then moving higher?
Yeah, I agree with that, Josh, and I think a little bit of a pullback. They call it a backing and filling of some gaps and so forth in the chart. It's going to be constructive and healthful for Bitcoin and for Bitcoin investors. But look, the momentum is very, very strong, and there's a lot of people, Josh, on the sidelines who are waiting for an opportunity to get in to Bitcoin and other cryptocurrencies. And this next pullback, whatever the size may be, it could be 5%, 10%, could be that one opportunity for people to get in. Look, let's face it, people who are not in Bitcoin right now, they're suffering from FOMO, fear of missing out right now. And I think if that FOMO gets larger and larger for people, they start getting anxious and wanting to get in on any dip. So the dip buyers have been present there for Bitcoin over the past couple of months. So looking for a much larger dip here might be a good opportunity for people to get in.
Bob, there was also the introduction of options on the ETFs that happened last week. As somebody who specializes in options and watches that market closely, what kind of activity did you see, and what does it tell us, if anything, about where Bitcoin could be going next?
Well, the options market, Julie, offers a really great opportunity for people to get involved with Bitcoin and not having to have that kind of money available to invest, right? It wasn't, 10 years ago, I think Bitcoin was probably about $5. Now it's up again near $95,000. So using options gives you an opportunity to leverage up and define your risk, and in putting capital out there to take advantage of a momentum run that Bitcoin has been on and may continue to be on into the future. So I think the options market, about 7-8 years ago, Julie, we had the introduction of Bitcoin futures, and that was really the point where the investing public became very serious and took Bitcoin very serious about investing and trading. in Bitcoin. The Bitcoin futures market is gotten very, very large now. I think the same thing is going to happen with the options market for ETFs and for Bitcoin. There's a whole herd of ETFs out there now. BITI, which was introduced last week by BlackRock. I think they had some record number last week of $513 million worth of inflows into that ETF, and the options market is going to take advantage of that as well too. We're seeing a lot of flows into calls, selling puts, that sort of thing. So I do think that it's the hype seems to be out of control here, but I do think that there is some good story here for some more upside in Bitcoin.
Bob, always good to see you.
Well, Bitcoin this morning creeping closer to the $100,000 mark. The drift higher comes after Gary Gensler, who led a crackdown on cryptocurrencies, announced that he's going to step down as chair of the SEC in January. Joining us now with more on this, we've got Yahoo Finance's David Hollerith. David, we've had a multitude of discussions of all of the decisions that have come from the SEC and regarding crypto more broadly here. What is the signal now once we see the step down from the position and then also a new administration in January?
Yeah, Brad, I mean, I think that most people, even before we even knew that the president-elect would be Donald Trump, were pretty sure that Gensler would not hang around. And that's because SEC chairs don't typically stay longer than 1 4-year term. That's actually historically had been the case since the Clinton administration. So this wasn't really expected, but as you point out, it's a huge vibe shift. If we look back at the announcement yesterday that came from the SEC, it was immediately followed by a rally in Bitcoin. Bitcoin's obviously had a ton of momentum this week and since the election, and it's interesting too in that Bitcoin isn't really necessarily in the crosshairs of the SEC under the current Biden administration. But under SEC Chair Gary Gensler, there has been significant push to ramp up enforcement on the crypto space, particularly going after a series of larger players over what has essentially been kind of a dispute between the industry and regulators about how they should be regulated. And honestly, the lack of regulation. I think this is sort of ushering in the fact that there's going to be a clearer framework, or so we think. As far as Gensler leaving goes, it also sort of necessitates the question about what would be expected from the next SEC. And at the very least, without even thinking about the congressional part of what regulation could mean for crypto, the SEC could slow down the pace of the enforcement. They've been pretty frenetic under Gensler. And then also, too, they have a number of lawsuits standing out with firms like Coinbase and Kraken, and they could potentially retrench on those lawsuits in the next administration.
David, what about who could potentially replace Gary Gensler as the lead here as SEC chair? There's been lots of talk about Hester Peirce, but who else could potentially be in that mix?
Yeah, Shauna, it all kind of pivots at this point around who the Treasury Secretary pick is. And we have it from Capital Account, which covers Washington pretty closely. Ian Katz at Capital Account, that Hester Peirce is not actually interested in taking the role. And so if the next administration were looking to pick a new head of the SEC that was already inside the building, it would likely fall to Commissioner Mark Ueda. There's also a series of outside names that are likely contenders, and those include Brian Brooks, who is a former OCC head under Trump. Also Dan Gallagher, who used to work at the SEC and now is head of legal at Robinhood. So there's a lot of names still in the work, but I think that what the clear message is that no matter who it is, they would be more friendly than Gensler. He's had the pace of rulemaking, not just in crypto, has been pretty frenetic, and I think this is his stepping down is something that people in Wall Street and the crypto space generally are appreciating.
All right, David Hollerith, as always, thanks so much for hopping on and breaking this down for us.
U.S. stock hitting new record highs yet again. HSBC expecting a powerful rally in the of risk assets in the coming months, but there are several risks to the upside and downside that could change that outlook. Joining us now, let's bring on Max Kettner, HSBC Chief Multi-Asset Strategist. Max, good to have you here with us this morning. As you're thinking about some of the potential risks here that are both to the upside and downside for the market, what are most prominent that investors should be apt to keep in mind?
I think, on the downside, given that we are so bullish going into 2025, it's probably more pertinent to talk about the downside risk first. Clearly, the biggest downside risk that we're seeing is still on the rate side. It is that effectively, we don't think we'll be wrong in our view. It sounds stupid to say, but effectively, it's almost like we're going to be too correct in our view, that really we're going to see too strong upside surprises on the earnings front, on the top-down front. And that, of course, would bring yields up. It would perhaps call into question the Fed's cutting cycle. Can they cut further? Do they maybe even have to hike again? Does the terminal rate have to be much, much higher? And that, of course, would bring long-end yields higher. It would bring bond volatility higher. And that really would be, sending a couple of ripple effects across all the risk assets. That, to us, is by far the biggest risk because it is so incredibly complicated to hedge because, of course, both bonds would suffer, but also credit, also equities, also emerging market assets, virtually all asset classes combined, with the only safe haven being the dollar. Now, on the upside and on the positive side, look, I think some of the things around deregulation, yes, of course, but I think on the upside, there is still this really powerful combination in the next 2-3 quarters of pretty low growth expectations. In fact, earnings expectations for the S&P the next 2 quarters are just for around about a 1% growth quarter on quarter, both for Q4 and for Q1 2025. And on top of that, low top-down growth expectations, still getting those rate cuts through. The Fed already starting to hint at perhaps starting to talk about the end of quantitative tightening. All of that is a fantastic setup. It's as Goldilocks as we can imagine, really.
And you point out, Max, that inflation risk is the biggest one, which is interesting in the context of the market's bullishness right now, sort of in part being based on the fact that the inflation war has been won. What will you be looking at heading into 2025 to really get a pulse on the state of inflation and the impact that will have on markets?
Yeah, I would look at things like super core inflation. Now, super core is, of course, the Fed's preferred measure of underlying inflation. It's sort of the most narrow definition of underlying inflation. That, however, is more likely going to decline in the first half of next year, particularly the first 4 months, mostly because we had these incredibly high readings in the first 4 months this year. So therefore, it's more likely base effects, things like vehicle insurance, that the resetting of that is not going to be as dramatically high as it's been in 2024 and also last year. That would bring super core inflation down. That actually is, again, another bullish factor for the next couple of months. I would say towards H2, when we're looking at a couple of other base effects that actually then would be driving inflation a little bit higher. And I would particularly point out inflation expectations at the front end. So short-term inflation expectation. I think about 2-3 months ago, I would have been much, much more worried about inflation because those short-term inflation expectations were significantly below 2%. They were already at 1.6, 1.7%. But what we've seen in the last 3 months is they've clearly gone up. They've gone up significantly to almost 3%. So at the moment, I actually do see inflation risks more on the downside for the next couple of months. H2, right, the second half might be bringing a bit more on the surprise side, perhaps on the hawkish side, but that is nothing which we should be particularly worried about right now, I think.
So, Max, what does that mean for your outlook for the first half of next year for the S&P? How much more room do we have to run, if you can put a number on that for us?
Yeah, I think the next 6-7 months, I think you can easily have 5-10% up. I think it's really, really supportive for equities. I think for global equities, we're really seeing sort of about 12 to 13% more upside in the next 12 months, so until the end of 2025. I think a lot of that could be front-loaded in the first half of next year, but I don't think it's just going to be the S&P. Within the S&P, I think there is really a basis for some of those sectors like industrials, a bit of like a mini re-acceleration there, but still liking tech here. I don't think it's just going to stop at the S&P, though. I think that Goldilocks backdrop with better growth, better earnings, re-accelerating growth, certainly against growth expectations and consensus expectations, that could be benefiting also other asset classes. Still things like high yield credit, perhaps even things like emerging market assets in the first half.
You mentioned that you like tech, but it seems like as well that there's going to be a longevity test that's faced with regard to the AI trade. With that in mind, is there another sector that you think could outperform tech despite all the weighting that has been thrust towards technology thus far?
Yeah, I think, to be honest, in the next couple of months, I don't think it is, oh, am I buying tech or am I buying all the other stuff? So I don't think it's like, do I buy Magnificent Seven or do I buy the equal weighted S&P? I think it's more about tech and some of the other stuff, which could be things like, the industrials. When we look at the S&P, I think particularly US banks look great here. It's the financials, but in particularly the banks with perhaps hopes around some deregulation, but also with rates coming down, with volatility coming down, with already, some signs of a new capital markets cycle starting. That should be really favoring US banks over European banks. So it's not just, okay, I want to get out of tech and buy the other stuff, buy industrials, buy banks, perhaps even buy some of the healthcare stuff. But to me, it's more about tech and complementing with some of the other sectors.
Vivek Ramaswamy and Elon Musk meeting with Republican leaders today to discuss their plans to slash the U.S. government's debt. Today's meeting is the latest indication that officials are taking Trump's efficiency push seriously. Joining us now to discuss, we've got Gautam Mukunda, lecturer at the Yale School of Management. Gautam, thanks for being here. I know you've been critical of Musk in the past, but pointing to what he did at X, he came in and fired 80% of the staff. If he does a similar thing with the government, will he make a dent in the deficit?
Well, if he fired 80% of the staff of the government, he would make a dent in the deficit, but probably not in the direction he wants. So I just want to note, right, I have been critical of Musk and also praised Musk. I think I've often said that SpaceX is the most impressive company in the world without qualifications or reservations. So that's not it is a much more sort of complex view than that. But something like the Department of Government Efficiency, a sort of massive government reform effort, is desperately needed. right? It is something that is long overdue. There's an endless number of lists of things where the government performance is just not where it should be. It is actually true that the Pentagon, for example, has never, not once, ever passed an audit. But the approach that they're talking about taking is sort of so profoundly mismatched to the needs of what the government actually has that it's hard to see how this effort is going to be helpful. Let me just give you a really simple example. All of their focus has been on who can we fire, who can we cut, what can we get rid of. Okay, if we take a look at the IRS, we have a lot of studies that show that every additional marginal dollar, that's sort of every dollar you add to the IRS's enforcement budget that targets high earners, generates a minimum of 40 additional dollars in revenue. So that would be a major government reform, right? Getting the IRS the ability to target the more than $600 billion in tax evasion, disproportionately with the highest earning Americans, and giving it the resources to go after those people and actually collect the taxes that are owed. But that is exactly the opposite of the approach that they seem to be talking about and taking.
So, Gautam, I'm curious, we still don't quite know, I guess, exactly what's going to play out here, right? It's like a lot of the other political things we're talking about right now in 2025. It's a little bit remain to be seen. Do you think there's a chance that they shift direction at all based on how public perception comes out as they start some of these policies? It seems like, at least to me, you would maybe want to get an easy thing through the door and get it approved so you can sort of stay on staff, right? We know President-elect Trump doesn't really let people hang around too long if they're not being successful.
I mean, they're talking about getting rid of daylight savings time, and if they do that, I'm all in favor of it. Like, that's a great initiative, long overdue. So what I say is, Elon Musk is sort of one of the most extraordinary business people who've ever lived. Like, you can argue about whether early Elon and current Elon are very different people, as they seem to be, and all that is true. But he has a track record of doing things that are huge, and he certainly has a track record of adjusting. Vivek Ramaswamy is a very different type of character, and so it gives me sort of a lot less confidence. But in both cases, what I say is the track record and the tagging to the wins is also going to be biased just by the fact that political pressures are going to revolve around the fact that these people don't have authority, right? So that there's no statutory authority attached to the Department of Governmental Efficiency. It's not even clear what they will be, right? If they're a commission, then legally they have to be balanced between both parties and have space for dissenting views. Does that sound like what's being put together? So the most likely case here is this becomes a report that nobody reads, but the risk factor is much more than that. I focus in on things. So, for example, in the last few weeks, the Trump campaign has sort of tied itself to Robert F. Kennedy quite closely, and they said they want to make America healthy again. There's a lot of focus on taking toxic chemicals out of food. So, all of that seems like a great idea. Like, it would be really good to get American food to the same levels of health standards that you see in Western Europe and other developed countries. That would be fantastic. But that takes large numbers of highly skilled scientists and administrators to do the test to figure out what we need to remove, and then to do the regulations that get these things out of the food supply. The same people who are saying they want to destroy the administrative state say they want to regulate our food supply to make it more safe. You can do one or the other, but you can't do both. Those are just profoundly incompatible goals, and they're going to kind of have to pick which one of those they want to pursue.
That's interesting in the context, though, of something like the Supreme Court overturning Chevron earlier this year. Do you think that kind of move from the judicial side of the government is going to potentially lead to more leeway for the likes of RFK Jr. to come in and kind of do whatever he wants? So
I think the end of Chevron deference was actually, it's been profoundly misunderstood, and it's going to have a lot of complications that we haven't thought through yet. But what ending Chevron did essentially was transfer power from the executive branch to the judicial branch. So there's a huge shift there where judges are going to be making decisions that, frankly, almost, very, very few, if any, judges actually have the technical background to do. But there are plenty of judges who were appointed by Democratic presidents. And so what we're actually going to see, I think, is a level of litigation and conflicting court decisions that would take even a normally speedy judiciary, and the judiciary has not been operating quickly under the Roberts Court, years or even decades to sort out. So what you'll see is different courts and different circuits arrogating to themselves authority that has traditionally gone to the executive branch it's, I think, actually more likely to make it harder for President Trump to do what he wants to do than easier.
Well, I want to go back to the AI of it all here. There's this bullishness around the idea of AI being useful and technology being useful to create more efficiencies. Our executive editor, Brian Sozzi, asked Salesforce's Mark Benioff about DOGE, Department of Government Efficiency, and whether tech could help push the government to be more efficient. Here's what he had to say.
Absolutely. And I think you'll see that an agent-first government is a government that's going to be more efficient and more well-run, using more technology. We already have relationships with a lot of government agencies. We're already talking to them about how to bring this technology in to create more efficient agencies.
Do you buy that argument that the tech focus of Musk and Ramaswamy could be a benefit to the problem of the deficit?
I buy the argument that the government desperately needs a better tech strategy and a better ability to use tech. And Mark Benioff is entirely right in saying that it could be vastly more efficient. I'm pretty skeptical that, Ramaswamy definitely not, and that Musk could do that for the government, just because the government is different than a business, right? We don't actually want the government to run a business. It is not the government's to run like a business. It's not the government's goal to run at a profit. The government does things that in many cases are too important for us to rely on business, and in other cases are too much what we call public goods. They're things that you can't make it a profit from, but that have to be done. So, for example, the U.S. government manages the extraordinary risk of the nuclear waste that was produced by decades of Department of Defense nuclear weapons programs. The Hanford nuclear plant, for example, it's kind of hard to believe when you hear about this, but there are rivers of underground nuclear waste that are moving through parts of the country that have to be managed by the U.S. government. That takes people with extraordinary levels of science and engineering talent. Can a technology strategy help you with that? Absolutely. Only high technology can help you with that problem. But saying, well, an agent-based thing can sort of solve these problems or get us out of the incredibly difficult regulatory trade-offs you need to make, that's just not true. And businesses don't deal with that kind of problem. We create governments to deal with that kind of problem precisely because businesses cannot.
Gautam, a lot to break down when it comes to Doge, and I'm sure we're going to keep talking about it. We look forward to having you back again.
Mag 7 stocks, they're headed for their second annual gains and obviously have seen a huge rally up over 65% year to date. Is the party just going to continue?
Well, first of all, let's just take a look at what's happened in the last 5 months. So although they're up 65% year to date, in the last 5 months, the best sectors have not been tech, right? It's been financials and utilities, industrial, consumer discretionary, and maybe real estate on the back of the Trump win. I don't know how that one got in there. But at the end of the day, we are seeing a broadening in market participation. That's been one of our views this year, and we're beginning to see this take hold, which I think is quite pleasing. That doesn't mean that tech still doesn't have a place in portfolios. As we look forward to 2025, we expect tech earnings to decelerate from something around the 40% mark to around 20%. They'll need to deliver given those lofty valuations that you mentioned right up front.
Nancy, part of the trend with big tech, though, that's been driving this rally has been they're outperforming those earnings estimates, right? We've seen consistent revisions up over the past year and a half now. Is that a case that you're considering where we could still see tech outperform if, yes, 40 drops to 20, but then they actually outperform that 20 and it goes to 25 or 30, right? And it's better than expected.
I think they're really good at outperforming expectations. That's just what they do, and they're going to continue to do that. So you're right, and that will provide some support. But I think it's going to be a different market in 2025. Potentially, we've got tax cuts, we've got deregulation, we've got a lot of things happening that can support wider bits of the market. So what I'm saying is, yeah, tech, you still want to be there. If it doesn't deliver, it's vulnerable to disappointment, but other parts of the market also likely to participate, and particularly, I think, participate from some of the things that President-elect Trump looks to be putting in place. Again, deregulation, tax cuts, this is good for the other parts, the more domestic parts of the economy, the more cyclical parts of the economy, which have been rallying quite nicely over the last 5 months.
How are you thinking about the incoming administration's export controls moving forward and any changes that Trump might make to the Chips and Sciences Act?
You never know with Trump. There's a sort of good news, bad news. I mean, on the good news side, and you heard the prior speaker bringing in Paul Atkins in terms of Bitcoin, sort of super interesting. He's pro cryptocurrencies. And remember, Donald Trump wants to have the U.S. dollar to be a reserve currency. We have the French government falling because they can't fund their deficit. The United States runs a comparable deficit. No problem here. So Bitcoin, being the superpower of the world, is one way that we can continue to control currencies, not just the U.S. dollar, but digital currencies as well. So that's kind of a positive. On the export side, again, Trump imposing export controls. We're in a bit of a tit for tat with China right now. So they've come back and said, well, you can't have our critical minerals. Is that a problem? Lower down in the electronics PC area, in the industrial military complex, it could be a problem. So we're in a bit of a tit for tat at the moment, but that's all part and parcel of Trump getting what he wants, which is better access to the Chinese market, better terms of trade, etc. So I think that's a tricky one at the moment. And the third one that you mentioned is the Chips and Science Act. He absolutely hates that, right? And you do have to scratch your head. We have spent about $280 billion so far. We do have TSMC and Samsung that are going to build fab facilities in the United States. That's a good thing. But that $7.9 billion we gave to Intel last week, isn't that the same company that removed 15,000 workers, lost $17 billion in a quarter, and just ousted their CEO? Is that the kind of company you give $7.9 billion of taxpayer money to? So I think he's going to make some changes here. Very hard to underline legislative programs, but expect some kind of truncation, so to speak, of both the CHIPS Act and also Inflation Reduction Act as well.
Nancy, you mentioned something there that caught my attention. You said in some ways we never really know with Trump, right, where exactly things are going to fall. I'm curious, headed into 2025, is he going to be one of the key drivers of market volatility? Like, is what Trump says going to be perhaps more important than us debating what the Fed may or may not do from meeting to meeting? Is it going to be a Trump-driven market, or some of the other macro factors going to perhaps come up above over Trump?
I mean, lots of shorter-term traders will absolutely be trying to play every sentence and every move that he makes. Our view is we are longer term investors. We got to stick with the fundamentals, which, by the way, are pretty positive. And deregulation and tax cuts add to positive fundamentals. So we're pretty optimistic about the outlook for 2025. We've been overweight equities really since 2023. So we're going to continue to ride this bull market. Remember, if you get through 2 years of a bull market, 70% of the time you get through 3 years. We think the fundamentals look pretty good. Earnings look pretty good. And by the way, a little animal spirits, M&A, IPOs would also, I think, enhance the trajectory. So let's focus on the fundamentals. But you're right, there will be traders that will try to play every sentence, every move. And I think that's kind of a loser's game because he can change his mind. In concept, he'll do what he said he would do, but the actual implementation remains to be seen. Very hard to play that.
Nancy, going long term here, one of the big topics that comes up on our Yahoo Finance NVIDIA ticker page is putting a big chunk of your 401k into NVIDIA. Is that a strategy that you think is a good one? Does the conviction in NVIDIA have legs in the next, say, 30, 40 years?
I mean, NVIDIA is a stock that's $3.5 trillion, give or take. It's the second largest stock, sort of neck and neck with Apple. Is it really going to triple from here? I think you have to ask yourself. Look, our view is the Mag 7, and this year it's been the four horsemen. It hasn't even been the Mag 7 in terms of what's rallied. If you're passively exposed to the United States, it means that you're not underweight NVIDIA, which is a good thing because a lot of active managers have been and missed that ride. But let's just step back and look at the fundamentals. I mean, NVIDIA, fantastic, right? At the moment, demand is definitely exceeding supply, but there's competition. 40% of its customers are frenemies. They're also trying to make chips as well. They may or may not be as successful. They may or may not be able to compete. You've got AMD. I'm not so sure about Intel, as I mentioned. But there's competition that could eat away at margins in the future. But near term, in the next quarter, kind of hard to see anything eroding the very significant market share that NVIDIA has, particularly given the demand for Blackwell that's coming.
Nancy, always a lot to break down when it comes to NVIDIA, but we're going to have to leave it there. Nancy Curtin of Alti Team Global, appreciate you joining us today.
A lot of young people aren't very confident in their money knowledge and avoid risk, according to a Wallet Hub survey. 57% of Gen Z think savings accounts are the best way to invest their money. Here with some tips to get Gen Z interested in investing. We've got Ashley Fox. She is the CEO of Amplify. Great to have you back in studio with us. And so, how can we make sure that the future generations are confident about their investing strategy, and where can they potentially start to put toe in the water or put some skin in the game?
So when I think about investing and building wealth, you cannot save or work your way to wealth. So we have to start investing. When we think about our buying power and spending our money, these companies are getting bigger and bigger and bigger. What if we start to own a piece of these companies? And as the Gen Z population continues to go into the workforce, spending their money is only going to make the economy grow, but how can we build our wealth with it? So opening brokerage accounts. Yes, saving is great, but what about when they get older? What about when they're thinking about retirement? What if we start retiring early and we have our money working for us? So it is extremely important that we are not just relying on savings accounts. We are also investing in the stock market.
And so what are you seeing in terms of Gen Z and how they're doing their own investment strategy planning? Where are they performing well, and where are some of the pitfalls that you're noticing as well?
I'm noticing a lot of Gen Zers are really good at attempting to make money.
Okay.
Right? They're finding different ways to make money, whether it's online in different ways.
That's not a bad thing.
No, I love it. I love it. But what else?
Yes.
Right? We're putting in the effort, we're putting in the time, we're putting in the energy. How are we putting our money to work? And if we think about the school system, we're not taught how to invest. We're not taught how to manage our money. We're not taught how to understand credit cards. So we're good at taking out debt, we're good at shopping, we're good at creating content, but what about investing and building that wealth so that we can create passive income? What about dividend investing, right? What about growth stock investing so that that money, while we're working for it, it can also work for us while we are sleeping?
What are the top strategies that anyone can be putting into effect with the last few weeks of the year to set themselves up even before that New Year's resolution when it comes to their investing and saving strategies?
The first thing I would say, you have to get a brokerage account.
Okay.
Because having a savings account, having a checking account, we're good at that. We have to start setting money aside automatically. So the first thing I would say, open the brokerage account and pick a small amount of money every 2 weeks that you can set aside. Nothing too big that forces you to feel like you're about to overdraw your account, but something that can be set aside consistently and automatically so that you're comfortable and confident. I always tell people at Amplify, the people that we're working with, you can start with $20, right? There are brokerage accounts now that allow you to buy fractional shares. What if we $20 our way to $1 million? What if we don't have to work until we're 50, 60, 70 years old, but we're building now while we're young? We're starting small, and it's compounding over time. So I would say get the brokerage account open, set small amounts aside automatically so it happens without you even thinking about it, but also build a strategy. Think about at the end of 2025, what do you want life to look like? What kind of money do you want to have coming in? How big do you want your portfolio? How much passive income do you want to have coming in? And start moving with intention. And every single quarter in 2025, increase that automatic deposit just a little bit so that you can train your mind to grow as you grow as a person.
I want to marry two different segments together here. And we were talking earlier with Glassdoor senior economists just about what they're noticing within the mindset of the workforce and where there could be a trend that takes place in 2025 of revenge quitting because there isn't the upward career trajectory. But I'm going to take the other side of that. Say you finally come into that promotion. Say you finally are able to say, all right, I'm getting a new raise. What is your mindset that you need to take on the second some of those things start to fall in line?
So if I'm being honest, I know just whether you are a Gen Z or baby boomer, anyone, when you make more money, you create a way to spend it, which is fine. Acknowledge the fact that you want to spend money on other
like
things.
A book, yeah.
So acknowledge that.
Yeah.
But also understand to sustain that lifestyle, to always be able to put yourself in a position to get the things that you want, you also have to set money aside so that at some point, when you don't have that promotion, at some point where you choose to leave that job, you have accumulated wealth that has been set aside, that has been grown, because it's great to work. It's great to build a business, right? But what about when you don't want to anymore? What about when you want to travel, when you want to do things? What if you don't have to utilize your physical energy to be able to do the things you want to financially? So as you make more, you invest more and pay yourself first, because even though we like to spend, we're giving that money to some other company, to some other individual that is making their money, fine, but what about you?
Yeah.
Because you're going to decrease your net worth every time you spend. So what if we spend and invest? I always say it's not this or that, it's this and that.
We got a little bit of time left here. I'm going to throw you one more, and we didn't talk about this in advance at all, so I trust that you've got so many strategies here. we're in peak spending season, basically.
Yes, we are.
How can people make sure that they're spending smart, even as they are going out, balling on a budget perhaps, and making sure that they check off everyone on the list?
So I always say, start considering to own stock and who you give your money to. So inside of our Wealth Builders Community app, our membership-based platform, and Amplify, we have a I Own It challenge, where we are investing in the companies that we're spending our money with. So start thinking about parents, where your children, what they want for Christmas, what do they want for the holidays. So I have like a 7-year-old niece. She loves Roblox. She loves YouTube. She loves Target. What if we take a second and find out, well, how much does it cost to own stock in Target, to receive a dividend from Target, to invest in Google? So take into consideration that, yes, we're going to spend money for our children and for our families, but what if we give the gift of wealth? What if we buy them the gift, but also buy them a share at the same time? And really challenge yourself during a time where the entire world is spending money. Let's look at earnings at the top of Q1 2025. Think about all the money these companies are going to make. And what if they grow because you spent money, but you grow with them because you spent money, but because you also invest? So it's, again, doing both. Just, you have to train your mind to become a wealth builder, to operate in that capacity. And yes, we're going to spend. But we are not going to make these billion-dollar businesses even richer and not get a piece of the pie.
Ashley, thanks so much for joining us.
Thank you.
Welcome back. Let's send it down to the New York Stock Exchange, where Yahoo Finance senior reporter Brooke DePalma is standing by. Hey, Brooke.
Good morning, Brad. Bath & Body Works has had a strong Q3 report, and now they're gearing up for their annual Candle Day. And I'm joined by Gina Broswell. She's Bath & Body Works CEO. Gina, good morning.
Good morning. Thank you for having me.
Of course, I want to start with something that's on top of retailers' minds at large, and that is tariffs. You say you have a big advantage here. Why do you say that?
Yeah, for years now, we have been doing a lot of nearshoring and onshoring, and really pleased to say that today, 85% of our production manufacturing is in North America, the majority of which is really right outside our headquarters in Columbus, Ohio.
Would you say that tariffs then are a benefit against your competition?
Well, I wouldn't say that so much. We do it for two reasons, really. One is minimal exposure, but the other reason for having onshoring is just flexibility with speed and agility. And for us, that's part of our differentiated model, is to be able to get our products in the stores in weeks rather than months. So it's sort of a double benefit.
Roughly 10% of your products or sourcing does come from China, Canada, as well as Mexico. So when you think about that, how much of an impact will this have? Will you have to then raise prices?
Well, we do a lot with our supplier partners, very collaborative. It's a group of suppliers called Beauty Park, and we work together to, mitigate any sort of additional costs, as we have been doing for years and years with them. So we would seek to mitigate that, and if there were anything, of course, we would, pass on a modest amount. But honestly, I'm very comfortable with the value engineering that our team does to be able to mitigate that.
So Best Buy CEO does say that consumers will brunt the cost of it. You're saying not so much in your case.
Well, we offer a compelling value proposition. So for us, it's all around the absolute highest quality, the most value, which includes convenience and experience, but at an affordable price. And so that's very important to us to make sure that we're meeting the customer mindset where they are.
Yeah, perfect segue to your big annual event, biggest promotion perhaps of the year. It's your annual Candle Day. How are customers thinking about promotions and overall this holiday season?
Well, we are on the eve of Candle Day. It is our biggest day of the year. And, I'm so excited to see how the stores are going to light up with all of that. We usually have customers lining up at 6 a.m. Literally lining up with matching outfits. We have a fandom that is like no other brand I know. And so to see that sort of excitement, and we're also celebrating a 25th anniversary for Winter Candy Apple. So we have fragrances that people love for years and years and years. And so when it comes to just the shopping spirit, the 30,000 seasonal associates that we hire to be able to keep up with the shopping demand, bring all of that to life with our customers. So,
are customers really focusing in on these promotions days? Are they holding to buy out until then, or are they mixing their basket with full price items as well?
So we have been seeing a value-seeking customer for several quarters now. And as I said, value isn't just about the lowest price, and we're very excited. We're America's most loved candle, and what that really means is the leadership credentials that we have. It's the best fragrance throw, it's the 25 to 40 hours burn time, it's a clean burn, and so forth. So we find that when customers seek value, they're not necessarily seeking the promotions per se or the discounts, but rather the full quality. And so that's what we bring to bear. But yes, they are choiceful. They are discernible in terms of what they put in their basket. But we've been, navigating successfully this macro environment for some time now.
Yeah, I do quickly want to hit on the share price. Year to date, shares are down roughly 14%. What's your message to investors here?
So we are heads down executing against a long-term strategy, and it has been working from the standpoint of, I think, this third quarter. If you adjust for the calendar shifts, which is, of course, you have to remove the 53rd week and the shorter shopping season, we have sequentially improved our top-line sales throughout 2024.
Very quickly, top challenges against your consumer right now, and where is your consumer when it comes to the income cohorts?
So one of the things that we have a huge loyalty program with 38 million active loyal users, and that allows us to sort of look at demographics of all kinds, socioeconomic. We've actually not seen any discernible difference on socioeconomic in terms of their behavior and their ability to shop with us. And I think that speaks to the fact that we have a wide range of price points. You could literally go right now and pick up a beautiful gift set already wrapped from $10 to $50. And so really it's more around meeting the customer where they're at and less about sort of the socioeconomic segments. And we certainly don't see it in our data, so we're excited about that.
Gina Braswell, Bath & Body Works.
Bitcoin indeed topped 100,000 for the first time ever. The cryptocurrency on that record-breaking run since President-elect Donald Trump's victory. Joining us now, Michael Saylor, Executive Chairman of MicroStrategy. Of course, MicroStrategy now one of the largest Bitcoin holders with just over 402,000 of the coins. I don't know if you want to do a little dance, Michael, if you've got some champagne behind you. But obviously, we've been talking to you for a while now, and you have been a staunch bull on Bitcoin. You put your money where your mouth is in terms of adding it to the balance sheet over there at MicroStrategy. I guess, now that we've gotten there, now what? What's next?
Every day for the past 4 years, I've said, buy Bitcoin, don't sell the Bitcoin. I'm going to be buying more Bitcoin. I'm going to be buying Bitcoin at the top forever. I joked with Dave Portnoy today. He said, I missed it at 10,000, I missed it at 20,000, I missed it at 100,000. I said, Dave, it's still less than $1 million a coin. You're getting a 90% discount from $1 million a coin. I'm sure that I will be buying Bitcoin at $1 million a coin, probably $1 billion a day of Bitcoin at $1 million a coin. And so I think it's a very simple idea. It's just keep buying Bitcoin with your spare capital. It's going to appreciate against the dollar forever.
So, Michael, if I don't own Bitcoin, though, and I'm listening to this, your advice is buy here or no, wait for a pullback? And then when I do buy, Michael, your advice to folks who are listening about how to do that, what do they buy? Do they dollar cost average into Bitcoin? What's your advice?
I think you should think of Bitcoin as a long-term capital asset. So if you have money you don't need for 4 years, or even better yet, for 10 years, you put it into a portfolio. You might hold scarce desirable real estate. You might hold your favorite artwork. You might hold some portfolio of companies you're going to hold forever. I think a part of that is Bitcoin. So I say dollar cost average into Bitcoin every quarter. Sweep some long-term savings into Bitcoin. Expect to keep it there for a decade or longer. And don't get too worked up over the volatility in the near term.
Well, and Michael, you kind of alluded to this, that you don't try and time the market here. You're just going to, the strategy through MicroStrategy is to just keep buying consistently, regularly, no matter what the price is.
Yeah, I mean, I look at it like Manhattan real estate, the year is 1650, and if you had a chance to buy it in every decade from 1650 to today, wouldn't you just keep buying it? If you didn't have to pay property tax and you could hold it, you would just keep accumulating it forever. There's never a bad time to buy it. There's a Sailor tracker. You can look at it. It just shows we bought at every price point every quarter, at the highs, at the lows, at the mids. I bought it every week for the past 4 weeks in a size billion or more. I'm going to just keep buying it. And it's not that complicated. I expect that it'll be the most valuable thing in the world 100 years from now, so why wouldn't you just keep accumulating it?
Michael, we've talked a little bit about this before, so I want to just re-up the question before we move on. When you've likened it to Manhattan real estate, you collect rent on it, right? So at some point, do you somehow, monetize the Bitcoin that you hold in some way?
Yeah, well, imagine I gave you the chance to buy 40 city blocks of Manhattan real estate 100 years ago, but there were no buildings on it and there was no rent associated with it. But you knew it was going to be the greatest city in North America, and you could buy it and hold it. It's, you would still do it, just like you might buy Alaska in 1867, even though there's no rent on it, because you think that over the next 100 years, someone else will find a way to take advantage of it. With Bitcoin, it's Cyber Manhattan. There's 8 billion people that have money. They're not going to live there, but they're going to put their money there because everybody has to park their money somewhere. And so you're just buying one block out of 21 million of all the capital in the world. It'll be the center of the digital economy. You may not know the applications, but there are applications. MicroStrategy makes a lot of money by holding that digital property. We're generating massive amounts of shareholder value from that. So you don't have to understand how we do it. You just need to hold your Bitcoin and let us drive the price up.
And Michael, obviously the move since the election has been powerful. Trump is moving back into the White House. He clearly positioned himself, as an ally of Bitcoin, an ally of crypto. What would you like to see, Michael, his priorities be now, his policy priorities?
Well, I mean, I think low regulation, low tax, pro-innovation policies give people, specifically with regard to digital assets, if we have a digital assets framework that supports digital commodities, digital securities, digital tokens, digital ABTs, digital currencies, digital NFTs, so that people can innovate in the United States of America and spread those assets everywhere in the world, I think that'll be good for the world and good for the United States.
Michael, I'm curious because we've talked to some of your peers in the crypto industry who have talked about maybe some of the friction at times that they have felt when they've been trying to buy crypto assets under the existing regime, under Gary Gensler at the SEC, for example. You guys have obviously accumulated an awful lot of Bitcoin at MicroStrategy. Has there ever been that kind of friction? Have you seen those regulatory obstacles to what you've been doing?
Well, I think Bitcoin is the one digital asset that has the most regulatory clarity in the world because there's general universal consensus that it's a digital commodity. The friction on Bitcoin has been slow approval of the ETFs, the inability to do cash create and redemption, the slow approval of the options market on the ETFs, and resistance to banks custodying and handling Bitcoin. So that's held back the asset class. I think that a favorable crypto regime will accelerate the development of Bitcoin. And I think on the digital asset side, right, just the lack of a digital assets framework for digital currencies and digital exchanges and digital tokens has put that industry in limbo. And I think we're looking for those things to be resolved with the incoming administration, and that should accelerate growth for everybody.
And Michael, this week on the show, we did speak to Senator Kirsten Gillibrand. And I asked her, Michael, specifically about this idea of a Bitcoin strategic reserve. Listen to her response here.
I don't know what the purpose of a Bitcoin central reserve is, and I haven't really seen the details of any idea about why you would do that and why that's important. I think it would have an obvious impact of supporting the Bitcoin industry, which in and of itself isn't good or bad. I just would want to know what the reason is.
All right, Michael, so the senator not sure about the reason for it. What do you say to that? What's your response?
Bitcoin is emerging as the world's reserve capital network. If you want to store your capital for the long term and you live in Africa or Russia or China or South America or even the US, your choice is local real estate or local stocks or Bitcoin. Well, people are realizing that Bitcoin is better than real estate. It's better than stocks. There's not a single company or real estate property in Africa that you would rather own for the long term than Bitcoin. So the very simple idea is buy 20 or 25% of the Bitcoin network on behalf of the U.S. government, catalyze the development of that world reserve capital network, and then let all the Chinese and the Russians and the foreigners sell all their other assets and buy Bitcoin, and then the money flows into the United States. If you want to put a great twist on it, dump your gold, sell all the U.S. gold, buy Bitcoin, then the trade is free because you could buy 5 million Bitcoin for the cost of the gold. You will demonetize the entire gold asset class, and our enemies hold gold in their banks, so their assets would go to zero. Our assets would go to $100 trillion, and we would control the world's reserve capital network as well as the world's reserve currency network.
As usual, you're painting a grand and vivid picture, Michael, with this kind of stuff. I know your long-term price targets are sort of almost infinite. Let's talk shorter term, and let's assume that the Bitcoin reserve doesn't happen, right? Let's assume that conditions continue as they are. Where do you see Bitcoin at the end of 2025?
You know, I don't chart it month by month, but I noticed that it's been a 60% ARR for the past 4 years and even before that point. And my model is generally that it will grow at 60% ARR, decelerating to 20% ARR over 21 years. So if you start to crank in 60%, then 58, then 56, then 54, and you put that on a scale, absent the cyclical volatility, you get to a forecast which makes sense.
Michael, quick question on that cyclical volatility, right? Because typically Bitcoin does move in these 4-year cycles, and there is a sharp pullback typically. Is that anywhere in sight, and what would be a potential catalyst for that?
I think as the asset grows and matures, the volatility decreases, and those the extremes of the drawdown decrease. The structure of the market determines the volatility, and so if you're going to forecast the structure of the market, you can't look backwards. It's like if you looked at a bicycle 4 years ago, and I show up with a motorcycle right now, it's a different set of physics. The market right now is driven by the ETFs, driven by the options market, driven by companies like MicroStrategy, driven by the global adoption. So I think what you'll see is you will still see volatility, but you won't see the extreme drawdowns of the last cycle. You'll see a more gentle volatility. It'll surge up, it'll come back, but I don't expect we saw an 80% drawdown in the depth of the crypto winter from 66,000 to 16,000. In order for that to happen, you had to have a bunch of very poorly capitalized companies like FTX and Genesis and Celsius and BlockFi force liquidate. We don't have those kind of companies in the system now. The capital structures of the companies participating in the market today are much deeper, much more robust, and there's a lot more equity capital today. So you'll see a different dynamic. I think it'll be muted to the upside and the downside because of the options traders that are moderating the market.
Michael, great to see you. Thank you so much for joining us, especially today on seeing this milestone in Bitcoin. Appreciate it.
Good morning, Brew Daily Show. I'm Neil Fryman.
And I'm Toby Howell.
Today, Doge comes to Washington as Elon Musk and Vivek Ramaswamy kick off their cost-cutting project.
Then why Guinness is suddenly the hottest drink in America this holiday season. It's Friday, December 6th. Let's ride.
One thing that we always appreciate about you is that whenever Toby and I mispronounce a word, you are quick to correct us. And this kind of reinforcement learning is working. I haven't said NVIDIA in over a year, just NVIDIA. But everyone struggles to say some words, especially if they're new. And the language learning platform Babbel just released its list of the most mispronounced words of 2024 in the US and the UK. Toby, I know you've been practicing all week for this performance. So Please impress our listeners by pronouncing the words that trip people up the most and explain what they are.
Here is the top 10. First is Kamala, as in Kamala Harris. Then there's Keoghan, as in Barry Keoghan, as in the freaky guy from Saltburn, as in Sabrina Carpenter's now ex-boyfriend. Then there's Koiker Hunche, which is a Dutch breed of dog that Shohei Ohtani owns, so people are looking that up. Buttigieg, as in Pete Buttigieg. Shein, the fast fashion company. Then Speculoos 3b, a new exoplanet that was discovered this year. There's Frige, which was the Olympics mascot. Semaglutide, as in Ozempic, as in Novo Nordisk. Zendaya, and Chapel Roan. I think I went 10 for 10 there.
Well, you did practice, but you did when the spotlight shone on you, you executed well. So that was the U.S. list. In the UK, the top word that people mispronounced was espresso, Sabrina Carpenter's song, and I guess the most common mispronunciation there was espresso.
It's actually a very nice snapshot of the year in news, politics, science. If you go down the list, it does show what people were talking about. So I like this.
Talking about wrongly.
Yeah, talking about wrongly. Let's revisit this in 2025. Now, a word from our sponsor, Yahoo Finance. Neil, was it a fast week or a slow week for you this week?
Slow week for sure. Coming back from a break is always tough.
Agreed, a slow week for me too, but fast week when it comes to the market once again. That is something I found. The market waits for no man. There are constantly news stories to be read and data to parse through. It's a runaway train that you can lose track of pretty quickly.
Yahoo Finance can help tame the beast, though. It makes each fast week in the market feel a little slower, a little more manageable.
Real-time market data, research reports, stock screeners, news updates you can trust. Yahoo Finance speeds you up so you can stay ahead of the curve.
If you want your slow weeks to feel faster and your fast weeks to feel slower, head to yahoofinance.com today. Elon Musk and Vivek Ramaswamy traveled to Washington, D.C. yesterday to soft launch their Department of Government Efficiency, or DOGE. The two entrepreneurs met with lawmakers behind closed doors to kick off their much-hyped initiative to overhaul the federal government's bureaucracy, slash regulations, and trim wasteful spending. The exact mandate of DOGE is still murky, particularly because it won't be an official government agency, just an advisory body staffed by unpaid volunteers. Plus, there's plenty of skepticism that it will be able to achieve its leaders' goals. Elon Musk has pledged to slash $2 trillion from the federal budget, but the math gets tricky slash impossible once you realize that the number represents about 30% of all federal spending, and 2/3 of the budget funds programs like Social Security and Medicare that are effectively mandatory. So finding $2 trillion to cut seems to be some magical thinking.
Still, there is a ton of energy behind DOGE in Washington, since pretty much everyone can agree that the federal government could use some pruning. And I mean everyone. Some Democrats and progressives have shown an eagerness to engage with Musk and Ramaswamy, including Bernie Sanders, who said this week that Musk is right about proposed cuts to military spending. Neil, can DOGE make a dent?
Well, let's take a look at one of their most hyped initiatives, according to them, which is to gut the federal workforce, and maybe that's illustrative of how this is going to work. So the federal government employs 2.3 million people. That accounts for 1.4% of the entire U.S. workforce. In 2022, taxpayers spent $271 billion on payroll for these federal employees. How much of the overall budget does that account for? 4%. So say they were to fire half of the federal workforce, and 60% of everyone in the federal workforce works for three things: the Department of Defense, the Department of Veterans Affairs, and the Department of Homeland Security. So you would absolutely gut those particular agencies, people giving services to people like veterans, and you would reduce the deficit. If you cut half of the federal workforce, you would reduce the federal deficit by less than 10%. So this is just some of the math that they're working against when you say you want to cut something like $2 trillion.
And that's the math aspect of it. Just do a thought experiment real quick. Say we fired a bunch of DMV workers. Would that actually make anyone's life better? Because now people are still going to need their driver's license. They still need to register their vehicles. And yet now you're going to go into a DMV that has less workers there. They're handling 2, 3, 4, 5 people. Does that actually make the government more efficient? And then the other aspect of government waste that they want to go after, DOGE does, is fraudulent payments, which again is understandable. You don't want money going towards fraud. You don't want it being misappropriated. And yet, if you think about the way you push back against fraud is usually to add in more layers of maybe bureaucracy, more paperwork, more hoops to jump through, and to ensure that the money is going the places you want it to go. And again, that doesn't really achieve your goal of efficiency as well. So they almost have an impossible task in front of them. It's a catch-22 whenever you go after trying to cut places. Unless you make cuts in precisely the right ways, it might lead to inefficiencies.
Yeah, there's a great anecdote about what you were talking about, where trying to cut bureaucracy leads to even more paperwork. So there was a government conference in 2010 that was held in Las Vegas. It featured a clown and a mind reader, and that caused an absolute scandal. Why is the government spending our taxpayer funds on clowns and mind readers to entertain government employees? But that led to an insane amount of paperwork and documentation and even more inefficiency. Now that every single time there's a government conference or any government employee travels everywhere, they have to fill out an insane amount of paperwork. So that just created even more, red tape, essentially. That said, you did mention that, a lot of Republicans are on board with this, and even some Democrats, Bernie Sanders, Ro Khanna in California, they are aligned with Musk and Ramaswamy on at least a few of the issues. One of the ones where I think there is common ground between Democrats and Doge is military spending, which is a major line item in the federal budget. Bernie Sanders said, I would love to talk with Musk about, these bloated government contracts for military contractors. Ro Khanna said the same thing. He was like, Elon Musk sees this from the inside because he at SpaceX is a big government contractor for the Pentagon budget. So maybe that is an area where that we do spend a ton of money where they could find common ground.
I do think that the main takeaway here is, one, the task is gargantuan. It will be difficult. But on the other hand, lawmakers are willing to play ball. Senator Susan Collins, who actually leads the Appropriations Committee, did have an hour-long one-on-one meeting with Elon Musk. He didn't make a presentation. They were just chatting through ideas. But clearly there is some momentum here. Whether they can pull it off, that remains to be seen.
And it's not the first time there's been a government efficiency agency that, trying to clean this up. Reagan did in 1982. So this is, every decade they try to do something. We'll see whether they can get anything done.
For this next story, we're going to do a little role-playing exercise. If you are at a holiday happy hour and a young person walks up to you and hands you a Guinness, do you A, politely decline, B, take a small sip, or C, tactically chug it so that the line marking the barrier between the dark stout and the creamy foam on top lands between the G and the Harp logo on the outside of the glass? Good job, everyone. The correct answer is C. Splitting the G, as it's called, has found its way into online culture, propelling Guinness out of old Irish pubs filled with old Irish men and into the glasses and gullets of younger Americans. One Boston pub owner told the New York Times that they had to purchase 63% more Guinness this year to keep up with skyrocketing demand. Some reasons why the drink might be having a moment outside the popularity of splitting the G. Guinness is best enjoyed straight from the tap, so a return to more social drinking after the pandemic could be providing a boost. Neil, these tailwinds Guinness is experiencing means that the biggest issue it's facing ahead of the holiday season is, will there be enough of it?
That's true. This week, Diageo, which is the big beverage conglomerate that owns Guinness, actually limited pubs in the UK from sourcing Guinness each week leading up to Christmas because they just haven't made enough to fulfill booming demand. In the year to June, worldwide sales of Guinness were up 15%. Meanwhile, the overall beer industry is in decline. Sales were basically flat between July and October for the global industry, but volume of Guinness consumed from kegs was up more than a fifth. So even as the overall industry stagnates, Guinness is, skyrocketing.
I do think it is fascinating, all the different aspects that have thrusted Guinness into a, kind of being the leader really in a semi-dying category. Another one is that Guinness has been working very hard to shed its reputation as a heavy beer. I mean, anyone who's seen a pint of Guinness, it looks like a meal in a glass. It is so heavy. The foam on top seems so thick, but really, they've been on this marketing campaign to show that we're actually not that heavy of a beer. It's 4.2% alcohol by volume. That's about the same strength as a Bud Light. There's only 125 calories per a 12-ounce glass. That's the same as Modelo Especial. So despite what looks would show, it's not as heavy as people think. And as the beer industry kind of shifts away from these heavier craft beers, people are saying, wait a second, Guinness despite what it looks like, is a much lighter beverage.
Okay, what the people actually want to know is, have you split the G? How hard is it? To walk us through this process.
Well, there's a little bit of controversy actually as to what the target is when you're splitting the G. The way I've done it is between the bottom of the G and the harp logo, but some people try to split the actual middle of the G itself. So depending on which pub you're in, depending on if you're in Ireland or America, there is a little bit of controversy, but there is this rise in so-called ginfluencers. That's a real term that's been flying around on social media, where this tradition, whatever you want to call it, started way back, like 2015 era, 2017 era, in Ireland, in the UK, and it has slowly made its way across the pond. You had never heard of it before this show, so
I don't know what that says.
We got to take you to a pub, Neil.
Yeah, Hartley's. And another part of the Guinness boom is that there is some sort of craftsmanship involved in, pouring it from the keg. There's a right way to do it that takes minutes to do, and there's an Instagram account that ranks all of the bars based on how they pour Guinness, and the best one is Hartley's in Brooklyn. So if you're looking for the best pint of Guinness, that is your best bet. We should go there this weekend. On April 15th, 2019, the world watched in horror as Paris's Notre Dame Cathedral was engulfed in flames. The 12th century Gothic masterpiece, a French national monument, suffered major damage to its upper walls and vaults, while its roof and iconic spire were destroyed. But out of the ashes, a phoenix rises. This weekend, Notre Dame is reopening to the public once more. In what experts are calling one of history's most remarkable restorations, the church has been rebuilt in a colossal effort involving more than 1,000 artisans and 250 companies from all over the world. Even more remarkable, the restoration took just over 5 years since the fire and came in under budget. The restoration project had raised over $900 million, but spent an estimated $737 million on the rebuild. Toby, even as the church was still burning that April, French President Emmanuel Macron vowed to reopen it in 5 years. It took a Herculean effort, but they pretty much did it.
They pretty much did it because there was so much support from really French's elite class to get this thing back up, because it is just a symbol of national pride. In the days and even the hours after the fire, you saw these almost like one-upmanship coming in from a lot of these billionaires, where the richest families in France, like I'm talking about the Caring family, they said that they would, from luxury good fame, would give $113 million. Then LVMH's CEO, Bernard Arnault, pledged $226 million. The L'Oreal Foundation gave $226 million. So it really became this big game of like, we want to get this back on board, but it was also almost like this public display of like who can support it the most. And then, yeah, Macron played a big role as well. He said 5 years, we're going to open it. He put this very hard deadline with the sheer amount of the work they had to do, but they came in under, it's wild that they came in under budget when you consider just how much went into restoring this building.
Yeah, I mean, let's talk about some of those restoration, processes, because this thing was built originally in the 1100s. And what they did to repair some of this was just go back to the way those craftsmen did it back then 800 years ago, because they were like, man, this is really good. This withstood the test of time for the most part. So they did things like take the organ down to the south of France and just repair it with the same materials that it was originally built with, like sheepskin and animal glue. One of the most impressive rebuilds of this entire thing was the roof, which is this incredible lattice work of wood. They went into the surrounding countryside just like they did when building the original Notre Dame, and took down 2,000 oak trees, brought them back, and made the roof again. So just incredible craftsmanship work. I can't wait for this documentary to come out to see how they built this. But it also reminds me of the fact that cathedrals, something that's like 900 years old, is constantly getting destroyed, rebuilt, destroyed, rebuilt again. So, a cathedral is not necessarily just a finished piece from when it's originally started. It's like a work of constant motion.
And I can't help but contrast Notre Dame reopening with the vote of no confidence that the French government just went through, where Parliament is still trying to figure out how to run the country. And then Macron is definitely going to use this reopening as a chance to kind of bolster his political standing, because he's on unstable footing right now. So that is another undertone to this great victory for France, but still they have some things going on behind the scenes that they have to figure out. Up next. Welcome to Stock of the Week, Dog of the Week, where we pick one stock from the week's news that knows there are still 25 days left in the year and is making use of each and every one of them, and one stock who is already looking ahead to 2025 whilst forgetting the gift that is the present. Neil, I won the pre-show grammar competition. You did good, but I did well. So I'm up first, and my stock of the week is Robinhood. The brokerage firm has quietly been staging a nice comeback over the past weeks, months, and year to climb back over its IPO price. It's now up 217% year to date. It's worth about $35 billion and just hosted its first Investor Day event this past Wednesday. CEO Vlad Tenev laid out a future where Robinhood has its hands in everything from stock and crypto trading to maybe sports betting. One interesting tidbit from the Investor Day was that Robinhood sees desktops as a pillar of growth over the next few years, as the Wall Street Journal put it. According to the company, about 50% of overall retail trading takes place away from mobile devices, but only makes up about 10% of Robinhood's volume. It's an interesting strategy. Robinhood first caught on for offering zero-fee trading, attracting a more casual crowd of investors to its app. But now, Neil, it's looking to go deeper with more serious, more sophisticated traders.
Yeah, it doesn't want the people like you or me that, just buy random stocks on our phone. It wants people who have the 3 monitors set up, are very serious traders. They also bought a company called Trade PMR, which caters to registered investment advisors for $300 million. That's a planned acquisition. So so those registered investment advisors, trade stocks and own and have custody of clients' money. So they bring a huge portfolio of business with them. So all of these initiatives right here speak to Robinhood going after a more a more intentful, that's not a word, intentional investor rather than the amateur one that, maybe propelled them to fame a few years ago.
Yeah, just look at the inroads they've made with people who do have more sophisticated financial needs. According to their Investor Day, 45% of recent users earn 6 figures or more. People who are at least 44 years old now make up a quarter of recent users, and about 60% of recent users are married or living with a partner. So it's not those kids in the basement. It's not the people who maybe propelled the meme stock mania of COVID of 2020. It is just normal people with normal and increasingly more sophisticated financial needs. So you can see kind of that Robinhood saying, we're in the next phase of our iteration and we want to go bigger here.
What do you make of their push potentially into sports betting?
I mean, it's not sports betting as like you traditionally think about. It is, they're trying to create these these markets.
Essentially prediction markets.
Yeah, prediction markets, which they rolled out ahead of the presidential election. So that was, I think, a test run for them. So they're thinking like, hey, this is clearly something where people are interested in. Why would we not skate where the puck is going? So I do think that there's nothing planned on the books right now, but they're definitely looking down that path.
Yeah, I think bottom line for Robinhood is it's in growth mode once again. My dog of the week is the Hawk Tuah meme coin. This launched Wednesday night to quite a bit of hype, but plummeted in value on Thursday, causing many people to lose money on that thing. Haley Welch, the girl who went viral for an interview in the summer and has stayed in the internet limelight, launched a meme coin to, in her words, unite her community. Right after launch, the coin shot up to a market cap of $490 million before plunging more than 91% in the span of a few hours yesterday, down to a value of less than $30 million. Welch and her team were immediately accused of executing a rug pull, a scam in which insiders hype up a crypto before selling it at a profit, disappearing, and leaving regular investors holding the bag with nothing. Welch defended herself yesterday, denying any insider sales or activity. Either way, the reason we're even sharing this story is that it showcases the boom in meme coins since the election last month. Bitcoin may have just hit 100K, but the smaller meme coins have been snagging even more momentum and attention to the point where the Hawk Tuah girl is now at the center of a crypto controversy. Toby, is this the top?
I don't know. I mean, Haley Welch is absolutely speed running the internet at this point. She got the viral video. She launched a podcast. Of course, the next thing to do is launch a meme coin. But it does speak to kind of the current iteration of the crypto market that we're in right now. I mean, you go back, we had the NFT craze. Now we're in the meme coin craze. Dogecoin, which is the original meme coin, if that's what you want to call it, named after the Shiba Inu meme that a lot of people know. It's outperformed Bitcoin over the last month. I mean, we were just talking about the Department of Government Efficiency is literally called Doge. So clearly memes are driving culture right now. And just to be clear for everyone listening, the point of these coins is that they don't have a point. There is no business model. There is no cash flow. There's no underlying asset that you're buying. You are truly just buying into the fact that there's a shared understanding of an inside joke on the internet. So whether you think that has real value or not, clearly it does based off of the market valuations of these meme coins. Now let's sprint to the finish of the week with some headlines you should know. Up first, the net appears to be closing around the shooter who gunned down United Healthcare CEO Brian Thompson in New York City earlier this week. Police released images of a suspected gunman taken from a surveillance camera at an Upper West Side hostel on 103rd Street. Authorities obtained a search warrant for the building and are working to identify him. Other loose ends investigators have tracked down. They believe the suspect may have caught a ride from Atlanta to New York last month on a bus. They also found a water bottle and a protein bar wrapper in a nearby trash can that authorities say the gunman purchased from Starbucks just before the shooting. Despite all the leads, though, Neil, he still remains at large.
Yeah, what really stood out to me was the reaction on social media. Tens of thousands of people expressed support for the killing and even praised the killing. I know it maybe was a minority, but it certainly was on many of our feeds. I mean, I think one good example of this is on the official Facebook post about his death from United Health Group, the parent company of the company that he was the CEO of. The vast majority of people reacted with the laughter emoji. There were 40,000 reactions on that particular post. 35,000 used the ha-ha emoji, and just 2,200 used the sad emoji. So, I mean, clearly there is a lot of animosity toward the health insurance industry.
Evocative and soft, warming and rich, appealing to a desire for comfort. That is not a script for a sensual phone line operator. Those are just some of the ways that Pantone is describing its color of the year for 2025. The color curator named Mocha Mousse a mellow brown infused with a sensorial and comforting warmth as the color it thinks will define the next 12 months. Neil, this past year's color was a warm and fruity peach fuzz. So a shift to a nougaty brown that evokes everything from luxury knitwear to swamp water. It's quite the 180.
It's the first time in the 25-year history of Pantone's Color of the Year that they've chosen a shade of brown. And I guess my question is, how much can Pantone put its imprint on culture going forward? Will a color organically appear and drive, general aesthetics? Or how much influence does Pantone actually have because it feels like they want to have influence? And one way they actually do is because when they announce the color of the year, they launch 1,000 different collaborations with brands. So they do start selling stuff in this particular color where they wouldn't before. But it is kind of interesting, especially if we're coming after a summer and a year where, Brat Green really drove a lot of online culture. How much of, what color stands out is organic and how much is a function of what the color elite say?
It is a good question. It's both predictive because they are predicting the color of the year and prescriptive because they are almost speaking it into existence. But I don't know. If you go back to the history, I think we're coming off of Peach Fuzz and Viva Magenta to have a brown. Maybe it is just time to settle down a little bit and have a little bit more of a mellow color of the year.
That is a wrap on our shows for the week. Have a great Friday and an even better weekend.
Great show day, Neil. I wish you all...
Welcome to Yahoo Finance's special coverage of the November jobs report. I'm Shauna Smith alongside Madison Mills, and we are just moments away from the payrolls number that we are going to be getting for November. Lots of emphasis and focus on this report. It's the final report that we're going to get here of this year. But Maddie, as you look ahead, many economists, many investment strategists are taking a look at this number, trying to glean exactly what this will mean here for the Fed going forward. Unlikely, I think, to say the least, to really change that macro view. But certainly, if we do see a massive surprise to the upside or to the downside here, that could be something that obviously could shock the markets and really move some of the trades today.
And a surprise to the upside could indicate a little bit of a question mark for the Fed in terms of the degree of excitement around cutting on that December 18th meeting. Having said that, of course, it's not just about the labor market. Inflation also a key picture here, and we're going to be getting that data in next week. Also interesting in terms of the prior month here, remember that jobs number coming in at 12,000, and it's going to be interesting to see how much of an upside surprise we could get here. Citibank saying, actually Bernstein saying this morning that we could get a surprise to the upside of 100,000 jobs added based on the ending of those strikes and also that hurricane-related impact to the labor market as well.
Yeah, the hurricane-related impact that obviously has created so much noise in the last few prints that we have gotten here. So maybe this print could give us maybe a slightly clearer picture of what is going on, some of the dynamics underneath the surface. Also keep in mind that it's holiday hiring season, and we know that just in terms of when the survey was taken and when the holidays fall, this was taken before many of the retailers did hire. So again, something to keep in mind as we look ahead here to that next print that we're going to be getting in just about a month from now. But when you take a look at the expectations, what we are looking to see here, non-farm payrolls expected to come in at 220,000. We also are expecting average hourly earnings on a month-over-month basis to decline slightly here to 0.3%, Maddie.
All right, well, let's get you those numbers here. The November payrolls report crossing the wire, coming in at 227,000, just above the survey number, which was 220,000. I want to take a look at that unemployment rate ticking up just a bit to 4.2%. The prior month was 4.1%, and the survey data also indicating 4.1%. Average hourly earnings rising 0.4% month over month, just above the estimate there. That was 0.3%. Again, that non-farm payrolls headline number coming in at 227,000, above that estimate of 220,000 here. Also taking a look at average hourly earnings year over year, again ticking up just a bit to 4%. The survey data coming in at 3.9%, but in line with the prior month at 4% here. Also awaiting those revisions as well to the prior month to see if there's a revision to the upside following the impact of that hurricane-related payrolls print. The September increase, again, pretty much bang in target for payrolls here. We will continue to cover all of these numbers as they come in and the market's reaction as well.
Yeah, you're taking a look at the quick reaction here. At least on our screen, we still have S&P futures. Now they are positive. There you go. So again, we're seeing a bit of an uptrend here on the heels of this print. When you take a look and drill down into the sector, some of the trends that we are seeing here beyond those headline numbers, you have employment trending up in healthcare and leisure and hospitality and government and social assistance. We mentioned retail there, obviously a focal point here during the holiday season. Retail trade actually lost jobs here for the most recent month. But again, that unemployment number that you mentioned there, Maddie, clearly will be a focus here this morning, taking up slightly just to 4.2%. Joining us now to break down these jobs numbers even further, we want to bring in Steve Sosnick. He's the chief strategist at Interactive Brokers. We have Robert Sotkin, the senior global economist at Citi. And Steve, let me go to you first just in terms of the market's reaction, the interpretation that we're seeing play out on Wall Street. What do you think of this print?
I think it's in line enough that the market's just going to do what it's been doing, which is continue the momentum trade. There's nothing in here to disrupt it. I think, my first reaction when I saw 227 was, wow, I was actually a bit surprised that it was this high. I'm seeing a 2-month revision to the positive side of 56,000, which is actually also a surprise. The unemployment rate, ticking up 0.1% to 4.2. It looked like the labor force participation rate fell to 62, fell a little bit. But to me, the other one that I think people aren't really focusing on too much is the monthly wage increase. 0.4%. last I looked, if you annualize 0.4% and the prior 0.3%, that annualizes to quite a bit more than 2%. We're talking 3-4%. That doesn't help the Fed's narrative if you're on the side of hoping for rate cuts. Well, before the number, we were at about a 72% chance, looking at a 72% chance of a rate cut. We'll see what the market has to say about that, because certainly Powell didn't seem to imply that either yesterday.
Well, let's talk to you about that, Robert. What are you thinking in terms of the Fed impact of this print?
Yeah, absolutely. These are all great points. And I think for the Fed, these numbers are going to be right in the spot of what they were looking for and they're comfortable with to continue easing policy, at least at the December meeting. So I would expect very much that for the Fed, this doesn't change the narrative, that likely rates are restrictive and they have to at least come down a bit more at a gradual pace. They'll be looking at some things that are concerning in the report, maybe a little bit of the uptick in the unemployment rate, a little drop in participation, but these numbers are extremely volatile month over month, and so the best thing is to kind of smooth through the last several months, especially with the volatility we've had in the reports. And the reality is we're getting an unemployment rate that's kind of staying in the low 4% range. That's sort of the definition of a soft landing. And so I think when you look over the last several reports, they'll be fairly comfortable that they're still getting that soft landing, but there are enough risks that I think they still need to lower rates.
So, Robert, we shouldn't be reading too much into that slight uptick then that we are seeing in unemployment rate.
I think that, historically, what we've seen in the past is when the unemployment rate started to rise, it tends to keep going. And then when the SOM rule was set off in the summer that the unemployment rate rose more than 50 basis points relative to its prior 12-month low, people got very worried. But we've mostly been moving sideways since that period, which is very different than what we've seen in history. And so I think if we're able to stay around these levels, this would be kind of sustainable unemployment for the Fed. Now, of course, the worry is you could go higher from here. I'm watching layoffs in particular very closely for that. And when we look at the jobless claims data, layoffs are very low. And so I think right now, not a concerning figure.
What is concerning then in terms of that average hourly earnings going up, Steve? I wonder if there is an inflationary backdrop under the hood of this print.
That's exactly what concerns me, Maddie. And when we think about it, the Fed's dual mandate is stable prices and full employment at a non-inflationary level. So if wages are rising. Now, let me stipulate, the idea of more people getting more money in their pockets is not a bad thing.
And maybe not a bad thing for equities, too.
People have money to spend, and, we've had the mixed range of retail earnings where it seems like, stuff like people spending money at Lululemon, but not necessarily in the dollar, in some of the dollar stores or some of the other things. So it's a bit mixed. So people having money is a good thing. But, again, if the wages are going up faster than the Fed's target, that doesn't help them meet their stable prices mandate. And to Robert's point, the idea of full employment, 4.2% unemployment is a number that most administrations would have died for in some of the old days. That's a really low number by long-term historical standards. So this, to me, says maybe Powell was sort of leading us in the correct direction of you may or may not get 25 basis points in December. He didn't explicitly say no, but maybe curb your enthusiasm about 2025.
Yeah, Robert, do you agree with that, just in terms of the fact that a print like this, when you take a look at these numbers, pretty much does rule out any sort of aggressive measures that we could see from the Fed in 2025?
Yeah, I think with the configuration of the data, not just the labor market data, if you look at some of the other figures we've been getting, still very resilient consumer spending. The Atlanta Fed GDP tracker for Q4 is well above 3%. So there really aren't a lot of signs that we're getting sharp slowing, except the concerns are, as we talked about before, that the unemployment rate has risen. Some labor market measures have softened. So that's really where the concerns about activity are coming from. But given most of the data are screaming soft landing, I think the idea of getting very aggressive rate cuts is unlikely, especially as we were talking about earlier. You do have to be a little bit concerned about inflation as well. Inflation has come down a lot, but is still above the Fed's target, particularly on the services inflation side, which is what's most tightly tied to wage growth. So, putting that combination together, I still think you get more easing, but I don't think you get aggressive easing. I think the bar for aggressive easing is extremely high. Maybe a meteor would have to hit the Earth, the U.S. economy. But aside from that, I think we're in for a relatively gradual easing cycle with these figures.
So then what happens to equities over the next 3 months, Steve? We get that cut in December, then where do we go?
Well, I think you have this honeymoon period that persists certainly through the end of the year. You could see the low level of VIX, and it's important to remember that VIX is not specifically a fear gauge. It's the market's best estimate of volatility over the coming 30 days. Well, there was really only the jobs numbers and the Fed meeting as major volatility inducements between now and the end of the year. So VIX has really dropped off. I think the big question, when you say 3 months, the big question sort of changes around 6 weeks from now is what happens when the new administration takes office? What might some of the tariffs be via executive order, that sort of thing? And that's quite a bit murkier, but that's not really priced in terms of the VIX 30-day calculation. I think right now, though, things are very frothy, but the trend is your friend. So it's a very hard market to fight.
Robert, how are you factoring in Trump's potential policies and the implications there? We talk so much about tariffs and whether or not they're going to be inflationary. We talk so much about budget cuts and just what exactly that is going to mean here for the economy going forward. What's your assessment?
Yeah, we just put out our 2025 outlook yesterday, where we kind of outlined a Trump base case, which is, there's a lot of uncertainty across a wide range of policy areas and kind of what do we expect within each. And the difficult thing for forecasting the economy is that Trump policies are a combination of positive and adverse demand and supply shocks, and sussing those out is very challenging. A good example would be if he does targeted tariffs, that would tend to lower growth and boost inflation. On the other hand, deregulation, which is another focus of his, tends to be thought to boost growth and be disinflationary in the short term. So I think it's very difficult to put all these together and say that inflation is going to be higher or growth is going to be higher or lower. It's going to depend on each of the factors. On balance, though, we do think when we look at all of the figures, on net, we're more worried about upside risk to inflation under Trump than downside. And I think that's another thing that points to, the Fed being relatively cautious, is when you net all these out, they're probably on net more likely inflationary than disinflationary.
And as Powell said this week, he's going to wait to see the impact of that policy and not kind of preempt any of it. Robert, thanks so much for joining us, and thank you, Steve, as well, for joining us to break down the latest jobs data. We appreciate it. We're going to send it over to Jared Blickery for a look at the movers on the back of that November payrolls report. Hey, Jared.
Hey, Maddie, it looks like risk on so far, and we're pretty early on here. And I should mention that a lot of times that we do get reversals of these moves into the trading hour as the day begins. But this is the initial reaction. I'm going to show you what's going on with small caps, because that is the biggest reaction to the upside. And we're seeing them up by about 86 basis points here. Those are Russell 2000 futures in the pre-market. And we can see even the Dow up just 13 basis points. It had been slightly negative before the report dropped, and now we are seeing a trade to the upside. And we're also seeing futures. We're seeing 2-year U.S. Treasury note futures. Those are trading up right now, which means yields are heading in the opposite direction. That would be down, and that's also supportive of the risk-on mood in the market. Those are the 2-year note futures. Here are the 10-year note futures. Very similar story, but I should say, too, these are not very big movements. We're still not seeing any kind of outsized reaction. And let's go to the gold market. Sometimes gold, silver, you'll see some reactions in the precious markets, in the precious metals markets here, not seeing much movement at all. Gold futures were already standing on some gains earlier when the report dropped, about 0.5 percentage point, and that is just not changing right now. And here's silver futures. Those are up 62 basis points, looking pretty similar to gold. I'm going to bet there's not a whole lot going on with Bitcoin here, but let me just show you ancillary. This is a market that has just been on fire, moving both to the upside and the downside by extreme amounts. I think it hit 92,000 or something overnight, and that was after selling off from 102,000. So big movements in Bitcoin, but that is not related to this jobs report this morning. And then let's get a read on the sector action. Consumer discretionary was leading before the report, and you can see most of the sectors in the green here. What is not in the green? Communication services and energy. And I just want to show you what's going on with some of the smaller issues. This is the ARC Innovation components. We're seeing Tesla, that's a big one, that's up, but also some of the smaller ones up, like Shopify 3%, Coinbase 1.5%. Just kind of speaks as to the risk on flavor we're seeing being expressed through these smaller, not always profitable companies. Shana.
All right, Jared, thanks so much for breaking that down. Coming up, we'll have more on the November payrolls report and look at what sectors gained and lost the most jobs. Again, you're seeing futures moving to the upside on the heels of the beat that we did get on the headline number. To recap those numbers quickly for you, the headline number coming in 227,000. That beat the street's expectations. Unemployment rising slightly to 4.2%, slightly above the average estimate of 4.1%. Also remember that 4.1% was also the prior reading there for unemployment. And average hourly earnings there on a year-over-year basis rising by 4% on a month-over-month basis. We did see a slight increase here of a rise of 0.4%. That was slightly higher than what the street had been expecting, I should say, of a rise of 0.3%. We'll be right back.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
The U.S. economy adding 227,000 jobs in November, 7,000 jobs more than expected. Unemployment rate ticking slightly to the upside here, up to 4.2%. Joining us now to break it down, we want to bring in Danny Romero. We also have Alexandra Canal joining us for a deeper dive into these numbers. And Ali, let me start with you because there's so many directions we could go with this report. But going into the print, there was lots of talk about strikes, how that affected past reports, how that will be reflected this month. What's your biggest takeaway from the numbers that we just got?
Yeah, the strikes, particularly the strikes at Boeing, really impacted the October jobs report. A lot of noise there, but we saw that pretty much rebound this month. Manufacturing, that was one of the hardest hit sectors in October, but we saw that rebound, particularly in transportation equipment manufacturing in the month of November. Employment in that particular unit increased by 32,000 last month, reflecting the return of those workers who were on strike. That's according to the BLS. In total, the manufacturing sector added 22,000 jobs after losing 48,000 in October. Leisure and hospitality also trended up last month with 53,000 jobs added after we saw little change in the month of October. Employment did tick higher in food services, and drinking places by 29,000. And if we look across the past 12 months, the sector has added an average of 21,000 jobs per month. So some relative strength in that category. But retail trade, that didn't do so hot. That lost 28,000 jobs in November after showing little net employment change over the prior 12 months. Now, in November, employment declined in general merchandise. That was down by 15,000, while electronics and appliance retailers added jobs. Now, this is not terribly surprising. Typically in November, we do see a pullback in retail jobs due to various seasonal factors heading into the holiday shopping season. We know a lot of retailers have been hiring earlier. We've also seen some shifts in consumer behavior when it comes to what they're purchasing. So I do expect that we'll see potentially a rebound in next month's job report. But all sectors to keep an eye on, especially as we've been tracking these strikes and the impact over the past few months.
All right, Allie, thanks so much for bringing us those numbers. Danny, we're going to kick it over to you. I know you've been following the construction data.
Maddie, it's not surprising that the construction sector added 10,000 jobs in November, a slight rebound from the previous month. Remember, there was a hiring freeze in October for construction jobs. Hiring fell to the lowest level since 2020, according to other government data. Experts say that the reason here was due to the election uncertainty and the expectation that borrowing costs would come down in the next several quarters, which would impact staffing decisions. But going back to today's jobs report, non-residential construction jobs saw a pullback last month, and the area that really saw a boost is residential construction jobs. This is an area that's a little bit more unpredictable. It gained 1,400 jobs last month, and remember, this is an area that has seen some pullback in residential construction job projects over the last year. But bottom line, experts tell me that they are expecting an increase in staffing in the next 6 months, specifically next year. So that means more hiring for construction jobs.
All right, Danny and Alexandra, thank you so much for joining us. We appreciate it. We're going to continue our coverage of the November payrolls report. We are joined now by Joe Brusuelas, RSM's chief economist. Joe, thanks for being here with us. I was here with you close to a year ago. You declared that we were in soft landing territory. What is today's print telling you?
All right, so today's print, it really corrects for the hurricane-induced October report. It's a little like fourth grade math class. What you do is you take the 227, you add in a 56,000 upward revision to the past couple of months, and then you divide by 2. What do we get? Well, we get 141,500. Guess what the 3 and 6 month trend was before the hurricane? 148,000. You know what? This is bang spot on. You know, we have a really remarkably calm labor market right now, ladies. If you take a look at the pace of firings, you know, yesterday, you take a look at this hiring, remarkable stability here. That's what I really see in this report. It's an American labor market that's just moving along at full employment, right? And I think that's the important thing here. We are at full employment. This is what one would expect. We need to hire between 100 and 150,000 a month to keep the unemployment rate and the labor market stable. What are we getting? Right around 148.
Joe, do you see anything that could put that in jeopardy?
Well, of course, right? There's always risks out there. My sense here is that we're going to get some big policy changes next year. That might take the edge off of it, because if the tariffs are outsized, yeah, it would make sense for big corporates to begin to pull back, because that's where you're going to see it. Now, when you look at the report, well, I think what we're getting is small and medium-sized businesses are hiring, but the big ones have stopped, I think, in anticipation of some of these changes. Moreover, you know, again, just to touch one thing here, the job losses in October were largely in Washington and Florida, where the storm was. We could see in the claims data for the last couple weeks, it came back. Danny made a really interesting point there around construction. I think it actually understated the rebuilding that's going on right now in the Southeast. I expect those construction jobs to be revised higher in the next couple of months. So we're in a pretty good place. Now, longer term, there are some issues in the labor market that I think we probably want to address here, because, you know, nothing's perfect forever.
Well, what are those biggest issues then? I guess we've talked a little bit about the inflationary pressures that you could see from wages, but underneath the surface, I guess what is most concerning?
So the median duration of unemployment is about 10.5 weeks. Most people who lose a job, they find one within 3 months. But we are beginning to see people who are unemployed longer than 15 weeks or 27 weeks. There's some issues there. A full 40% of those who are out of work and actively looking have now been unemployed longer than 15 weeks. 22% of those are facing longer bouts of unemployment. Now, typically it's a matter of friction. There are personal issues out there. There's some discrimination that's always there in the market, especially around older folks, I think. But the 800-pound gorilla in the room is technology beginning to create some unemployment? What economists would kindly call technological unemployment. It's what everybody worries about, artificial intelligence. Now, we just don't know. But my gut tells me we're probably on the outer edges of that. And that might be why there's some redundancies out there in the workforce and why people are having a hard time finding jobs, because some of their skills now are not really necessary because what we can do with artificial intelligence.
What you're talking about is so critical for listeners to understand. I think, Joe, especially as you have a DOGE group coming into the Trump administration that's going to focus on using tech to create more efficiencies. What does that do to the Fed if we do start to see a weaker labor market because of increased efficiency due to AI?
Okay, so if you're an investor and you see that, the Fed clearly would move to cut rates. Now, I think today's report does support a 25 basis point cut at the December 18 meeting. But I don't think we're going to see any more action until March of next year at the earliest. But over time, the Fed's going to pay very close attention to technological unemployment. I remember Ben Bernanke years ago, before this U.S. Senate, talking about this very thing. And the senators looking at him like, what is he talking about, right? Oh no, they're well aware of this over at the Fed, and they've been thinking about this for a very long time. And they would move to accommodate if that's the case. But I want to be really clear here. We don't know right now enough to categorically state that's it. But my gut tells me we're about to reach the point where we ought to start thinking about this a little more.
Joe, what is the most critical, looking forward, as we look ahead to next year? We talked a lot about Fed policy. I guess in your view, what is that most critical data point or report that investors should be paying attention to that really will give us the best sense of where the economy stands? Because we go back and forth all the time.
This is where I'm really glad I'm on Yahoo Finance today, because we can get a little technical. We can start throwing out some jargon. They need to begin looking at critical bond spreads that are proxies for leverage and liquidity. Now, since the election a month ago, I've spent a lot of time talking to my professional network, the cats who work on bond desks, repo desks at the systemically important financial institutions, i.e. the 5 major banks. They are beside themselves. They're giddy. They expect leverage to work back into this market, to flow through to the big companies who are then going to begin to expand their operations. I mean, this is going to be a very heady time if you work in financial markets. So that's what I really have my eye on, because the seeds for a financial expansion are all there. The light regulation touch, taxes coming down, the way in which tech and energy are likely going to really benefit from the new policy framework. So those are the things that I'm looking at with respect to at least the domestic economic outlook. Now, the global economic outlook is very different. You had a global economist on here from Citi, taking a look and say over in Europe, they're going to need to get aggressive with their cuts. That economy is stagnating, and they do not have the time to wait. So it's going to be a tale of two cities next year in the global economy, the United States and Europe.
It'll be interesting to watch how this all plays out. Joe Busuelos, always great to get you, especially here on Saturday Night today. Thanks
Happy
so much.
holidays, everybody.
Thank you, you too. All right, well, before we head to break, let's get a check on the market action. Taking a look at futures, you're seeing some gains here across the board. It looks like all 3 of the major averages on track to open the trading day in the green. Flipping over to the bond market, we're seeing some movement there, a bit of a pullback here in yields. You got the 10-year yield right around 4.16, and then flipping over to the dollar, we also did see a bit of a drop there on the heels of this trending of the dollar index pulling back just a bit. We got much more on the jobs coverage ahead. That's coming up next on Yahoo Finance. It's 9 a.m. here in New York City on this Friday, December 6th, the Jobs Day. Welcome to Yahoo Finance's flagship show with the Morning Brief. I'm Shauna Smith alongside Madison Mills, and let's get you guys the 3 things that you need to know this morning.
First up, the November payrolls report coming in hotter than expected. U.S. stock futures jumping on the back of the numbers, which showed 227,000 jobs were added last month, slightly higher than Wall Street had been expecting. October's jobs print was also revised higher from 12,000 to 36,000.
Plus, Bitcoin pulling back from its record highs. The digital asset trading below the 100,000 mark here this morning after hitting a low of $92,000. Here you have it just below 99,000. Still, though, Wall Street strategists expect the token to rally into the new year. And derivatives market pricing for January showing the highest open interest for Bitcoin options with strike prices of 110,000 and 120,000 that expire at the end of the month.
And Donald Trump tapping venture capitalist David Sachs to be the White House crypto and artificial intelligence czar. In a post on Truth Social, the president-elect said Sachs will guide policy for both of the industries. The new post is expected to help spearhead the crypto industry deregulation that Trump had promised on the campaign trail. Meantime, former U.S. Treasury Secretary Larry Summers casting doubt on Trump's idea of a national Bitcoin reserve. Summers dismissed the idea of the government setting up a reserve of Bitcoin assets in a Bloomberg television interview, calling the idea, quote, crazy.
Futures are pushing higher after the November payrolls report came in hotter than expected. A bit of a better print here. We want to bring in our very own Josh Schaefer for more on the market reaction. And Josh, there's so much to dissect and dig into this report. But Maddie and I have been talking for the last 30 or so minutes and focusing in on what we got average hourly earnings and the wages there, what ultimately that's telling us, because that did come in maybe slightly higher than what forecasters have been expecting.
Yeah, so average hourly earnings coming in at 4% year over year. That's unchanged from October. And largely, I think this is a big part of the story, guys, because the narrative coming into this jobs report essentially was, is if we got about in line print, which I think looking at our screen right now, 227 versus 220, 4.2 versus 4.1 on that unemployment rate, but some had been predicting 4.2. I wouldn't say that's largely unexpected to see unemployment rate come up. But really the narrative was, okay, if we get about an in-line print, CPI is going to matter a lot more to the market next week. And when you look at this consistent wage growth that we're seeing and the fact that that number isn't coming down, and you're talking about this last mile of inflation being sticky, it seems like something we're going to be talking more and more about going into next year. And again, I think it just makes, when we're thinking about what are the risks to this December rally, we kind of just keep talking about stocks are drifting higher every day. Stocks are drifting higher every day to end 24. Well, what could be the risk? It feels like now your risk is probably that CPI print, because it seems like the CPI print would maybe drive, that would be the catalyst to maybe have the Fed not cut in December. It doesn't seem like the jobs report today is moving the needle in terms of that argument, but maybe the inflation print next week does. And even if it doesn't next week, it gets into that whole discussion we've been having about maybe the Fed doesn't cut much in 2025 or at all, right? This wage growth story is a large part of that.
It seems like the market is really running with that 4.2% unemployment rate number as, evidence that the Fed continues to have that justification to cut. And yeah. I wonder how the inflation print, how much that could potentially change that narrative.
Yeah, no, it's an interesting point, Maddie. And the other thing, too, that I'll bring into this conversation from data that was out Wednesday, I was talking to ADP's chief economist, Neil Richardson. She was pointing out to me in their wage data growth right now, so if you took their private wage growth that they're looking at and you looked at CPI, wages are actually only pacing, per their data, about 30 basis points higher than CPI. That's a very narrow margin, right? And so what that means is we talk a lot about, well, at least wages are growing above inflation so the U.S. consumer can keep spending, right? And that's part of why we have this good economy. That margin is actually slimming too, because inflation isn't moving down that much. And at some point, if the general American consumer is barely making more money than the pace of inflation, you wonder about the overall trajectory of the U.S. consumer going into next year. That's a part of this story as well, if inflation doesn't keep coming down and sort of stays in this sticky range. But it does, I think overall, today's report reminds us that while we were talking about the labor market a lot in the summer, inflation seems to be the main print again and the main narrative that we're going to be talking about with the Fed leading into that meeting on December 18th, but also going into next year.
Yeah, Justin, I think that's such a great point here for investors and for our audience really to understand, because we have been going back and forth just about what print matters most and where investors should be paying close attention to, right? And clearly they both matter, because we wouldn't be having this reoccurring debate every other month. It's just about what we should be paying close attention to. I'm curious, just from your assessment so far, the number of strategists that you talk to, economists, just how they're factoring in the unknown variables at this point when it comes to Trump policy, when it comes to what is likely, the timing of that. Like, how much of that do you think is playing into this narrative, and how policymakers are also trying to figure that out?
Yeah, so when you bring in Trump policy, right, obviously sort of the consensus broad take would be his overall policies, including things like tariffs, are expected to be a little bit more inflationary, right? That's sort of the overall high-level take. The question is it inflationary in the first half of 2025, the second half of 2025, or do we not actually see that until 2026? That's one of the hottest debates right now. I don't think anyone really has a good answer because we're not really sure. But I think overall, if that is what leads to the Fed not cutting, that isn't something that people are necessarily worried about for the stock market in 2025 right now. It is, if the Fed is not cutting, because as Jay Powell just said 2 days ago, and I don't think this jobs report would necessarily largely change his opinion, the U.S. economy is in pretty good shape right now. If they're not cutting and the U.S. economy is in pretty good shape and they're waiting for inflation to come down, a lot of people would argue that's still a good opportunity for something like cyclical stocks. That's been a popular call we've been talking about going into 2025, right? Maybe something like financials, one of those sectors. And I think that call still remains whether we get further into this Fed debate about inflation. It seems like that is still something people feel confident going into 2025. But again, the unknown of the Trump policy, Shauna, definitely is the biggest question still looming.
Yes, and it's hard to figure out exactly how and what it's going to look like, obviously. All right, Josh, thanks so much. Let's turn now to the focus of the Fed here. Our next guest saying that it's actually the central bank's inflation battle now falls in their hands. Joining us now, we want to bring in Brian Jacobson. He's Annex Wealth Management Chief Economist and Strategist. Let's talk about exactly what that means here for the inflation battle falling into the Fed's hands. When you see an average hourly earnings print like this coming in slightly higher than expected, we have inflation remaining very sticky. What should the Fed do at this point?
Yeah, thanks for having me. So here at Annex on our investment committee, when we were looking at this morning's report just a little bit ago, it really is one of these things where it's not necessarily a Goldilocks report. It's more like a little engine that could report. As far as just the economy, it just keeps moving along, keeps climbing that hill, that wall of worry. And now it's really up to the Fed as to what are they going to do with this data. They have no idea where they actually want to end up with the federal funds rate. And so they don't know the destination, but they do know that the journey to get there includes more cuts. How many more and over what time frame? It's quite likely that they're going to cut in December at the next meeting, but then shift to a cadence of every other meeting in 2025 because they want to tread a little carefully here. They don't necessarily know how the economy is going to react with the cumulative effects of the rate hikes that they had. Even though they're cutting, they haven't really cut a lot. So I think that really they made a lot of mistakes along the way, but thankfully American consumers and American businesses have really just kept chugging along ahead to make up for those mistakes.
I want to zero in on the consumer with you for a second because we're seeing small caps rallying this morning, beating out the moves that we're seeing in large caps. And I wonder if that's the market telling us that there's this bet on increased consumer spending that's going to fuel some more growth in those smaller and mid-sized businesses. If we do see that increased consumer spending, though, doesn't that tick up inflation and therefore lead to a Fed that has to be more hawkish? What does that look like to you?
Yeah, quite possibly. I think that the immediate reaction here that we're seeing is that with lower yields, a lot of those smaller cap companies, they have higher debt burdens than the larger companies. And so you can get a little bit more of that relief. So if this almost locks the Fed into continuing along that path of gradual rate cuts, that should provide some relief to small caps. The burst that we could get with consumer spending, if we get a little bit more optimism now that we have the election behind us, and granted, we've traded election uncertainty for policy uncertainty, but consumers seem to be at least saying they're feeling a little bit better. So if we see some acceleration of consumer spending, that should hopefully redound to the benefit of small caps. So we have an overweight to small and mid-cap stocks for that reason, because we do think that it's not necessarily going to reverse course for the Fed. That we can see that improvement in consumer spending, but they're still so price conscious that they are very quick to shift to other retailers and other suppliers if they see prices moving higher than their wages are.
So then, Brian, when you take a look at a print like this, when you take a look at the expectations going into 2025, I think many investors are out there asking themselves whether or not this rally that we have seen, whether or not it has room to run, whether or not it can be sustained. When you take a look at a print like this, is that enough to continue this risk-on move to the upside?
I think for now, right, as far as do we then get some sort of pullback maybe in January as people reassess where are they with their portfolios. Sometimes if you think about, all right, if you had something that you bought at the beginning of January, now you get a year in, it's a long-term capital gain instead of short-term. So you can get some of that volatility, I think, as we get into the new year. And a big question in my mind is the sequencing of threats and policies from Trump. When he, in his first administration, he threatened tariffs and then implemented them when he wasn't getting his way. Now, is he going to come out instead and impose the tariffs and then promise to remove them if he does get his way? So I think that if we do a Trump who is a little bit more coming out of the gates swinging with actually imposing the tariffs, that could come as a bit of a shock, because I believe most people are thinking that you should take him seriously, but not literally. Well, at this point, where we are with valuations and the market run, I'd say maybe start taking him a little bit more literally.
So then what do you do with that, particularly given that you've got a Fed that is going to be cutting, at least if you look at what the market is telling us, but we have long and variable lags from those cuts, and also that policy is going to take time to actually get implemented. Which of those two is going to win out as the driver of the markets, the fiscal or the monetary policy?
I think that for 2025, it's really going to be uncertainty around fiscal policy, because they are likely going to take a good chunk of the year trying to figure out that budget reconciliation process, as far as, you know, all the horse trading that takes place in order to extend ultimately the Tax Cuts and Jobs Act, but what else gets thrown in there and modified perhaps. So I don't think the fiscal picture is going to become very clear. What is going to be clear, I think, is more the monetary policy side, continued gradual cuts. And so if the monetary policy, the cutting of rates really trumps the fiscal policy side, that should serve as a fairly favorable backdrop for risk assets, but it's not going to be without its risks along the way.
All right, Brian Jacobson, thank you so much for joining us. We appreciate it.
Thank you.
It's time now for some of today's trending tickers. Meme stocks still on the move today after the rally was sparked by stock influencer Roaring Kitty posting a cryptic message on X with a picture of a Time magazine cover that appears to resemble a 2006 issue that featured you as the person of the year, literally you. The post sent shares of GameStop, AMC, Unity Software, ticker U, and Clear Secure, ticker YOU, soaring yesterday. But taking a look now at AMC, those shares are moving to the downside. Now, part of the reasoning behind that I am anticipating is that we saw AMC dropping on this filing to sell up to 50 million shares today. We've seen them consistently waiting to offer these share sellings after Roaring Kitty posts. This is not the first time that AMC has done this, and we've consistently seen a negative share reaction off the back of that. But it's also no surprise to see Roaring Kitty potentially posting about this kind of meme stock rally in anticipation of those GameStop earnings coming up. Perhaps there is some movement ahead of those earnings.
Yeah, we certainly have seen, once again, him invoking some excitement within these trades. You mentioned the pullback that we're seeing in AMC here this morning. Again, that's on the back of a nearly 6% climb that we did see yesterday, when we did see more and more money start to be poured in to some of these meme stocks amid the speculation. And once again, Roaring Kitty, time and time again, when he does post, doesn't post very often these days, so that is why it's so significant and does tend to move the market the way it does. But we do tend to see a reaction given his following that he has been able to really accrue over the last several months and several years when you go back to the start of the meme stock craze. So GameStop, we saw a lot of volatility. We saw the stock halted briefly yesterday. We're seeing some a further push into some of these select meme stocks here this morning, with GameStop up another 2% here ahead of the open. But you could send yourself around spinning in circles trying to figure out exactly what some of these some of his posts ultimately mean and what he is trying to signal. That doesn't stop anyone. There's so many theories out there just on ultimately what this all signals going forward for the meme stock tree. He certainly has a lot of loyal followers, given that success that he did see a few years ago. But once again, I think this also just points to some of the froth that's in the market. When you take a step back, take a look at valuations, where they are today, take a look at Bitcoin hitting that record high yesterday. We're now just slightly below 100,000. I think that really just speaks to just that overall sentiment, that risk on sentiment. And obviously, you can draw some parallels, although very, very different. You can draw some similarities to what we saw a couple of years ago.
Yeah, and then you've still got that $7 trillion in cash on the sidelines that could come in and increase that froth even more, even further. So certainly a lot of bullishness and momentum to go around here. Coming up on the morning brief, we're going to count you down to the opening bell on Wall Street after a better than expected payrolls print. Plus, as we await a federal court ruling on the ban of TikTok, the potential ban of TikTok, we're going to look at the stocks to watch around that decision. And on the other side of our break here, Acting Labor Secretary Julie Su gives us her read on the state of the labor market. We'll discuss that and much more on Morning Brief. Welcome back to Yahoo Finance Live from the Labor Department here in Washington. I'm Jennifer Schonberger. The labor market rebounding in November after being slammed by 2 hurricanes and a worker strike at Boeing in the month of October. That non-farm payroll number bouncing back to the tune of 227,000 jobs versus a revised 36,000 in the month of October, though the unemployment rate ticking up 0.1% to 4.2%. For more insight on this morning's report, I want to welcome into the program Acting Labor Secretary Julie Su. Secretary Su, thanks so much for joining me. It's always great to see you.
You too, Jennifer.
So we saw a rebound in the job market in the month of November, quelling any fears about further weakening in the job market, though we did see an uptick in the unemployment rate to 4.2%. To what do you owe that?
So this is another example of this really historically strong economic recovery and the transition, as we've been talking about for some time now, to steady and stable growth. Last month we said that the hurricanes and the fact that there were tens of thousands of workers on strike affected the number, and this month landed exactly where we expected it to land. The total number of jobs created have been unprecedented under this administration. In fact, it's the only one that has seen job growth every single month in the entire time that a president has been in office. We're very proud of that. We're handing off the strongest economy in history to the next administration. The unemployment rate at near just above 4% has also been very, very consistent. Defied expectations, but very, very consistent. So it is up slightly, but since the summer, it's been between 4.1 and 4.3%. And what's important to note is, even with a slight uptick, the labor force participation rate is incredibly high. It's like for prime age workers at a 20-year high. Normally, when you see more workers in the labor market, you see bigger bumps in unemployment. That has not been the case here, and so. Again, like by all markers, this is a jobs report that we're proud of and an economy that we're really proud of.
But we did see the labor force participation rate actually tick down again for the second month in a row. Any thoughts on that? And the fact that we did see the uptick in the unemployment rate to 4.2%, is that a recognition that more people are trying to join the labor force, and that is why the unemployment rate went up? Or do you expect that that will continue to drift upward in the coming months?
So there's been a trend in terms of the overall labor force participation rate because of older workers, right? Of sometimes a slight decrease or steadiness. For the prime age workers, it has been very steady for a very long time, and that means people are feeling positive about the labor market. They're coming in, they're looking for jobs, they're finding them because of the large number that have been created, and they're making more in them, right? Let's keep in mind that wages are also up, and the rise in wages has outpaced inflation for months now, and so we're seeing wages on the rise and inflation going down, another marker that when you prioritize the well-being of working people in the economy, it does make a difference.
That Black Friday and the start to the holiday shopping season was later this year. How much of that downdraft do you think was because of a later start to the holiday shopping season versus demand for workers being lower because of inherent lower demand by retailers and a weaker economy?
Yeah, I don't think it's a weaker economy. I do think there have been, we've been seeing a transformation in the retail industry, right, for some time now, but certainly online shopping is a part of that, because at the same time that the retail employment numbers are what they are, we're still seeing record, consumer activity, right? Black Friday has been reported to be the most activity in a long time. And so people are buying things. They've got some of that disposable income to do so. But the nature of how people shop, I think, has been changing. And we're going to need to look over the next month also to look at retail, because this is a noisy period of time, right? The holiday shopping season does affect what happens in retail, and we'll need to look at another month to see if that's a real trend or just an aberration.
Speaking of trends and overall trends in hiring, we've seen that cooling. However, we haven't been seeing mass layoffs. Economists are calling this the no hire, no fire economy. What's your sense of that notion?
I don't know if that is more in comparison to, remember there was a time, certainly in 2022, where there was so many jobs being created and a tight labor market giving workers more power to choose. So many of them were leaving their jobs to get better jobs, right? It wasn't that they were being laid off. It wasn't that they were leaving the labor market, which would have been signs of a weakening economy. All of the pieces put together were signs of a very strong economy. I think the same is true now, right? This is a period of greater stability. People are settling in. And so, again, of the jobs that we've created, of the jobs that are growing, it's no accident that many of those are also in industries that we've said, if we build a strong economy where we prioritize workers and their wages, then those industries also become stronger too. And so we're just, I think, seeing some more stability, more leveling out.
We know that immigration is also part of this story. The forthcoming administration has talked about mass deportations. Of course, we don't know when and to what extent that policy could be implemented, but if we were to see a drastic drop in immigration, what impact would you expect on job creation and wages in this economy?
That's one of those, sort of, I guess, campaign promises that really have put some, real fear and insecurity into communities. And by most accounts, it is something that would be very harmful to the strong economy that we will be handing off to, there. part of the growth in this economy has been fueled by immigrants who have long helped to strengthen our economy, to do critical jobs. And so, I'm not going to predict what is likely to happen, but I do think that cruel and inhumane policies are inconsistent with building a strong economy.
This administration has done a lot for unions, organized labor. President-elect Donald Trump is looking to put forth as his labor secretary Representative Lori Chavez-DeRemer, who is a pro-union Democrat. Does that give you confidence that the reforms that you've made surrounding unions will remain intact in the next administration? And have you talked to Chavez-DeRemer?
So she and I have exchanged messages. I certainly want to be as helpful as possible in ensuring a smooth transition for her. I care deeply about the department, and one of the things that we have seen in this administration is that when the American people deserve a very strong labor department that is true to its mission, that understands that when unions are strong, workers are strong, but that also a large majority of American workers are not in unions, and so the Department of Labor stands as a really important defender of their rights, of enforcing basic labor laws. We put $1 billion into the hands of working people just who experience wage theft. That means you go to your job, and at the end of the day, you don't get paid what you were supposed to be paid. That is a break of a fundamental law, and it's the responsibility of this department to enforce it, right, to make sure that that's not happening. We, saw a decrease in this administration in the number of injuries on the job, fatalities on the job. I think those are examples of when the department is strong, when employers know that there is going to be enforcement if they choose as a business model to break the law. There are good results from knowing that there's going to be consequences to law breaking, right? So having a strong department is so important to all of that. And the most important thing is there are 15,000 career civil servants who work at the Department of Labor who believe in the mission, who come and do that work every day, and I believe that they will continue to do that.
Secretary C, we'll have to leave the conversation there, but thank you so much for your insight. As always, so appreciate it. Thank you. That's Acting Labor Secretary Julie Su. We will be right back after this.
We are just about 20 seconds away from that opening bell ringing on Wall Street. You're taking a look on your screen at the NASDAQ and the New York Stock Exchange, where we will be seeing that opening bell in just about 10 seconds here. I want to take a look, though, at the market reaction to that November payrolls report here, coming in just above the whisper number of 216,000, coming in at 227,000, and we're seeing a positive reaction in the equity market here on the back of that jobs print. You can see here in the futures market, the NASDAQ and the S&P 500 continuing to move to the upside. Also a little bit of movement in the Treasury space as we have this idea that the December payrolls number that we got in today for November is indicative that the Fed is not going to necessarily be able to cut too much too soon, and that could put a cap on yields here. I want to see if our NASDAQ has updated for the day. You're taking a look at gains of about 0.2%. The S&P 500 also moving to the upside. And I'll wait a second for the Russell to update as of the market open this morning. You can see here the Russell was under pressure yesterday. I think it's going to be really interesting to watch the Russell today because we saw the Russell beating the large cap names as of this morning on the back of that jobs print, perhaps in the idea that consumer spending moving to the upside could lead to a rally in some of those smaller business names. Again, though, the question being if the Fed does have to keep rates higher for longer, that could be putting some pressure on small caps moving forward. So that's going to be an interesting index to watch moving forward today. Again, you've got your S&P, your NASDAQ, and your Dow all moving to the upside off the back of that jobs print. And you can see here a little bit of the movement to the upside I was talking about in small and mid caps. If you take a look at the S&P 500 equal weight beating out the broader S&P so far in the trade this morning. Let's get over to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Well, thank you, Maddie. I'm going to put a 3-month chart of the S&P 500 on here so we can see we have now had it up 11 of the last 13 days, so only 2 down days. And basically, it's been on a tear since the election there on a number of occasions, breaking to new highs. And we've seen this in other markets as well. We've seen the NASDAQ composite come back to record highs, and the Russell 2000 just kind of eludes traders right now, those new highs. But you got to think that eventually they'll catch up and we'll be able to say a record closing high for the Russell 2000, something we haven't been able to say for a few years. 10-year T-note yield is marching to the downside. This is supportive of the risk-on rally after the payrolls report. We got those hot wage inflation numbers, but that may be counteracted by that increase in the unemployment rate. Here, the 10-year T-note yield is now off quite a bit from those highs of 4.5% that we saw only a few weeks ago. U.S. dollar looks like it's up now, had been down earlier, but not making too much of a fuss for traders. And in the early goings, we are seeing some cyclical action here in consumer discretionary and industrials and materials, but also consumer staples. So that's a defensive sector. That's number 2 up here, XLP. And we can see on a year-to-date basis that is not quite at record highs, the ones that we saw in September, but it's still holding on to gains of about 15.5%. But I want to focus on the Mag 7 right now. The Mag 7 index, not shown here, has been hitting record highs for several days in a row. Today would be the 5th. I don't think it's there yet because we're seeing a mixed board in those bigger numbers, in those bigger issues that you can see to the left. And Apple, Microsoft, Alphabet down just a hair. Microsoft flashing green now. But Tesla is the outperformer of the group. Tesla up 1.47%. I'll put a 5-year chart so you can see climbing steadily back towards those record highs that we saw in 2021. So investors getting excited about that. And I also want to take a look at Microsoft. Here's a 5-year chart. I'm going to dial this down to a 1-year so you can see that we are breaking through this resistance area. Had been stuck in a trend channel, just going sideways for a number of months. Now it's breaking to the upside. And will it continue on? Will it be the next Amazon, which recently broke to record highs itself? So that's kind of the blueprint there. We want to focus on some of the smaller issues. You know, we were talking about the small caps and are they going to catch up? Well, we've seen a lot of the fringier parts of the market. That includes the ARC innovation components that you're seeing behind me. That's unprofitable tech. Tesla is profitable, by the way. It's also a very big company. But if we look at the equal weighted version, we can see some of the leaders here. Shopify up 4.5%. Coinbase has been on a real nice run along with Bitcoin. And let's just end on Bitcoin. You can see it's down 3.14% right there. But really interesting, on Twitter, on social media, I'm seeing traders call this the Darth Maul candle, that red candle right there. If you squint, you can see it if you know the Star Wars trilogy, or I don't know how many they have now. But nevertheless, I promised we'd end it there. Crypto, a little bit of a downdraft for the morning.
Wish I could weigh in on that, Jared, but I'm far from an expert in that. All right, Jared Blickery, thanks so much. It's time now for today's strategy session. You got President-elect Donald Trump tapping venture capitalist David Sachs to be the White House crypto and AI czar. So what does this mean for the industry? We want to break it all down with Frank Spicer. He's Metafi's CEO. It's a predictive trading platform that actually sees Bitcoin getting to $250,000 by the end of next year. So a lot to unpack here this morning, but I want to start there with the lead, and that is David Sachs here being appointed this crypto and AI czar role here in the incoming Trump administration. Does that make you even more bullish on what the potential is here for Bitcoin over the next 12 to 13 months?
Yes, it does. It signals a shift to being hospitable to crypto innovation, and in general, just the concept of its viability as an asset class. I think it's a full vote of confidence from the administration, something the founders in the industry have been looking forward to for a long time. And everybody I've talked to is super bullish, almost unanimously. I don't think I really got anybody that is saying that this doesn't mean great things for the industry. And I think, that 250 starts to maybe look a little conservative if a few things click for the industry here.
Then what could be then more realistic? Are we talking 300? Are we talking 260? I guess give us a better sense.
Yeah, you can see 275, 300 if the rest of the world begins to adopt it as a viable hedge against inflation and an alternative settlement mechanism. There's really no reason why the price floor needs to be there. There's only a few million circulating Bitcoin. If you look at the historical chart, there's 21 million that will be in circulation, but there's about 15 million that are locked up right now that don't really move. So there's a limited supply and a growing appetite from large ETFs and nation states to soak them up. So I think that means a competition for the remaining Bitcoin on the market, and that pushes prices up.
But Bitcoin is down today, Frank, and there was this kind of idea that once they hit that $100,000 psychological level, we would see some profit taking, but we didn't see it right after we hit 100,000. What does today's move tell you, and is it part of a broader story here, or is it something simple?
Yes, actually. So this right here, what we're seeing is inexperienced traders taking long positions on Bitcoin and being taken to school by professional traders. I think what happened is people decided as the rally was running, to take long positions. If it wouldn't retrace, it was going to just blast to new highs. But that's not the way that the industry works. That's not the way the asset has ever worked. And over the past 24 hours, you've seen almost 1 billion in liquidations of BTC positions.
Frank, when it comes to, I guess, just the potential here, you talk about the key psychological level of 100,000. And I guess if we do see institutions and then potentially government continuing to buy in beyond this, and you have this appointment of David Sachs, how much does that just totally reshape the crypto market and maybe what is to come and make some of these regulations even more realistic or more probable?
I think it means great things for exchanges based in the United States, so they can start to bring these projects to the general audience and retail investor class. I think it gives exposure and a pathway for investors to see, okay, this project can develop, I can bring it to market. The United States starts to look like the way you bring projects to market, instead of being essentially radioactive over the past few years, where if you're a founder in this space, you were taking a real chance. Mark Andreessen was just on Joe Rogan explaining how he's had 30 founders debanked in the past, 3.5 years, just for being associated with crypto. And I think that all goes away. And instead, what you do is you see a return of innovation, which is what the United States leads the world in, and what we're best at.
I want to get your take on some conversations we've had here at Yahoo Finance this week with individuals who've both had to really stay the course during the crypto winter here, and that's Michael Saylor and Anthony Scaramucci. Let's take a listen to what they had to say about the Bitcoin rally.
Just keep buying Bitcoin with your spare capital. It's going to appreciate against the dollar forever.
This milestone is important because I think it tells people that Bitcoin's probably ready now for prime time institutional investing.
What an incredible backdrop for Anthony Scaramucci there. But, okay, are we really out of the woods when it comes to any question marks about the validity of Bitcoin, Frank? And I get that that's the question that every Bitcoin stan hates to hear, but I think there are going to continue to be people who remember the FTX collapse and still have questions about whether or not this really can come out of retail and be an institutional investment vehicle.
So I think if you fork the question here, yes, we're out of the woods in terms of its recognition as a viable asset class from professional investors, but we should not consider ourselves out of the woods for volatility, because the asset doesn't work like an equity, and it is subject to liquidations and things that typically don't impact stocks in the way that people might traditionally invest in them. So you're not able to look at it like a stable asset that has hundreds of years of precedent as stocks or equities do. But I think what we'll see is not just more of a better policing of the projects that come onto the market, but I think we can look forward to now U.S. exchanges such as like Coinbase and Kraken and Crypto.com, folks that bring projects to the retail investors in the States here, vetting the projects and taking projects with long-term viability. And once those sort of move into the market, and you're not just chasing these meme coins and meme tokens that are just ridiculous in my opinion, you'll start to see real value creation, real generation of returns for investors. But Bitcoin itself is going to be subject to swings, and I think you'll see that through the next 2-3 years before it starts to finally mature when it's 3 or 4 times the price that it's currently at.
All right, Frank Spicer is the CEO of Emitify. Thanks so much.
Thanks a lot.
Now for our chart of the day, let's take a look at just how expensive this current market is. This is a chart looking at the cyclically adjusted price to earnings ratio of the S&P over time here. You can see nearing record levels that we have not seen since the 1929 bubble. That was that Black Monday, heading into Black Tuesday as well on Wall Street. And then we have the tech and media telecommunications bubble, the dot-com bubble, heading into the early 2000s as those prior highs for this chart here. And then you can see at the end, we are taking up to historic highs as well. So what does this tell us? It tells us what we've been talking about nonstop over the past year, that the market is incredibly expensive and valuations are stretched. The question for investors, does it actually matter, right? We've been hearing from investors all morning, Steve Stogzek included, saying don't fight the momentum, don't fight the tape moving forward. Another quote I love from this morning, expensive stocks, they can always get more expensive, particularly when you look near term. And that's something that we spoke with Max Kettner from HSBC about this week. He sees the S&P going up between 5 and 10% in the first 6 months of next year. We've continued to get increasingly bullish price targets in as folks are doing their 2025 outlooks across the street. But the big question is the risks in this market, not only globally with geopolitical challenges, but also domestically with the incoming Trump administration. Could there be any fiscal policy changes that could outweigh the monetary policy as the bigger driver of this market? We do have the Fed kicking off their rate cutting cycle. They are expected to have that December rate cut. But then we've had folks this morning tell us it could be in every other meeting. They could skip in January and then cut again the next month. How will that impact this market that is stretched when you look at the valuations? Again, though, I would point to some of the commentary we've gotten from experts this morning saying don't fight that momentum and just go along for the ride.
All right, guys, coming up, a judge is expected to rule on the legality of the TikTok ban passed earlier this year. We will be taking a look at some of the other companies that could benefit from the ruling. That's coming up next. A Washington judge is expected to issue a ruling today on whether or not a potential ban of TikTok here in the U.S. will go forward in January. TikTok's parent company ByteDance arguing that the ban would be a First Amendment violation. Its supporters saying that the Chinese-owned app poses a national security risk. I want to bring in Rohit Kulkarni. He's Roth Capital Partners Managing Director and Senior Research Analyst for some of the companies that could potentially stand to benefit here from this ban. So, Rohit, lots to unpack here. Let's start with who plans to, or who is in best positioned to benefit. If we do see this blocked, if we do see the need here to divest come January, what are the top 3 plays then for investors?
So a lot of scenarios here that could unpack over the next 30 to 45 days, and Trump and Musk further complicates those scenarios, in my opinion. But near term, let's just stay focused through the year end. If the judge upholds the ban today or over the next few days, the social media players in the US are clearly directly to benefit, in particular Snap and Facebook or Meta. So those are the companies with the most overlap of the number of users and advertisers. So I would expect shares in Snap to rise the most, and then shares in Meta to rise as well. But having said that, what happens in January and what happens to TikTok's stance as far as appeals and the next steps in the legal process, that remains to be seen. That's what further complicates the scenarios, and whether Trump and Musk together, how they work with TikTok in the future.
I'm curious, Rohit, how much you are anticipating the Trump administration to really be able to do on this. I mean, this had bipartisan support. This is obviously happening today prior to Trump being back in office. What if this is kind of much ado about nothing? It's kind of already done.
Hard to predict, to be honest. What I think is that TikTok could just become kind of a negotiating ping pong between Trump and China to a certain degree. It could set the tone in terms of how certain digital assets from China are perceived by US capital markets. And TikTok is not just the only one. There are other companies such as Temu, such as Shein, and various different other factors that could start to be put on the negotiating table, if you will, as Trump puts this in a bigger kind of scheme of things. So that's where it starts to complicate things. And if you think of Musk that who owns Twitter and is kind of supportive of various different things that social media should be doing, and TikTok is probably in that sphere as well. So I know many unknowns here, but in my opinion, there's a scenario that TikTok would still be around come 1st of February, working alive and well in the US. So there is that could again reverse some of the gains in the social media stocks that we might see.
Rohit, when it comes to just this back and forth and uncertainty just about whether or not it's going to be banned, what exactly the future looks like even beyond here the next year or so, it's a company that its parent company, ByteDance, is recently valuing itself at just around $300 billion. Does that at all cap the upside that we could see here going forward just in terms of that growing valuation, or how should investors be thinking about that?
Yeah, absolutely. I think the new money that could be looking at a company like ByteDance is going to be staying on the sidelines, in my opinion, until there is a clear resolution of what happens to TikTok and its future in the US. Until then, probably there is almost no growth in ByteDance's valuation, despite what they may be doing outside of the US, outside of TikTok, and the core Chinese app that is kind of the sister app of TikTok in China. So obviously ByteDance would also be looking forward to a more quicker resolution, in a resolution that does not end with TikTok ban, probably a series of compliance steps. But I think we are several months away from that. I think this runs through the legal system, and you know that it probably takes a while before we actually see what happens beyond the ban that could be upheld today or this week.
I know that you focus more on the tech, Rohit, but I'm curious about the impact of the e-commerce side of this with TikTok Shop's success over the Black Friday holiday. Could something like Amazon be a beneficiary as well?
Yeah, absolutely. I think, again, it would be a small beneficiary, it could be a second order beneficiary, but when it comes to the style of younger people looking to purchase things and have a more of a serendipitous way of purchasing items, they are looking at newer places like TikTok, where the likelihood of them having an Amazon Prime membership or having a Costco membership, like I have, that's kind of the first things that we did when we got married. But those guys are not looking to doing that. So Amazon knows this. They're trying to put assets in front of younger people that could be attractive, that could replace the Temu, Shein, and TikToks of the world. So again, slightly to a smaller degree, but yes, absolutely, Amazon could start to get more eyeballs from the younger population as and if a company like TikTok starts to get thrown to the backyard.
All right, Rohit Kulkarni, thanks so much for joining us.
Thank you so much.
Coming up, we'll take a look at some of the top trending tickers on Yahoo Finance. More when Morning Brief comes back. We're taking a look at some trending tickers this morning. First up, Ulta beating on the top and bottom line in the third quarter and raising the lower end of its full-year sales outlook. The retailer also reporting stronger than expected comp sales in the third quarter. The results surpassing expectations on a number of metrics as the beauty brand faces increasing competition. Barclays, Jefferies, and Raymond James are among the firms raising their price targets on the stock this morning. You can see those shares still moving to the upside, up about 12%.
Plus, Rubrik beating third quarter estimates, raising its full year revenue guidance. Analysts saying that increasing demand for data security driving those positive results. Wall Street is bullish on the stock. You've got 18 buys, just 1 hold, and 0 sell ratings. A number of firms seeing further upside for the stock, lifting their price targets this morning. And finally, DocuSign beating expectations in the third quarter, boosting its revenue forecast for the full year as well. The company's billings growing 9% in the third quarter from the year prior. Analysts foresee further upside for billings, driven in part by early contract renewals. Wall Street is still mixed on the stock. It's got about 4 buys, 14 holds, and 3 sells of the shares, still moving up over 20% this morning. Well, that does it for the morning brief. But keep right here on Yahoo Finance. You got another hour of the two of us. But stick around for Catalyst. That's coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, investors cheering the U.S. payrolls report, with all eyes now turning to next week's inflation print. We'll discuss how the data could impact the Fed's path forward.
Plus, a federal ruling on the legality of the government's TikTok ban looms. We will break down what exactly is at stake.
And we'll hone in on the state of corporate America, with HPE and Lululemon jumping after earnings. All that and more coming up right here on Catalyst. Markets now pricing in an 88% chance of a 25 basis point rate cut following that November jobs report. That's up from about 70% before the report, according to our CME Fed Watch tool. We still got one more data print before the Fed's next meeting, and that's inflation, coming up next week. Here with more on her outlook for the Fed's path forward, we've got Diane Swonk. She's the chief economist at KPMG. Diane, great to speak with you. What would that headline inflation number have to be to change the likelihood of that 25 basis point cut on December 18th?
Well, basically, the biggest thing the Fed is watching right now is the stickiness in service sector inflation. So what we saw was an acceleration in that last month. We'd have to see a deceleration in that number to guarantee we get to the cut in December. And I think that's why we're going into this meeting and the blackout period with so much uncertainty, even though markets are very much excited about the prospect for another cut in December. The Fed itself has signaled all options are on the table of cutting or skipping a meeting in December, and that's because of the inflation data and the stickiness we've seen in the service sector. In the employment report as well, even though the unemployment rate ticked up a bit, the service sector is where gains were the greatest, and wages showed signs of accelerating actually in the service sector. The Beige Book showed that we saw earlier in the week from the Federal Reserve that entry-level wages are beginning to pick up, along with wages for skilled tradespeople. And I think those are things that are all going to factor into whether or not the Fed cuts in December. And it really leaves in our mind, it's still more of a flip of the coin.
So Diane, talking about the flip of a coin, I guess just looking ahead to 2025, there still is so much uncertainty out there. But given what we know now, what do you think would make the most sense just in terms of the pace of those cuts?
Well, already the Fed has signaled a slowdown in the cadence of rate cuts going forward, and that's because they don't know exactly what the non-inflationary rate is, and there is a lot of uncertainty about what the policy outlook will be. The Fed will not front-run policy changes, but once we do see things like tariffs and curbs on immigration, if they come to fruition even in a small portion of what the president-elect has promised, those could buoy inflation in 2025, and by our own estimates, slow down the number of rate cuts to 3 from 1.5% pre-election. And so that would be something that would not be welcome news by the president-elect, but it is going to be a sticking point if, in fact, we see things like tariffs that he's been talking about, even in a smaller portion, along with those curbs on immigration and the full extension to tax cuts.
When you are modeling what's going to happen in 2025, how is the question mark about fiscal policy impacting that model? And what are you doing to kind of find clarity? Because we don't know yet what is actually going to happen in terms of policy in Washington. It's just conjecture at this point.
Exactly. And so, first of all, we're starting out with a continuing resolution. We have to lift the debt ceiling again after January 2nd or suspend it so that we can move forward and not risk defaulting on our debt. But that continuing resolution, that means last year's budget has not been yet decided. They're going to try to get the extension of the full tax cuts into that resolution. Technically, you need offsets of increased revenues, and tariffs levied by executive order cannot count as offsets in reconciliation. You know, we've not seen either party really be disciplined on fiscal discipline, and so we don't expect that. But by the end of the year, you're going to see a new fiscal budget, and what there will be is attempts to cut spending at the same time that they raise spending on things like border security. The cuts to spending the math gets very difficult, and there certainly are efforts by the president-elect's team to think about ways to cut spending in the federal spending bill. Those get very difficult, but we do see constrained spending as we move into 2020, the end of 2025 and early 26. Remember, all of the spending that got deferred due to the continuing resolution, no matter what they decide on the budget, that will be spent in the remaining quarters of the fiscal year, which ends on October 1st.
Diane, I want to zero in on the consumer and some of the conflicting readings that we have been getting out this morning. We just got, just a few moments ago, we got the Michigan sentiment number actually rising to 74. This is a prelim reading. It's the highest reading that we've seen since April. Looking ahead and given some of the policy uncertainty that you were just talking about, the options that are on the table, I'm curious just to get your assessment of the consumer and what you think the consumer spending patterns are going to look like.
Well, right now we've got a lot of momentum and a tailwind for the U.S. consumer because we've seen wages outpace inflation for 20 consecutive months. That's restoring some of the purchasing power lost to inflation earlier in the pandemic, and it's clearly giving consumers a bit of a lift. We also saw the Conference Board numbers for the consumer confidence numbers in November rise quite dramatically, especially among those below 35 years of age on better job prospects. So all of that is giving us a tailwind entering the year with the consumer, along with the surge in wealth we've seen, and older consumers are tapping that wealth via their home equity lines of credit and upgrading their homes, much to the chagrin of millennials, to age in place. So all of those things set us up for the consumer to be in pretty strong shape as we enter 2025. What will matter thereafter is how much we see in terms of rate cuts and whether or not the improvement in inflation can actually continue. What the worry is that the premium that consumers earn over inflation could narrow again as tariffs are implemented.
I want to get your take on just how certain we are that there are not cracks in this labor market, because the median duration of unemployment continues to tick up here. We're also seeing underemployment continuing to tick up from its 2022 lows. Are there cracks in this market that we're ignoring?
The thing we worry most about is there's major downward revisions that we know are already in the pipeline for 2023 and 2024, which means we have less of a cushion in terms of labor market strength. We have a lot of productivity growth, but less of a cushion in terms of job generation. And also, overall job generation is very concentrated. 70% of jobs that we've seen added since June of 2023 have been concentrated in three sectors: healthcare and social assistance, leisure and hospitality, and the public sector, mostly state and local jobs. State and local governments are expected to see some of the biggest cuts in funding from the federal government, along with the fact that their fiscal 2024 was not very great. So that could undermine the gains in employment as we move into next year, and that's something that we're going to be watching extremely closely, given how concentrated job gains remain and the fact that we could have less of a cushion. That's where there could be cracks in the labor market going forward.
All right, Diane Swonk, always great to have you. Thanks so much for taking the time. Stocks rising after a November jobs report came in higher than expected. Markets now pricing in a nearly 90% chance of a 25 basis point rate cut come the Fed's next meeting in just about 2 weeks. So how should investors be positioned with the Fed in mind? We want to bring in Eddie Gabor. He's the CEO of Key Advisors Wealth Management. Eddie, it's great to have you back on the program. So we certainly are seeing some movement to the upside here. Risk on sentiment, it seems like in equities in the bond market, we are seeing a bit of a pullback, much of that based on the expectation here for that December rate cut. I'm curious just to first focus in on that bond market reaction, a bit of a pullback. Have we seen maybe a cap in yields to the upside?
Temporarily we have, because I think the Fed is absolutely going to cut in December, because I think they're going to put more emphasis on the labor market than they will the inflation data that we get. But I do think it's a head fake, because I believe next year we will see a reacceleration of inflation and calls that 10-year bond to get closer to 5%. So we're keeping a close eye on the 10-year. I think that is much more important to focus on than what the Fed actually does, because last time the Fed started cutting rates, the 10-year just went straight up. So as long as the bond market stays cool where we are right now and range bound, it's going to continue to be very bullish for the equity markets. I think any